Okay, so welcome to everybody. Thanks for being here. I'm Pietro Garibaldi. Welcome to Collegio Carlo Alberto and LTI. So we are very pleased and honored to host the fourth joint workshop, Long-Term Investor Trends, Theory and Practice, that we manage jointly with the Bank of Italy. Last year was in Rome, and this year is in Torino. If the institution goes on, we might have it in every other city. So I don't have much to say in substance. Just a few words about the Collegio and LTI. So the Collegio is a joint venture of University of Torino and Compagnia di San Paolo, and is the location. Some of you were, I heard they were in the past in Moncalieri. It has been moving here 6-7 years ago, and now we are fully integrated with the city. And inside the Collegio, there are various institutions. One of those is LTI, which is a small think tank, which was established in 2017 by the University of Torino under the guidance of Elisa Luciano, which is here. She was the first director for 4 years. And the idea of LTI, it's a sponsor-based think tank, and on one particular issue, which is long-term investors. And so it engages in outreach activities, research, and an educational program within this topic. So the sponsor, let me remind you, the sponsor are financial institutions in North Italy, Compagnia di San Paolo, Intesa San Paolo, Banor, Equiter, Ersel, Fondaco, and Reale Mutua. And so these are the sponsor of the of LTI, which we are organized with beyond myself and Luca Regis, which is the deputy director. We have a scientific committee. Some of the members are here. We have Ugo Panizza and Tito Cordella, which are presenting and discussing, and also Elisa, which is still in the scientific committee, which incidentally we will meet on Wednesday. So this is a good example of what we do, and more on the research oriented. And the idea is bringing people on this topic, and we have a full intensive day, and so I don't want to take too much time. So just the logistic is in the program. So presenter will have 25 minutes for giving the talk, 10 minutes for discussion, and 5 minutes for questions. So I will chair the morning session, then we will have a coffee break, and the coffee break and also the lunch will be upstairs in what we call the common room. Now, in the rest of this introduction, I will give the floor to Lanfranco Suardo of the Bank of Italy, which will give us some views on the topic of the conference. Let me just thank the organizer, because the workshop and the program, it's amazing. We had like 60-70 submissions, so it's quite impressive. So Luca, as I mentioned, did most of the work, but also from the Bank of Italy, Marcello Pericoli and Marco Tabogo are key. And also for all the logistics, you probably had to deal with Florence Plochard-Con, she's wonderful, and she's also here, and we are all indebted to her and to all the Collegio staff. So have a nice and productive day, and I just give the floor to Lanfranco. Thanks.
Thank you, Pietro. On behalf of Banca d'Italia, I would also like to welcome you all to the fourth workshop on the long-term investors trends, theory and practice. And the workshop addresses important issues about investments and financial markets on the background of increasing climate risks and sustainability concerns in asset and liability management. And this is the first workshop after the pandemic, of course, where almost all the speakers are physically present. Therefore, this is a good opportunity. I'm confident that we will be able to make the most of our discussions being here all together. This is very nice. Bank of Italy and LTI started this cooperation in 2019 with excellent outcomes so far. And I wish this workshop will continue this tradition and reinforce the collaboration aimed at investigating long-term investments. The workshop, let's say a few words about the issues addressed by the workshop. The workshop discusses three interconnected topics that are of utmost importance in today's financial landscape. Environmental, social, and governance, ESG. We talk a lot about ESG today. Consideration, and we include in ESG also climate risk. Long-term investors' behavior and asset pricing. ESG considerations are increasingly shaping investment decisions. They go beyond economic performance and take into account a company's impact on the environment, its relationship with employees and stakeholders, as well as its corporate governance practices. In recent years, ESG has gained significant traction as investors recognize that sustainable and responsible business practices are not only beneficial for society, but they can also drive long-term financial returns. This is a key point. It's not just it's also a sort of interest-driven traction. One critical aspect of ESG investing is climate risk. Climate change poses a significant threat to our planet, and businesses are increasingly recognizing the need to mitigate the associated risks. As the world grapples with rising temperature, extreme weather events, of which we had unfortunately a tragic example in Italy a few weeks ago, and other climate-related challenges, investors are incorporating climate risk assessments into their decision-making processes. It's a key point for investors now to incorporate these risks. Companies that fail to address the issues raised by the changing climate landscape may face significant financial repercussions in the long run. Therefore, understanding and managing climate risk has become vital for sustainable investing. And let's go to the second issue touched upon by the workshop, which is long-term investing. I am personally, having spent much of my professional life in banking supervision, I became very soon very well aware of the virtues and advantages of long-term investing, which looks beyond short-term gains and focuses on achieving sustainable growth over an extended period. And long-term investing is also consistent with the principle of ESG and climate risk. And by incorporating ESG considerations and factoring in climate risk, investors can identify companies that are well positioned for long-term success. Because the key point is that companies committed to addressing environmental and social challenges tend to be not only resilient, but also innovative. So it's a key point, it's a key part of innovation in the company policies. The capacity of being able to address ESG and therefore having a long-term focus in investment. And finally, this is the last point, the last issue addressed by the workshop, is the conducting rigorous asset pricing studies remains fundamental to understand how new investment strategies, including these long-term and sustainable ones, can be optimally implemented in what kind of risk-return trade-offs they face. The ultimate challenge is to provide investors with the tools needed to make informed decisions that prioritize both financial performance and positive societal outcomes. The ambition is to contribute to a more sustainable and prosperous future for all. This is quite a significant ambition, I would say, but it's worth trying. a few words on what we are doing about sustainable investment at the Bank of Italy, because we are very much involved in that. The sustainability of investment is part of a strategy of the Bank of Italy. And during the Italian presidency of the G20 in 2021, the bank played a leading role in defining an ambitious multi-year agenda for sustainable finance and the fight against climate change. And moreover, the bank launched several initiatives aimed at addressing the need for high quality, granular, and international comparable data about firms' ESG practices. In 2022, the bank also became a member of the steering committee of the Network for Greening and the Financial System, a group of central banks and supervisors willing to share best practices, contribute to the development of climate risk management in the financial sector, and mobilize mainstream finance to support the transition towards a sustainable economy. As far as there is a possibility for the central bank to lead the financial system, we are very much involved in trying to convince all the market participants that this is an important aspect to. This is an important part of a strategic issue for the whole financial system. The commitment of the Bank of Italy to sustainability objectives goes beyond international cooperation. In fact, internally, we set up a climate change and sustainability committee, which contributes to defining the bank's financial strategy and the hub of experts to stimulate and coordinate analysis. Furthermore, we have integrated ESG principles in the management of some of the bank's portfolios, following the guidelines published in Investment Charter. We use both ESG scores and carbon matrix in the management of our equity and corporate bond portfolios, and we invest in thematic portfolios aimed at supporting companies that develop technologies instrumental to the green transition. We integrate sustainability matrix in our strategic asset allocation exercise. So we have a whole set of methodological approach devoted to sustainable investment. The Bank of Italy commitment to ESG integration may also serve an example. This is very important to the investment community. The goal is to show that sustainability considerations can lead to improved financial performance and risk management. And by embracing ESG principles, we can foster innovation, reduce risks, and create a more resilient and prosperous economy for all. Let's go briefly to the papers that will be presented today, following these three main items. Today we have the opportunity to discuss a wide range of topics that are all relevant not only to long-term investing, but also to the unprecedented climate challenges we are facing. Two of the papers, I will shortly mention the papers without naming all the authors. I would like to avoid making too many mistakes in spelling the names. Two papers, one on carbon policy surprises and the other on reducing carbon using regulatory and financial market tools, show that the links between carbon emissions and financial markets are significant and multifaceted. As carbon emissions contribute to climate change, they pose various risks to economies and financial systems. These risks include extreme weather events, transition risks arising from policy changes and regulations, and regulatory risks related to compliance and market competitiveness. On the positive side, because there is also positive side of the story, the transition to a low carbon economy presents investment opportunities in renewable energy. clean technologies and sustainable infrastructure sectors. Understanding and integrating climate-related risks and opportunity into financial decision-making processes is essential for managing risks, capturing opportunities for new investments, and supporting the transition to a sustainable future. Another paper presents a general equilibrium paper on dynamic ESG equilibrium, presents a general equilibrium framework for understanding, put these into a general equilibrium framework, trying to understand the role of sustainable criteria in asset pricing. So a theoretical framework for all of that. 3 papers then will analyze the role of different financial market players in equity markets. Do institutional investors stabilize equity markets in crisis periods? I had a look at the papers. This is particularly having at the. I don't want to talk about the paper, but I found it particularly interesting. And another paper deals with institutional investors in bond markets. And the third paper analyzes the role of culture in banking businesses, cultural stereotypes of multinational banks, and understanding what drives the behavior of different categories of investors, their needs, institutional constraints, and specificities is essential for designing good financial products, efficient market mechanisms, and effective regulation. The keynote speech, Imperfect Financial Expectation Theory and Evidence, will focus on another key aspect of investor behavior, how market participants form their expectations, possibly departing from rationality, and how these in turn affect asset prices. And finally, 2 papers will provide a theoretical and empirical analysis of financial market, what is missing in asset pricing factor models, and flight to climatic safety, local natural disasters, and global portfolio flows. Studying the mechanics of markets, how assets are priced, and how they respond to all kinds of shocks, including those related to climate, is a very important part of designing effective long-term investment strategies. And in particular, long-term investors need to have a complete and up-to-date understanding of the risk and the potential sources of financial rewards they are exposed to. So this is it. So to conclude, I think that we have a very rich program. The workshop addresses topics that are highly relevant for investments and for policy making. And I hope that it will favor the blossoming of new ideas, so which are very much needed because the economy is changing. We are in a time of high uncertainty, and there is a need for addressing this uncertainty with possible new ideas. And for these, I want to thank the LTI, the organizers, the keynote speaker, the presenters, the discussants, shortly, all of you in advance, and wish you a constructive day.
Thanks a lot, Lanfranco. Indeed. Okay, so I guess we should move to the formal presentation. So the first is, I think Ugo Panizza will give the talk, and it's Carbon Policy Surprises and Stock Returns, Signals from Financial Markets. So you have 23 minutes. I take you 2 out.
Okay.
The discussant is Ludwig Chincarini. How do you pronounce Chincarini?
So 23 minutes. Okay, very good. So first of all, thanks to the organizer for inviting. us. So this paper is joint with Martina and Richard. Martina and Richard are both at the fund, so whatever the usual thing, it's not the opinion of the fund. But the management of the fund doesn't even know that this paper exists. So, okay. So I will go through the paper a bit quickly because we don't have much time. So I want to give you a flavor of what we do. Spend some time about the conceptual framework and the empirical methodology, and I'm going to show you the baseline result. I don't think I will have much time to go into robustness checks, but they're there. Okay, so the motivation, I think, the introductory talk told us about the motivation. There is this commitment by many countries to get to net zero, and when we emit carbon, we create a negative externality, and as economists, we think that pricing this negative externality is a good way to address it. The EU set up the first large emission trading scheme in 2005. It didn't work very well at the beginning because basically they give away these carbon allowances for free. So the price was, and they gave too many, so the price was close to zero. But with time, the price started increasing, so it seems to be working. And it's a cap and trade scheme, right? So there is a given amount, and then firms can trade the allowances, and so this is efficient, all this sort of stuff. So that's and what we want to look in this paper, if we want to see if policies that affects the availability and the price of these emission allowances are reflected into stock prices of firms, depending on how emission intensive they are. Okay, so that's the idea of the paper. And so basically we build a data set. Actually, Diego Kanzik already partly built of it, of policy regulatory surprises, and we look at whether there are events which affect the EU carbon policies. If this event have an effect on stock returns of firms, depending on the carbon emission intensity of these firms. What do we find? We find that there is this effect, and that the tightening of carbon policy actually leads to lower returns to firms with a high carbon emission. And interestingly enough, this does not only apply to firms because not all firms participate in the EU emission trading scheme. We find that this effect also applies to firms which currently do not participate into the ETS, which we interpreted as these policies implying some sort of carbon transition risk. We'll get to this in detail in a moment. So there is a literature which is fairly recent, but it's growing. I will not go through all the literature, but I want to highlight 3 papers. 2 papers by Patrick Bolton and Martin Kaspersik, hard to pronounce. And so these 2 papers focus on the cross-section of stock returns. And so basically what these 2 papers, one just for US firms published in the Journal of Financial Economics, and the other one for a panel of firms all around the world published in the Journal of Finance. These 2 papers focus on the cross-sectional of stock returns. So they don't see what happens like we do, what happens when there is a change in regulation, but they basically look at whether firms that emit more carbons on average have higher returns. If they have higher returns, it means that the cost of equity capital for these firms is higher, and that's what they found, so focusing on the cross-section. There are also 2 other papers, by Patrick Bolton and a bunch of co-authors, which has not yet been published, and one by Milcher and other authors, which try more similar to what we do. They try to look at the relationship between carbon prices and stock returns on impact, but they only focus on firms which participate in the emission trading scheme, and they do a very painstaking exercise that they look at firms, whether firms are long or short in emission allowances, and they find, not surprising, since this emission allowance is either an asset or a liability if you're long, or a liability if you're short, of the firm, that when the price of carbon goes up, the returns of firms which are long on these allowances goes up, and firms that are short, it goes down. So we don't look at the endowment of firms in terms of carbon allowances. So we consider all firms, those who need it, doesn't need, so the sample is larger. And we want to see if exactly there is a response which is independent on whether firms currently need or do not need these carbon allowances. So, I want to spend a couple of minutes just to tell you how the difference between what we do and the cross-sectional studies do. So I'll do this through a very simple example. So consider that you have two firms which are identical right now, and one firm, call it A, does not emit any carbon. And then you have a firm, call it B, which emits carbon. And these two firms are identical in the sense, to make it the easiest possible thing, these firms at some point in the future will have an asset which has a value C, okay? And the market doesn't think about carbon risk and whatever. So what is the value today of this asset is the same, and it's simply the discounted value of this asset, which will pay at a time t. Now let's suppose that at time t prime, there is a policy shock which affects the value of firm B, the dirty firm. And we think about three possible shocks. One shock is that the expected value at times big T is still C, but is no longer certain because there is some, risk linked to the production of this dirty asset. So if that's the case, investor will require a high return simply because now I have a safe asset versus a risky asset. So there will be a risk premium that we call rho. That's one possibility. The other possibility is that the value at time big T will remain certain, but this effect of carbon reduce the value of this asset. So now the asset is worth delta C with delta less than 1. That's the second possibility. And the third possibility are the first and the second together. So the asset is worth less and it's uncertain. So both the asset will be worth delta C and the return will be with some uncertainty. Now, under these three possibilities, you can see the behavior of the price of the asset when this shock realizes. So the green line is the green asset, which is not affected. The light gray line, the dark black line is under the assumption that the return is the same. So you see at big T, the value is that. But since the investors require a higher return, there is a drop in price immediately brought about the fact that the discount rate is higher. The light gray line is under the second assumption, that is the return is still certain, but the terminal value is lower. So the required return is the same. So you see the slope of the light gray line is identical to the slope of the green line. And the third one is both of them. So the terminal value is lower and it's uncertain. So the slope is the same as the slope of the black line, but the terminal value is less.
You think only of negative shocks?
And we're thinking about negative shocks. You can think about positive shock, it would be the opposite. But the only thing the reason why I did this, because when we presented this graph, there was some confusion between what we do and the work by Patrick and Marcin, because what Patrick and Marcin, they're basically comparing the slope of the black line and the slope of the green line, right? So the return in the cross-section after some carbon shock as realized. And what we're trying to do, we're trying to estimate the effect at the time of the shock, okay? So that's the difference between what we do and what they do. So the data, I'm gonna not spend much time, but we have data on carbon emission that comes from Urgentem. And here you see the carbon emission by sectors. You know, as you might expect, if you produce electricity, you emit a lot of carbon. If you're a life insurance company, you emit less carbon. So this is some background about the emission trading scheme. I'm gonna skip it not to waste too much time. And the only thing that what we have this data set of regulatory updates, which has been built by Diego Kancic up to 2018, and we update it up to 2021. So we have dates in which there is some change in the regulation. And again, following the paper by Diego, we see, we look at whether this regulation has an impact on carbon prices. And so our policy shock is the change in carbon price on the day in which there is a regulatory event. That's our policy shock. And here you can see these are all the events and the change in carbon price around event days. Okay, so that's what we do. So let me tell you a little bit about our empirical strategy, which is very simple. The interpretation is slightly more complicated. So I'm going to show you the regression that we ran and then spend a couple of minutes to tell you about how we should interpret the results. And in fact, if you read the working paper that has been posted before, there is a mistake because we didn't have the right interpretation, but now I'm going to tell you the right interpretation. So the regression that we run is this regression. So here as a dependent variable, we have the stock return of firm I in a given day, within a given year, of course. So these are daily data on stock returns for all our firms. And here, this is a variable that tells me how much carbon these firms emits. This is only available at yearly frequency. And this variable is interacted with a bunch of things. Well, we have a bunch of fixed effects. I'll tell you a little bit more about the fixed effects. But so what we have first, we have just the firm emission. And this alpha parameter is basically the Bolton and Kaspersky parameter. So it tells us in the cross-section, what's the difference in stock return, the average difference in stock return between high and low emission firms. Then we, is this dead? Okay, this doesn't point anymore. Okay, this is dead. Then we have the beta 1, which is basically what happens to the carbon price. So this is how firms react to stock returns when the carbon, depending on their emission level, depending when the carbon price moves. Then we have the beta 2. This is a dummy that takes value 1 in regulatory event days. And then we have beta 3. This is the interaction between the change in carbon prices and the regulatory event days. So here we are looking when the carbon price moves during a regulatory event, how it affects firm stock returns depending on their emission. So that's the regression that we run. And in our original paper, we completely focused on beta 3. And our idea is that, well, if on a given day, in regulatory event days, stock returns only move because it was a regulatory event, that's the effect of the carbon policy of stock returns. Then we thought a bit harder about this, and we realized that beta 3 is not enough to estimate the causal effect of carbon policy on stock returns, depending on carbon emission, but we need something more complicated. Why do we need something more complicated? And the best way to think about the problem is to look at this graph. So here we have stock returns. here we have our carbon policy. This is what we care about. We want to see how carbon policy affects stock return. Now, the problem is that we don't observe directly carbon policy. Our proxy for carbon policy is how much carbon prices move on regulatory events. But carbon prices can move for three reasons. They can move because there is a policy. They can move because there is some other shock, which we have no clue what it is. Or they can move because there is an increase in demand for companies that are emission intensive. So we don't observe the policy, we just observe the carbon price in event and non-event days. Of course, if we could make the claim that the only thing that moves prices in event days is the policy, we say, well, that's what we have. But it's kind of, since carbon prices move every day, it would be kind of weird to say, well, you know, all the factors that move carbon prices in every day are completely shut down the day there is a policy. So our beta 3, why this thing doesn't work anymore? Oh, no, it works now. This beta 3 basically, in our early interpretation, would indeed assume that on shock days, nothing else happens. So now, luckily enough, under relatively weak assumption, you can use this regression to recover the causal effect of the policy on stock returns, and basically this, which is some sort of combination of beta 1 and beta 3, where beta 3 is weighted by this formula, which is on K, and K is the ratio of the variance of the carbon price in event days vis-a-vis the variance of carbon price in non-event days. So once you have this adjustment, under the assumption that, well, these assumptions that are listed there, and under the assumption, no, it's not listed there. So basically, the assumption is the two shocks, that the shocks that move. Okay, sorry. The assumption is that this shock and this shock are additive and not multiplicative. If they're multiplicative, you cannot do anything. Under the assumption that these two shocks are additive, you can recover this total effect of the carbon policy. And in our baseline estimates, actually, total effect is larger than beta 3. It's about 2 times beta 3. So now that I told you everything about the empirical strategy, how much time do I have? 5 minutes. Okay. Now I told you what I do. I just show you the numbers now. So then we run the 7 minutes. Okay. So this is our baseline estimation. So this is, first of all, we start by adding one thing at a time. So this thing is just this parameter. It's just the parameter alpha. So this is the Bolton and Kaspersky parameter, and so when we put it alone or we put it with other control, we get the results that in the cross section, firms that emit more, that investors require higher returns from firms that emit more. Then we put one interaction at a time, but the full model is this model. So first of all, this is our beta 3 parameter. So this tells us that in policy event days, there is a negative correlation between carbon prices and stock returns for firms for high emission firms. But more interestingly, when we compute our causal effect of the policy, we get a coefficient which is fairly high and statistically significant. Now, interestingly enough, so you know, we spend quite a lot of time in the paper discussing that by just running carbon prices on stock return, you know, you get a reverse causality problem, because basically what you're picking up this effect. Of course, if the demand for electricity goes up a lot, there will be a lot of demand for carbon. The price of carbon will go up, but electricity producer will also have high profits. So, and in fact, sorry, now I'm going the wrong direction. And in fact, in non-event days, the correlation between carbon prices and stock return for high emission firm is positive, which you can see in this graph. So this is the correlation in non-event days, and this is the correlation in event days. We do a bunch of things. So first of all, when we run this regression, we have a bunch of, we have firm fixed effects, we have country, sector, time fixed effects. So we have kind of rich set of fixed effects, but people could tell us, firms report results every quarter. So maybe you should control for all some kind of firm balance sheet and income statement outcome that are reported every quarter. We could have done that, but we did something even more radical. So we run a regression with firm year quarter fixed effects. So this controls for whatever happens to a firm in a given quarter. So this kind of wipes out whatever investor can see from quarterly report of the firms. Clearly, when we do this, we can no longer estimate the effect, the Bolton and Kaspersky effect, because this variable only varies yearly frequency. So once we throw in, firm quarter fixed effects, this thing disappears, but everything else remain unchanged. And also you see our effect, it becomes 4.09. It used to be 4.13, so that doesn't change anything. The last important experiment that we do, so we wanted to see, so you can think, you're a high emission firm, you need to buy carbon offset to produce. So it's kind of natural that when the price of carbon goes up, your profit go down, right? So that's a pure, I think it would be still something interesting, but this would be a pure cost effect. But we wanted to see, but some of the theory that emphasize this, it says that carbon policy affects stock returns, not through a direct cost effect, but because investors start pricing in some sort of transition risk. And so to kind of discriminate from these two possibilities, we threw away from the sample all sectors that participated in the European trading scheme. And we looked at whether our results are still there once we only consider sectors which do not currently participate in the European trading scheme. So these firms don't have a direct cost in the sense that they are not paying, they don't have to pay to produce. Of course, this could still be an indirect effect, because if these firms, they buy inputs from firms that need to pay, depending on, what the, competitive price or the structure of pricing is, their cost could still go up. But as a minimum, the effect should be smaller. But when we threw away sectors that participate in the European trading scheme, we get exactly the same result. In fact, they're slightly higher. And these are the results, without the firm quarter year fixed effect, and these are the result with the firm quarter year fixed effects. Again, the results are identical. We also look at, and then I'm going to wrap up, Pietro. We also look at whether the effects, there is some asymmetry in days in which the carbon price increases and the days in which the carbon price goes down. We find a little bit of asymmetry in the sense that the effect seems to be larger when the price goes up than when it goes down. But the difference between the two things is not statistically significant. And then, this is this test for asymmetries. And then we do, a lot of robustness check. We look at placebo. We drop one country at a time. We look at only advanced Europe. In our baseline, we don't include the UK because the UK doesn't participate in the ETS. Well, it used to participate, but then there was Brexit, whatever. But, we do everything with the UK and the results are there. We do it by dropping financial institutions and the results are there. The only thing in which the results disappear, but the sample is very small, if we only include emerging Europe. So everything else is kind of there. So, well, these are my key takeaways.
Okay, very good. Thanks. Perfect timing. So, Ludwig, the discussion. You have questions or no? But maybe after the discussion. But you can. But yeah, maybe after the discussion.
I can stay there.
Yes, probably yes. So I can give you a pen.
Okay, thank you.
So how do you pronounce your surname? Chincarini. Yeah, no, that is. It
sounds,
but
it's like Beethoven.
Yes.
Yes.
Let's see.
That's because my father was doing drugs when I was born. Thank you very much. How do I flip this? Let's see how we do this.
The big thing goes forward.
Okay. Okay. Thank you very much. By the way, a little joke. Thank you, Collegio Alberto, Bank of Italy, and Uni as well for bringing me in. And I have to do marketing. It's part of my job from the publisher. Our new book is out. It's great for teaching students quant portfolio management. So please check out the new book. It's a great book. Steve Ross wrote the foreword. Do you know Steve Ross? Arbitrage pricing theory, the whole thing. So good book. Please check it out. Okay, so summary of the work. So first I should say, I don't know very much about ESG. Okay, so for the authors, Ugo, I'm an amateur. I did start a company that did ESG way back, but other than that, I don't know much about ESG. So I'll start with that. I thought also the paper was pretty well done. There's not a lot of criticism I can find. There's not a lot of added value I can give it. So I'll make random comments and then Ugo can decide to throw it away or not. So he explained pretty well what the paper's about. Events that lead to higher carbon prices lead to negative returns, and it's more for high intensity carbon using firms. Okay, and so their conclusion is carbon policies can raise cost of capital, which, by the way, I would have expected. Right, if the markets are somewhat efficient, you would expect this to happen. So I wasn't surprised. The background of the findings, what I was excited about is the data, because I didn't even know this data existed. So about all this ergentum, this carbon emission data by firm year, I thought that was nice. And then also these policy events that I believe they got from another paper. Okay, I'm going to try to skip some of the boring stuff. So their big question, again, as you already know, is can policy penalize firms in terms of cost of capital? That's the big question. Another question, I'm going to do this a few times today because I don't have a lot of things to say about their paper, bad or good. I think the paper's done well, is what if these firms can't change? So one of the big things I think about ESG is right now, everyone seems to be a sheep. It's popular to follow ESG. Everyone does it. But not a lot of people are thinking really smart about ESG. So, for example, does it make sense to penalize firms that have to do what they do? So a great example, when I started our firm, now it's 20 years ago, can you believe that? We would create these portfolios of firms that were separated by ESG. One of the things you found, I'm sure it's more advanced now, but most of the firms that were left were firms that would never damage the environment. So things like Apple computers, which now they are damaging the environment, but let's forget that. So were you really doing anything useful by separating out firms that wouldn't do it anyway? Example, a lemonade stand or a cafe place. So one has to think a little more deeper. So that's the only point. And I'll do one more of those thought experiments. We need to think about doing ESG a little better. That's all. So let's keep going to their paper. They look at these firms here, and these are some of the emissions of these firms. And obviously you see that certain firms emit a lot more. And that goes back to my thought process. If a society needs coal, and they really need coal, is it the right solution to tax them too much? Again, I'm not giving you an answer, but we need to think about that. In the US, for example, they penalized oil severely in the last few years. And oil prices went up in the US, and consumers were penalized heavily. Again, not saying that's right or wrong, but is that the right answer? Are we doing it the right way? We need to think carefully what we're doing. An example is this. If I taxed espresso in Italy, right, at a 200%, is that the right let's say espresso is bad for people. Is this the right policy? Probably Italians would revolt. But that's an example. So we need to think carefully. And it goes to here because we see companies that. So I think their work is straightforward. They did differentiate it from the other work that's popular, the Bolton and other work. So they made a slight change. My biggest comment is I would clean up the presentation of the paper. I think the way they present equations and things is non-standard. So make the paper more readable. That's my biggest comment. I would even start with an event graph somewhere in the paper. Just a typical event graph that you see in event studies, just where we can see like this beautiful graph of what's going on. And it might inspire the reader it might also get it published in a good journal. I think it would help to explain the EUA futures contracts in a footnote or somewhere. A lot of people aren't familiar with these contracts. So to explain what they are, how they work, how people trade them, I think this would help. Spend more time explaining the estimation process. It's a bit murky. So for example, they do a multiplication of the emissions times a bracket expression. For me, this could just be me. That's not the way I typically see it. I typically see the interactions already done. So a good place to look, I used to do this myself. My good friend, Steve Levitt. Do you know Steve Levitt? Freakonomics. You probably forgot about it because there's so many mistakes in the book. But yeah, there are. But he has I like his papers because he always does interaction effects really nicely, even though he gets the econometrics wrong. So we know. No one gets the joke. You know the joke, right? Okay. Well, I'll tell you the joke later. Okay. So the main equation estimated is here. This is the one I'm talking about. And I just think there's a better way to write this. That's all. And he's told you the results, but positive returns with carbon emissions on non-event days and substantial negative returns on event days. These are all the events. These are my questions, Hugo, that may be ignorant. 1 minute. Oh, gosh, I can't even tell my good stories that are coming later. Okay, 2 minutes. Let me do it. I would like to know if these event days are all positive or negative events. Even though you use prices to determine, can you interpret anyway? Do certain countries behave differently than others? Are you able to identify announcements that would affect one country versus another and hence witness some differentiation? Is there a way to get a database of events that have conflicting sources of news so that the news on that day could have gone either way? And then what does that mean for pricing? Are the results more about valuation or uncertainty? I think you said at the beginning you can't differentiate, but maybe there's a way to do that to figure out what's by the type of news, what it is. Okay, so I like the approach of the paper, would suggest they take a little more, make it more readable, event-like graph, interesting contribution to the effects. More generally, I think ESG people need to think carefully what they're doing. This has nothing to do with their paper. I think it's a bigger issue. And I'll give you my last analogy is the cell phone analogy. So cell phones are creating a generation of idiots. That's my hypothesis, okay? And so what we'd like to do is eliminate or reduce the use of cell phones by children and young people because they're basically becoming idiots. But at the same time, there's a lot of people who use cell phones for commercial use, which we think the externalities are less. So again, what policy would you put in place to reduce that? But you can't put a tax on everyone because then you would reduce the people that really aren't causing externalities. So again, the policies I think need to be thought out a little better generally in ESG. And that's it. Thank you very much. Great paper though. Thank you.
I was told that the online question comes through cell phones. So will not be prepared. No, because there are online participants.
Yeah, but these might be the commercial users. The commercial users.
No, it was okay. Okay, so before giving 1 minute, there was at least one question, so super quick.
Just wondering if you thought about the central moment of the distribution of the funds and estimating that effect panel perhaps look at the quantile panel, so estimate the quantile panel so that instead of focusing just on the central moment, you would also look at what happened in the tail of the distribution. So basically, yeah, at the extremes. It's this panel literature is relatively new, but perhaps you have thought about it, just suggestion or curiosity.
Yeah, last question, because then we need 2 minutes to.
Thank you. I was thinking some years ago, I started a specific political event in Europe, the first global climate strike, you know, Greta and the strikes. And in that paper, I found an effect on stock returns, but not on the carbon ETS market. So the question for you is, are you making an assumption that the carbon market react to political event before equity investors, or could also be the other way around?
Can I ask you, Pietro?
Yes, please.
Okay, so I'm going to be selective because you told me I have a minute.
2.
Okay, so there is a very important question that was raised by Ludwig. Who pays the cost? Now, to tell you the truth, I don't care. So you made the example of espresso. You know, cigarettes are highly taxed, and it's the right thing. And if I were, I would increase even more the taxes. So it's bad for you. It's a negative externality. I tax you. And whether the consumer pays the cost or the consumer that, I mean, you want to reduce the production of things that generate negative externality, and ideally the price is the price of the negative externality. But it's important for us because if you think that the demand for a good is inelastic, then the price, the increase in cost will be fully translated to the consumer. And in fact, if the demand is perfectly inelastic, I should see nothing in stock return, right? Well, if the demand is fully elastic, you know, the firm is gonna price. So it's important for our results, but from a policy point of view, if you know, I don't really care in a sense. But so thanks for all the comments about the presentation. So we will address this. So the events, I mean, again, we take the day in which there is a regulatory decision, and we see what happens to the carbon price of that day. So they change in the carbon prices. Sometimes it's positive, sometimes it's negative. It's our sign of the policy, right? So maybe it's a restrictive policy, but it's less restrictive than what people thought. Is that kind of the price of carbon would go down. So I haven't thought about the climate strike. That's a great thing. So again, we focus on regulatory policy. So we focus on days in which the European Commission decides something about this market. You know, there are more allowances, there are less allowances. And we follow there is a paper which has been published in the AR by Diego Kanzik. So we focus their methodology to identify these shocks, but I didn't think about this. The quantile tail distribution, actually, this is thank you. So we are planning to do exactly the opposite because we got some comments that maybe we should discard the extreme events and just look at what happens in the plus minus 1 standard deviation from the thing. And it's something that we're going to do, but we never thought to do exactly the opposite, to look at the tail, but that's a very nice suggestion. Yeah. So to do a quantile things, yeah. So we are still wanting to focus on the mean, but Martina, my co-author, her PhD thesis was on growth at risk with all this quantile regression. So we have the technology to do that.
Very good. Okay, thanks. So I guess let's move on. So the second paper by I think Fabrizio Ferriani will present, and it's Flight to Climate Safety, Local Natural Disaster and Global Portfolio Flows. So 23 minutes, 24.
Okay, so thank you everyone for being here, and also to the organizer for accepting our preparing the presentation. This is a joint work with Andrea Gazzani and Filippo Natoli, all at Bank of Italy. And before starting, please note that the usual disclaimer applies. Okay, so just to have these two introductory graphs to motivate the talk. This is evidence that I'm pretty sure almost all of us are aware of, but in principle, the number of extreme events of natural disasters, and for the rest of the talk, I will use these two terms as essentially interchangeable, is increasing. There is this upward trend in their occurrence. But there is also another aspect. They are not only more frequent, but they are also unevenly distributed across areas. So there are some areas that are more affected by this type of events. And in this paper, we start from this evidence to try to answer to 3 questions. And these 3 questions will also correspond to 3 key findings that I'm going to show you. The first question is, do international investors respond to local natural disasters? So we try to address this interlink between international portfolio flows and local natural disasters. And the answer is yes. And as we will see, they essentially respond by pulling out money from the countries that are affected by the extreme weather events. And the rationale that we propose is that there is this climate risk channel at play. I will define this, and I will try to convince you that there is this sort of climatic risk aversion by investors that is what we consider as some sort of new pull factor. And the third question is, where does this money go to when after a shock? And essentially, we will see that in line with the second question, the investors try to redirect their money towards countries that are perceived as less risky from a climatic perspective. We essentially use local projections, both in a panel and in a time series setting, and we use this, this empirical tool to interconnect these 2 variables that will be our variables, key variables in the specification. On one side, we have equity portfolio flows, and on the other side, we have this regressor that essentially identifies climate shocks at the local level, climate events at the local level. It's not a climate shock in the sense that was presented by Ugo in the previous presentation, but is essentially a local event, a local extreme weather event. Okay, the literature and the contribution, I will go very straight on this because I don't want to waste too much time, and there are a lot of details in the presentation, but essentially in the paper, essentially we build on 3 strands of the literature. The first one that relates climate events to the macrofinance literature. The second one that interlinks the impact of studies the impact of natural disasters on the economy prospects, and the third one is the one that is related to capital flows and the flight to safety literature. What we try to do here is try to build on these strands of literature and link them in this way to show that this new transmission channel that is related to climate risk perception could in a way be an amplifier of the shocks, because financial investors essentially amplify the real effect by redirecting money from one place to another one. Okay, so let me, because there are a lot of results, and I think this is the most important part of the presentation. As I said, what we use are essentially two datasets. The first one is the MDAT dataset that is the largest natural disaster dataset worldwide, and there are some conditions to be to satisfy to enter in this dataset, and essentially it registers all the main events in terms of extreme weather events. You can think about flood, earthquakes, or storm that satisfy the conditions that you see in the first line. And it provides a lot of information also related to the time, the characteristics, if there are some damages, deaths, and so on. While the second data set, that is our key dependent variables, is related to portfolio flows that are channeled via mutual funds. Of course, this is a part of the overall portfolio flows, but we will show you some robustness tests using more comprehensive data sets. But they are interesting because usually mutual funds investors are known to be quite reactive to, for instance, increase of volatility or political events and so on. And the advantage of this data set is that it has a very high frequency, it is at a high frequency, it is a weekly data set, and it also allows to study some breakdown with respect to the type of investors. We have, our time period is 2009-2019. If you're wondering why we are excluding some other periods, for instance, the COVID or the global financial crisis, the answer is simple, because we want to avoid extreme periods of extreme volatility. Length and Primiceri have a paper on this that could imply some non-linearities that are difficult to address and could muddle the identification of the channel. But this is not a problem in terms of general volatility of portfolio flows, because here we have a lot of episodes, the sovereign crisis, in Europe, the Chinese sell-off, the Brexit, the taper tantrum, and so on. And we have 39 countries. This is very important for our geographical heterogeneity. 16 are advanced economies and 23 are emerging market economies. Okay, the empirical strategy. As I said, we use the first exercise, we use a panel local projection. Our dependent variable is this one, that are portfolio flows normalized by asset under management. And our key regressor is this, that is a dummy that is equal to 1 if one specific week, because as I said, the time periodicity is weekly, is equal to 1 if one extreme weather event occurs in a specific country at time t. And of course, we include a lot of controls to take into account standard push and pull factors in the literature, country and time fixed effect for a proper identification. So the first result, this is finding number 1. So the first question was, do investors react to extreme weather events? And the answer is yes, but there is some heterogeneity. And in particular, the response is present only in emerging market economy, whereas it is essentially mute in advanced economies. These are weak, so essentially this is a 6-month period. And what you see is that in terms of magnitude, the largest impact is around almost at the 8th week, so after 2 months, and then it reverts to the mean. And now, if you're wondering if this is big or not, just to have an idea of the magnitude, we observe that there is a 0.1 percentage point decrease in terms of outflows. The average weekly outflows is this, so it's quite close to the average. But I think that in other terms of reference, it is to compare this to a monetary policy shock. We mentioned this in the paper. Here, there is not the size, but let's say that this is equivalent to, we have an exercise on this on the paper, this is equivalent to around a 5 basis point shock in the US monetary policy. It's not so small, let's say, for at least compared to a single climate event. Now, we dig a little bit more into the geographic heterogeneity, we see that there is this behavioral response of investors, and we want to see if we can explore the heterogeneity within the emerging market economies group. That is the group that is found to react to these events. And to do this, we classify firms with respect to their climate risk exposure. We use this index that is has already been adopted in the literature, that essentially builds on 45 parameters to classify countries with respect to their exposure to climate threats. We use the classification of countries with respect to the median value predetermined to our sample. And just to give you an idea, I don't know, okay, for the hyperlink, I will try to, but still, the most of the countries, the high climatic risk are in the Asian regions. We are only talking about emerging market economies. And there are also some in the Latin America regions. So now in the next exercise, we want to see, and these are the results, to see if there is some difference. And what we find is that essentially our overall results related to emerging market economies are only driven by countries that are exposed to a higher climatic threat. Because essentially, as you see, this is a little, essentially the same in terms of magnitude and dynamics with respect to their role EME group, whereas countries with emerging market economies with low climate risk don't essentially respond to the shock. This is the first key finding. But of course, you could be wondering about the fact that you are not identifying in a proper way a climate risk channel, because there could be a lot of confounding factors. And essentially, what I showed now could mix two possible channels. The first one is a direct economic impact that could have an ambiguous sign, because on one side, there are some papers that found that portfolio flows after one type of these events decrease, whereas other papers find that they increase. And the rationale is essentially that in some cases, probably these events, at least in the first case, permanently damage the economic prospects of the economy, so the investor decide to pull out their money. Whereas in the second case, probably investors find some investment opportunities, because essentially there are some reduction in the marginal return of capital is very low, so sorry, is very high after the shock, and they decide to put money in the country for reconstruction. Whereas the channel that we propose here is only based on climate risk, and it has only a negative sign, because after the shock, the investors update their belief with respect to climate risk, and they decide to reduce their exposure to the country. So to isolate this this channel, what we propose to do is to see, to look at the reaction of portfolio flows when there is an event not in the country that we are studying, but in the countries, in the neighboring countries. So in the same countries within the same region, so that the investor could say, careful, because something similar could happen also in my country. What could happen in this case? And in particular, the specification, we have two exercises. There are more in the paper, but here I'm going to show you two exercises. Is that in this case, our dummy, the one that identifies the climate events, is equal to 1 only when there is an event in the neighboring countries. So think to, for instance, to Latin America, and the case of portfolios to Argentina. This is equal to 1, for instance, not when there is a shock in Argentina, but when there is an event, for instance, in Brazil. And what we find is this. So essentially the same specification, but the dummy now is perturbed with respect to the baseline case. And we see that now the dynamics is much more persistent. and also larger in terms of magnitude. And this could, I mean, this is mainly speculation, but this could, in principle, be indicative of the fact that the direct effect, the one that has two confounding explanation, could be positive on average, because with respect to the baseline that I showed you here, the magnitude in absolute term is larger. Now, the second exercise with respect to this channel that I want to show you is the following. Okay, you could argue now that there are some trade interconnection, for instance, the case of Argentina and Brazil. They around 40% of the imports of Argentina comes from Brazil. So if I have a shock to the Brazilian economy, it is normal that I also expect a negative shock to the Argentinian economy, because essentially also in that case, the economic prospects could deteriorate. So to try to isolate also this type of interlinkages, we augmented the specification with this new term that takes into account the trade interactions between the economies. So to see if in a way this could be one potential channel of transmission different from the climate risk channel, so different from the increasing aversion of investors with respect to the climate threat. And as you can see, the main effect is mainly unchanged. Indeed, there is a small reduction in the overall magnitude, but the dynamics is essentially the same, whereas the interaction term, the one controlling for potential trade interlinkages that explain the effect is essentially muted. Now, let's go to the third finding and to the third question. So where does money go after the shock? And in particular, if investors reassess their portfolio, their investment strategies in response to the shock, there are several ways to, of course, update their investment decision. The one that we are going to explore here is again related to the climate risk channel. In particular, if investors decide to move the money from countries, emerging market economies with high climatic risk to advanced economies, and in particular, as we will see, to advanced economies that are perceived less risky from a climate perspective. We start with the advanced economies, of course, because they essentially represent the standard safe haven in the capital flow literature. But as I said, we want to twist the explanation by relying on this climate risk channel. Even in this case, I'm going to show you two exercises. There are more in the paper. And the first one is based on pooled local projection. And in this case, we have this variable that is the amount of normalized flows, portfolio flows towards advanced economies. And our key regressor is this variable that is equal to 1 if at least one event occurs in one group of emerging market economies. And the group that I'm mentioning are all high risk, either high risk emerging market economies or low risk, always from a climate perspective. And of course, we include the standard controls and the push and pull factor literature. What we find is this, that the spillover only occurs in the group of high climate risk emerging market economies. It takes some time for the spillover to develop. That is quite consistent with the fact that portfolio durations take some time, whereas the response is essentially not statistically significant in the case of emerging market economies with low climate risk. The second exercise that I want to show you that is strictly related is, okay, let's explore not only heterogeneity within the group of emerging market economies, but also with respect to the group of advanced economies. And in this case, we turn back to a panel setting, and we add two terms. The first one is an interaction between the dummy for the climate events and the climate risk exposure of advanced economies. So we want to see what happens to portfolio flows that are redirected towards economies, advanced economies, with respect to the level of climate risk. And the second one is the interaction between the dummy for the natural event and the level of non-life insurance. This is the standard metrics that is also used by the IMF to measure, if you want, how advanced economies, how an economy in general is shielded against extreme weather events. And what we find is this, that there is a negative response with respect to the climate risk and a positive one with respect to insurance. So how do you interpret this? If an event occurs in the first plot, in the left plot, if an event occurs in an emerging market economies, portfolio flows to advanced economies with high climate risk are negative. Whereas the opposite happens for advanced economies with a high level of non-life insurance premiums. So this should, in our idea, should be quite indicative of the fact that this is this channel that again redirects flows from one place to another one. And to have an idea, for instance, as you can see, United Kingdom and Canada, they can be considered as quite safe from a climate perspective because they have a very low, climate vulnerability and a high level of non-life insurance. The opposite holds, for instance, for Japan, that is one of the traditional safe haven destination in the capital flows literature, because it has, of course, a very high, yes, I will finish. They have a very high level of climate risk exposure and not a very high level of insurance coverage. We have a lot of robustness tests. Here, I only want to cite some before going to the conclusions. And in particular, there could be also a problem of taxonomy. What are climate events? What are not climate events? Because, of course, we also have earthquakes. And the results are virtually unchanged. One that was raised in several discussions, and I think it's very important, is the second one. And it is related to how a PFR is representative of portfolio flows. It is representative of a part of portfolio flows, the one related to mutual funds, but we have a robustness test also with respect to balance of payment data, portfolio flows, and also with respect to the tracker that has been developed by the OECD and in part also by the IMF, that are more comprehensive data set, but they have a quarterly or monthly frequency. We also change the climatic indicators. We use alternative specification in terms of the damages instead of the dummy that are caused by the event. We control for trade linkages and in particular for fiscal capacity. And we also provide some breakdown. For instance, what is the different response of retail versus institutional? The anticipation is that not very different across the two classes. Whereas we find that active flows, active portfolio strategies, let's say, they react more quickly to the type of event. It is probably consistent with the fact that they don't essentially have to replicate a benchmark, but they have more freedom in setting the portfolio. And the conclusion, and let's say the policy implication, this is essentially a recap. So what I try to show you is that there are some portfolio impacts of extreme climate events, and this is probably not new, but what I wanted I try to highlight is that there is this climate risk channel that could be the explanation both for the pull out of the money, but also for the direction towards advanced economies. And these, of course, have important policy implications for two reasons. The first, the two that I want to address is climate threat, as we showed at the beginning, is increasing. So this channel could be even more at play in the coming years. And also because, of course, there is a lot of debate on the fact that this type of events and the exposure to transition risk could also be included in the decision of capital requirements. So I think that this could also help to inform the debate with respect to this aspect. And I'm done.
Very good, thanks, Fabrizio. So the discussion. Michael Donadelli. Already uploaded this.
I sent this morning. No.
May I? Well, I don't know how to do it. I think they are doing it. Yeah, it's there. That's right. Please.
Okay, so thanks to the organizer, so Collegio Carlo Alberto, UniTo Torino, and Bank of Italy for the invitation. So it was a pleasure actually reading this paper, also because it's close to some of my topics. One of my topics I used to work on. Okay, so first, what I'm gonna do is first briefly, hope I'm gonna be fast, review the paper, this to be sure that I got all the points, okay? Because the paper, there are a lot of robustness checks and clinical results, it's quite long. Yeah, sure, sorry. Okay, and then I'm gonna go through my comments, okay? So, stylized fact, actually there's only one in the paper, so, but I think that you can add something, that's one of my later comments. So there is evidence of capital outflows in country hit by natural disasters in general. So starting from that, in the paper, the authors ask whether natural disasters, okay, can shape or influence the dynamics of global portfolio flows. Okay, from this perspective, this is a novel idea and worth to be investigated, okay, at the end of the day. Okay, first, data. So they got actually data of natural disaster, as the authors explained. So from the emergency event database, okay, natural disasters covered are, so we have drought, landslides, earthquakes, storm, extreme temperature, volcanic activity, flood, and wildfire. So to be natural disasters, the classification is, so 10 or more people dead, 100 or more people affected, injured, or homeless, and the declaration by the country of a state of emergency. Okay, the sample of countries included, so they rely on countries affected by at least 10 events in the period chosen by the author, 2009-2019. This boils down to have a sample of 39 countries. So 16 of them advanced and 23 emerging markets, if the math is correct. Then this has been done also to have at least one disaster per year, so to have a sizable frequency in terms of disaster, and to me this makes a lot of sense. I don't see this as a strong assumption, actually. It's quite typical also in event studies sometimes. Okay, so then the examined sample is, as I said, 2009-2019. So the motivation actually, if I got it right, is to exclude actually the great financial crisis from the sample as well as the COVID-19. Okay. Then a very nice and high frequency dataset on emerging portfolio fund research. So for APFR, weekly data on financial investor equity portfolio flows. And actually this is actually the key database of the paper, and the key variable here, of course, is net flows. Okay. Then to classify countries by their level of vulnerability to climate change or to climate change risk, they use the Notre Dame Global Adaptation Index. There are several indications composing the composite indicators. So, and they refer to this one, the propensity of predisposition of human societies to be negatively impacted by climate change. As are these to classify actually countries. Okay. So then there are other data used mainly for robustness checks. So that here, this is actually the standard local projection methodology a la Jourda 2005 used by the authors. Okay, and the key variable is the dummy variable, 1 if natural disaster occurs and 0 otherwise. Okay, plus a bunch of control. So main findings, no effect of net inflows among advanced economies. Actually, there seems to be a significant decline in net inflows only among emerging economies, significant up to 8 to 10 weeks after the shocks. And apparently this effect is mainly driven by emerging countries classified as more exposed to climate change risk according to the vulnerability index we were citing before, right? About inspecting the mechanism, actually, they rely mainly at the end of the day to a direct channel, and your direct channel actually, you interpret it as a change in belief of investor related to, okay, the propensity of a country to be more exposed to climate change, in particular when a new natural disaster events, okay. And from here, this is gonna be my comment, my main comment, second main, sorry. So the first one is about the data. So it's fine for me to restrict the sample to 2009, 2019, but why narrowing your analysis so much where you can use data going back to, I mean, not you, of course you don't have data available from, you know, for a century, but at least you can extend your sample. On the one hand, of course, you may lose some countries because you don't have all the data for emerging countries, but then you can investigate the effect of natural disasters over different eras, in particular, the most important one, the era of stock market liberalization and cross-border capital control removals among emerging markets. That would be key. And notice that from a methodological point of view, even with local projection, you can control for the crisis. This is not going to harm your result, I think. So, and as you show at the beginning, so remember that in particular, so the frequency of extreme events, these are just two of them, started, you know, to increase since mid-80s or early 70s, and depends on the type of the disaster. Okay, second comment is about actually the mechanism, the transmission mechanism, and the methodology. Okay, so your standard local projection methodology you use actually cannot control for the fact that your control variables can be directly affected as well by natural disaster. Okay, to make the long story short, is not a difficult task. You can control using the extended methodology of Jourda and co-authors, where they do control for this fact. So where you can add to the standard usual local projection, this extension here, which is accounting for the fact, okay, that the natural disaster can directly have an impact on your controls, for example, equity market indexes, volatility, as well as effects. Okay, and then you will have at the end, as reported in their paper, actually, the composition effect suggesting you whether or not your identification will be a correct one. Okay, then about actually still the methodology, maybe I'm wrong here, but why not assuming that asset under management are also changes in the aftermath of the shocks? Why using predetermined under asset under management? I do expect that they will change after the shocks as well. Okay. Then other comments. Okay. So first, it's fine to focus mainly on emerging markets, in particular on the subset with high climate risk, but why not going for all the robustness checks, including all, I mean, both group of countries, including advanced, maybe you can find interesting results also there. Okay, that's just, you know, maybe a naive comment, but it can be worth investigating. Okay, actually, when you go for the trade, so when you are controlling for trade, notice that actually you lose significance up there. So somehow trade matters. Okay, and here we go back to the story of the effect on controls, in particular effects. Okay, you control for the fact that earthquake and volcanic activity are not strictly climate-related events, but I would put this as a main result. So I would exclude these two natural disasters directly, okay? After that, first, more stylized fact in the spirit of figure 2 at the beginning as a motivation. Why not going for the quantitative ascent you can compute actually forecast error via decomposition with local projection to have actually a real number about, you know, the contribution of your shocks to equity portfolio flow, global portfolio flow dynamics. Okay, maybe an international model in the style of the microfinance literature would be awesome to add, but, you know, probably time consuming. And okay, the last comment is, would be better to discuss the literature only in section 2. Okay, not anticipating in section 1, sorry.
Okay, thank you very much. We have two questions first there. Then Hugo. Please.
One quick question about the countries which are close to each other. So you made the example of Brazil or Argentina. So if there is a disaster in Nicaragua, I can suspect that, you know, people start thinking about Honduras. But if there is a disaster in Patagonia, it's not obvious that Brazil, which is, you know, very, very far away from Patagonia. So maybe you should control for country size or something like that.
Yeah. Okay, then I have a similar question, please.
So I have one comment and one question. So I have used M.dot dataset before in my research too. So I would say that, you know, it's best not to trust it too much when you're going historically, especially before 1980s, 1970s, because as far as I know, it has been established around 1970s. And then the dates that are before that were kind of retrieved from historical resources, etc. So it may not have the same coverage as afterwards. And the second one is about this, you know, shocks that are coming from neighbors in the same region. So I was thinking about, you know, what kind of treatment effect that you're recovering from that setting. Because imagine, let's say you have a region with 5 countries, there is a shock to 2 of them, right? 2 of them got affected by a disaster and 3 of them not. So if you're using the setting, 3 countries that are not affected are becoming your treated countries, but 2 countries that got actually affected by the disaster are becoming controls, and these controls are not clean controls. You see what I mean? So looking at the differences between these 2 going forward, even with local projections, are not going to give you like clean treatment effects. So maybe best could be to drop those countries that were affected in that period from the comparison. Thanks.
Okay, yes, I have one small point on the selection criteria. So clearly you oversample large countries. I mean, Luxembourg, I mean, US will always be in your sample. Luxembourg is quite unlikely because of size, yes. So please, 3 minutes.
Thank you for support.
I think it should work.
Oh, right. Okay. So thanks for all the comments. I will only touch some of them. I really like the one suggested by Michael also to control it for the KBO extension, essentially. There, I want to touch one comment that was raised by 2 of so by the audience. The fact of using the M.dot dataset. The one possible explanation related to restricted the sample is the one that we want to try to address, as I said, the extreme volatility periods. But I take your point that we could also extend the sample and look what happens if we have a restrict version or a longer version. But another motivation was raised by the audience now, and it is especially related to the fact that there are some critiques on the reliance of the MDAT dataset if you go too far back in the time. But I mean that in principle, take into account the trade-off between extending the period and also the reliability of the dataset. That could be something that could be done. And one that they are essentially quite related is about the neighboring effect. Here we show only two exercises in the paper. There are also some exercises that try to address two main aspects. The first one is the simultaneity. As you said, the example in Nicaragua and Patagonia, it's quite difficult to say that could be related. So there is an exercise that try to address the possibility that these shocks are correlated. So, or essentially the same shock, a storm hitting two countries that are neighbors. We have a further exercise that try to address this. And I take the point of the one suggested in the second question. We have something in the robustness that looks at the number of events in the neighboring countries. Is not exactly what we were referring to, because our main exercise is on a dummy and the control with the number of events, but I would be happy to talk about this. And also, I like the comment about the composition to have an idea on the importance of the shock. And to come into your last question, yes, definitely there is the risk that the data set overrepresent the largest countries. That's for sure. And the more the risk, I think there is the certainty.
Hello, shall we start? Okay, thanks for coming back here. We are just a few minutes later. And so today I have the honor to present Professor Andrea Gazzani, which she will give a lecture on imperfect financial expectation, theory and evidence. So Professor Gazzani is an expert on financial economics. He has several publications in top journals in finance and financial economics. So I think that Professor Gazzani will enlighten us with his new frontier on this field. Okay, and Andrea, the floor is yours.
So this is going to be a talk about some new topics I've started working on, which is on studying deviation from rational expectations. And this is also based on joint work with Puya and Ali, who are at Northwestern. Okay, so let me start with some motivation. So let me tell you that in June, the new inflation numbers came out for Italy, and it turned out that inflation in Italy was 8%. If I would ask you, what do you think is inflation going to be in 2023? So Marcello, you told me that you were looking at inflation swap data. Yeah. So what do you think is inflation going to be in 2023?
A very difficult task. I think it's between 5 and 8%.
Okay, that's a very big confidence interval. Now, so if your professional forecasters at Banca Intesa and other financial institutions would agree, they say it's somewhere between 5 and 7.2%, and the mean is around 6%. Now, of course, the realized inflation is going to be perhaps somewhere in between, or perhaps it's going to be higher or lower. Now, what I want to argue in my talk is that even though sometimes we're going to overshoot and sometimes we're going to undershoot the realization, it turns out that if you look at the data, there's a systematic pattern of how people either overpredict or underpredict based on the realization. And that's going to be the topic of my talk. Okay, so first question is, why should we even care about expectation? Well, first of all, of course, households and firms should care about expectations. Why? Because it determines, for example, how much you save and how much you consume. As a company, it also matters. Why? Because it matters on the prices that you're going to set and how much you're going to produce. Now, there are policymakers in here, so there are people from the Bank of Italy. Of course, we also care about expectations because for central banks, it matters how inflation expectations feed into monetary policy if you think about the Phillips curve. Now, I'm not an expert in macro. I'm going to talk about asset pricing. So in asset pricing, it's also natural to think about expectations. And the reason are just the two Euler equations that we always have in standard asset pricing models. The first one is just the standard Euler equation, which equates the price as the expectation of the stochastic discount factor M times future cash flows. And the second one is another manifestation of UIP, uncovered interest rate parity. So that's going to be the focus of my talk today, where log exchange rates are just the sum of the two interest rate differentials between a foreign country and the local country, and my expectation today about what the exchange rate is going to be next period. But the question is now, where do these expectations come from? Now, standard models usually have a standard answer, and that's rational expectations. Okay, so rational expectations is really the bedrock of both macro and finance. And the reason for that is because rational expectations allow us to fully understand the world we live in. So a particular couple of consequences of rational expectations are the following. So first of all, if you assume that people have rational expectations, you assume that the representative or agents have knowledge about the economy's structural equation. The second manifestation is that you assume that agents know the shocks and they know the distributions of the shocks. And the third manifestation is that people are able to do Bayes' law. Okay. Now, we usually combine rational expectation together with the other second assumption, and that's full information. So what does this imply? It implies that all the data about the state of the economy is common knowledge to all participants in the economy. So together, what we have with full information and rational expectations is what people call FIRE. So that would be the full information rational expectation hypothesis, which implies that if you take my subjective or Marcello's subjective expectation about what inflation is going to be this year, it coincides with what the econometrician thinks inflation is going to be in 2023. Now, of course, rational expectation is very convenient. And why is it convenient? Because it closes the model. Okay, so once in asset pricing, we think about how to determine expectations. If we go back to the Euler equation, all I need to do is to pin down the dynamics, for example, for the stochastic discount factor, and I can think about risk premium. So many people in here have worked on that, including myself. Now, of course, there are also certain disadvantages of rational expectations. And what we want to argue in our paper is that it's a very strong assumption. In reality, we may assume, for example, that agents have constraints about the amount of complexity that they can entertain. What we want to argue is that agents have limited capacity for processing information. Just take, for example, this month, so many different things are happening. It's just very hard to process all this information. Other people have argued that it's very hard to understand what general equilibrium means. So maybe we just live in a partial equilibrium world, and it's very difficult to know what general equilibrium is. Some people like Nicola Genaioli have shown that if you look at survey data, people actually do not follow Bayes' rule. And maybe people have not a complete knowledge of the information that other people possess. So what we want to argue in this paper is that it's very natural to expect that there are deviations from FIRE. So what I want to do today in my talk is first I want to give you some empirical evidence for departures from FIRE. So I was just talking to Martin. So this is so most of my work is theory, but because I don't want to bore you with like a million of equations, I thought I should also show you some data. Then I will talk about the wilderness of non-rational expectations and what that means. And then I'm just going to show you one particular model we thought about, which is going to be about time series misspecification. Okay, so let me start with presenting you some evidence why we think that rational expectations is not a very good assumption if you look at how people behave. So the way that people have tested, so there's a whole family of ways of how we can think about deviations from FIRE, but the one I'm going to present you here is the following. So what you can do is you can look at forecast errors. Now, what does that mean? So Marcello told me that he thinks that the inflation XT in 2023 is going to be, say, 7%. What I can do then is in 2024, I can measure the inflation and I can measure the forecast error. What I want to do then is I want to see, is this forecast error predictable by inflation today? So if I told him that today inflation is 8%, did this have an impact on his forecast error? Now, on the rational expectations, what we find is that this coefficient beta H for any forecast horizon H should be equal to 0. And why is that? So the reason for that is just because of the law of iterated expectations. So what does that mean? So it's very easy to show. If you take this coefficient beta H here, so this is just the covariance between XT, which is inflation, and the forecast error if you assume that they have 0 mean. And you divide by the variance of X. Now, what is E star? E star is the true expectation, where E is just the Marcello's expectation about what inflation is going to be in H periods. Now, because of the law of iterated expectation, which has to hold on the rational expectations, I can just rewrite this as the expectation of the conditional expectation at time t. Now, what do we have here? Because xt is known at time t, I can just pull out xt. So what we end up with is the expectation of xt and the difference between the expectation of E star minus E. Now, of course, on the rational expectation, we assume that the subjective expectation, so Marcello's expectation about what inflation is going to be next period, and the econometrician's expectation have to coincide. And hence, the difference between the two has to equal 0. So what does this imply? It implies that for any family of rational expectations or deviations from rational expectations, if I regress forecast errors on any information available at time t, I should have that these coefficients are equal to 0. Okay. Now, many people have done that with macro. What I want to do here is I want to study asset prices. So what I did here is that I just looked at forecast error of interest rates. Okay, so you have a whole panel of professional forecasters who make predictions about what interest rates are going to be next period. So what I did here is that I measured the forecast error for the 3-month interest rate in the US, and I regressed that on the level of interest rates when these people were doing the prediction about what the interest rate is going to be in the future. And what do you see here? What you see here, so the red line is the estimated coefficient for different horizons. So this is in months. So this is up to 10 years. And this is the estimated coefficient together with the 95% confidence interval. So what do you see here? But clearly, these coefficients are not 0. Okay, so what do they mean? In particular, what we find is that this beta coefficient for any horizon H is negative. What this implies is that we have systematic overreaction to current realization. What does that mean? It means that in periods of high inflation, people tend to overpredict what inflation is going to be, whereas in periods of low inflation, you're going to underpredict of what inflation is going to be next period. Now, clearly, that's a deviation from rational expectation. Okay. Okay, so this was just a motivating example of why we should even be looking at these deviations from rational expectations. Now, Sims has coined this notion of the wilderness of non-rational expectations. So what is that? Well, once we deviate from rational expectations, there are many, many different explanations that we can have of why people deviate from rational expectations. Here, I'm just going to give you a list, and there are hundreds more of how people have thought of how can we explain that people overreact to information. Well, there's rational inattention, there's higher order uncertainty, level K thinking, which is exactly this fact that it's very hard to understand general equilibrium, cognitive discounting, over extrapolation, overconfident, and so on. Okay. So now, of course, each of these models are going to have different implications of how, for example, the macro should respond to expectations about future inflation. So what we want to do in our paper is we want to tame the wilderness of non-rational expectations. So what is the standard approach that people usually take when they write down these behavioral models? So for example, what people do in extrapolative expectations or diagnostic expectations is that they assume a particular model of expectation formation. Okay, so for example, if you look at the work of Nicola, you have a bad shock, which implies that my predictions are going to be worse going forward. What we want to do in our paper is we want to abstract from pinning down how exactly expectations are formed. What we want to do is something much more reduced form. What we want to argue is that let's start from the properties or time series properties of the economic fundamental and then try to back out whether overreaction or underreaction is going to be a function of the time series properties of the economic fundamental. So just to give you an idea of what we want to do in the paper is, imagine you want to characterize forecast error predictability in terms of the objective and subjective autocorrelation of, for example, the interest rate. Okay, so where does this come from? Just think of the autocorrelation as a sufficient statistic to summarize the properties of how interest rates behave. So psi star is going to be the objective autocorrelation of the interest rate at horizon H. So think of it, for example, as the autocorrelation of inflation as observed by the econometrician, and psi H is just the subjective autocorrelation of the inflation at horizon H. So that would be Marcello's inflation autocorrelation of his inflation expectation. So what we want to do is we want to run the following regression. That's exactly the same regression I just showed you 5 minutes ago. So we want to regress forecast errors about inflation on realized inflation today, and I want to measure this coefficient. Now, what I can show you, what I will show you in like a couple of minutes, is that we can characterize this regression coefficient. So how forecast errors respond to today's inflation as a function of the difference between the subjective and the objective autocorrelation coefficient. So what we want to argue in this paper is that overreaction or underreaction is endogenous to the time series properties of how people form expectation. So I do not need to come and write down a specific expectation process. I'm going to allow expectation to be endogenous depending on how the time series properties of the economic fundamentals are. So the subjective and objective autocorrelation are just summary statistics for predictability and what matters for the degree of over or under extrapolation at different horizons. So that's going to be the main point of my piece. So what I'm going to do now is going to write down a model of how agents may misperceive time series property. Okay. So the model we have in mind, yeah. So the example we have here is going to be about the univariate economic fundamental, like inflation or interest rates. However, we could extend it to a multivariate setting. It's exactly the same. Okay. So the framework we have in mind is very simple. So imagine there's going to be a sequence of payoff relevant variables which are generated by a latent n factor model. So what does that mean? Imagine you take inflation. We know that inflation is probably influenced by many different factors. Same for interest rates. Okay, so there's policy, there's many different things that affect interest rates. Now imagine this is something very complicated and has n different factors, where n just may be some random number. Now imagine, and this is going to be the only assumption I'm going to make today, everything is going to be an endogenous outcome of my model. But imagine that agents cannot entertain n factors. Agents are constrained to just entertain at most k factors, where k is going to be different from n. Agents are going to be otherwise constrained rational, and they're going to estimate the K-factor model that best fits their observations. Okay, so the one criticism that people usually have to these behavioral models is that, is it really realistic to assume that Renaissance technology is so stupid that they would misestimate the model for inflation on a continuous basis? What we want to argue is that these agents are like super sophisticated. In fact, if you just pin down the number of factors, they're going to have a very complicated optimization problem and pick the model that best fits the data. Now, of course, it's case large. So if you can entertain many, many different factors, we're going to revert back to rational expectation, but that's not the focus of our paper. The focus of our paper is going to be, what if K is really small? So if you just focus on 2, 3, 4 factors, how does this going to impact asset prices in equilibrium? So what I'm going to show you is that asset prices are just going to be, or the predictability of asset prices are just going to be a function of the true data generating process. So how Marcello perceives, for example, inflation, and the amount of complexity that Marcello can entertain. By the way, I hope you don't mind that. Okay, so what are the facts we're trying to explain? The first fact we're trying to explain are the famous Fama regressions. So what are Fama regressions? Fama regressions are in international finance where we regress currency returns. So these are changes in exchange rate minus the interest rate differential on the level of interest rate. As Fama has argued, this coefficient should be equal to 0 if there's no predictability in exchange rates according to UIP. However, what we find is that high interest rate countries usually have higher currency returns than low interest rate countries. Okay, so Australia has higher returns than Switzerland. Now, what I plot here is the estimated coefficient together with the 95% confidence intervals. And indeed, if you just take a basket of 10 currencies relative to the dollar, you see high interest rate countries have high expected returns. Now, what people have done more recently is that they have extended the horizon. Okay, so this is in months. So that means, for example, 7 years. So what you see here is this very particular pattern that it actually reverts. What that means is that it's Switzerland that has higher returns than Australia if you move out to 7, 8 year, 10 years. Okay. Now, what's the problem? I have spent 10 years of my career trying to write down risk-based explanations of why we have risk premia in currency market, bond markets, equity markets. Now, a risk-based story is not going to explain this pattern. And why is that? Well, if I want to argue that Australia is more risky than Switzerland because Australia depends on commodities, there's no way to explain why should Switzerland all of a sudden be more risky than Australia if I look at a different horizon. Okay, so the point being that risk-based stories have a very hard time explaining this type of fact. So that's the first fact we're trying to explain. And the second fact is going to go to the survey data and look at forecast error predictability regressions that I just showed you. So what we do here is that we look at the forecast error of interest rate differentials. The reason why we look at interest rate differentials is because to determine exchange rates, you have to focus on interest rate differential. So if you regress forecast errors of interest rate differentials and you regress it on the level of interest rate differentials at time t, you see this very strange pattern. First, you see overreaction if you look at short horizons, and then you see underreaction if you go at longer horizons. Okay. So what I'm going to show you is a model that tries to explain this very particular pattern of both over and under reaction at different horizons. Okay, so let me talk about the framework. So the framework we have in mind is very simple and reduced form. So it's going to be a discrete time economy with a mass of identical investors. We have an extension in our paper to heterogeneous age. There's going to be an exogenous sequence of fundamentals, XT, so think of it as dividends or interest rates or whatever your variable of interest is going to be, which is going to be generated according to a probability distribution P star. Now, if you take the standard no arbitrage condition we imply in international finance, UIP tells you that the log exchange rate, ST, should be the difference between the interest rate differential between the Eurozone and Switzerland plus the discounted value. So because we just want to focus on the behavioral channel, I'm going to make the stochastic discount factor constant. And my today's expectation of what the log exchange rate is going to be next period. E is going to be agent subjective expectation, and we're going to assume that subjective expectations and the true expectations, E star, are going to be different. Okay, so otherwise I will be back to rational expectation, and the whole, the currency return will be equal to 0. So excess returns are just going to be changes in exchange rate plus the interest rate differential. So what is the main idea we have in the paper? The main idea is going to be very simple. Imagine that P star is like some really complicated thing to think about. It's some very complicated model that explains how interest rate differentials behave over time. And what we're going to assume is that agents are going to use a simplified version of P star. They're going to fit a simpler model to P star to back out what their expectations are going to be about interest rate differential next period. So how does this look like? So imagine, so this is the most general form of how we thought about this can happen. So imagine the true world is the following model. So XT is going to be the interest rate or inflation or dividends. And this economic fundamental is going to be driven by some factors ZT, where ZT is just some n-dimensional object, okay? And we're going to assume that these factors have some armor structure. So there's going to be some autoregressive coefficient A star and some loading on the shocks B star. And what we assume is that agents neither observe nor know the underlying factors. So I have no idea what drives interest rate differentials. And they obviously also do not know what A star, B star, and C star are. So what do agents do? Agents model in their heads. It's going to look exactly the same. The reason why we do that is because we want to make sure that any deviation from rational expectations just comes from this 1 degree of freedom we're going to take. And this 1 degree of freedom is just going to be that the number of factors they have in their mind, K, is going to be lower than the truth, which is N. Okay? So if K is smaller than N, the set of models entertained by the agent does not contain the true model. This is when we end up in a misspecified world, and we have this misspecification. And A, B, and C, so the loadings on the fundamental process and the factors, are going to be an endogenous outcome of learning. So every time Marcello observes a new realization of inflation, he's going to update his model, and he's going to pick the model that best fits the data. So as I mentioned, the only exogenously specified feature is going to be K. Everything else is going to be endogenous. So this model really makes it different from like the extrapolative diagnostic expectations world, where you pin down the expectation. Here, expectations are going to be endogenous as a function of the properties of K and the properties of the fundamental process. So what agents do is that they're going to pick a low rank approximation of the true data generating process. Because my co-authors are engineers, I have to mention that this is similar to model order reduction and control theory. Okay, so now how does learning work? So now I told you how the models differ between the subjective and the objective measure. Now the last thing I have to show you is how do people learn? Well, that's very boring. What we are going to assume is that people are fully Bayesian, okay? The reason, again, why we're doing that is because we want to make sure that any misspecification we measure is just due to K being different from N. So how does Bayesian learning work? So agents are going to start with a common prior belief at an initial period T0 over full support over the set of K factor models. What you then do is that you observe a realization of inflation or interest rates. You're going to update your prior, and you're going to end up with a posterior mu t. In our setting, we're going to abstract from finite sample issues. Why? Because if you just allow people to have a very small sample of observations, it could be that deviations happen because you have a small sample issue. Okay. So as I mentioned, agents are going to be fully Bayesian. The way to think about it is that you're just going to focus on your K factors and you put 0 probability on N factor models. So the agents model is going to be an endogenous outcome of people's learning, and it's going to depend on the true data generating process and K, and it's going to be independent of other characteristics of the environment. In particular, wealth and preferences are not going to matter here. Okay, so this is completely like preference free, the model we have in mind. If K is larger than N, agents learn the true model, we're back to rational expectations, and there's going to be zero predictability. If K is smaller than N, agents are going to end up with a misspecified model of the world, and this is then when we get the predictability that's going to, and these deviations from forecast error predictability. One important thing is, as I mentioned, they're going to pick the best K-factor model that best fits the data, and no matter how much data I throw at Marcello, he's not going to update his K, okay? So K is fixed. Okay, so last thing, and then I'm going to show you the main result, and then I can show you some data, and then I'm done. So how do subjective expectations now look like? Okay, so now I told you how the model works. I told you how people learn. The last thing I need to show you before I can show you the equilibrium is subjective expectations. So how do people form expectations? So the way it works, so this is an extremely ugly slide. You don't have to understand the slide. It's very simple. So imagine that this is the truth. This is the true model. And there are many, many K-factor models which have some distance from the true model. So what agents are going to do is that they're going to pick the model which has the smallest distance to the true model. And this is what we have here. Okay, so what people do is that they're going to minimize this KL divergence. The reason why we use KL divergence is because that's what people use in information theory. So basically, KL divergence has a very natural interpretation. So what people do is that they minimize the difference between the uncertainty about the one step ahead prediction under the agents model and the one step ahead predictions under the truth. Okay, so what you do is that among all the different K-factor models that I could pick, I take the combinations of K-factors which minimizes the distance to the truth. So now I'm basically done. So what I can do now that I set up the model, I can show you how does this model, what are the implications of this model for predictability. So as I mentioned, the application we have in mind is in currency markets. So again, log exchange rates are interest rate differentials plus my subjective expectations about the exchange rate next period. On the rational expectations, the subjective and the objective expectation coincide, and there should be no predictability of exchange rate. Why? Because UIP has to hold, so there should be no extra return from holding a currency. Now, of course, that's boring. That's not what we want to focus on. So what we want to focus on is when subjective and objective expectation deviate, and what we're going to find is that we're going to see predictability in currency returns. So what are the two things I'm going to do? So I'm going to run two regressions in my model and in the data. The first regression is what I already showed you, is the FAMA regression. FAMA regresses currency returns on the level of interest rate differentials. So I'm going to focus on this beta HRX, which is just deviations from rational expectations. And I'm also going to run forecast error predictability regressions. So these are forecast error interest rate differentials, and I'm going to regress that on the level of interest rate differential. Of course, on the rational expectations for any horizon H, these should be equal to 0 because there should be no predictability. What we are going to do is that we're going to look at these deviations from rational expectations for any horizon H, and we're going to interpret this as a term structure of deviations from rational expectation. Okay, so here's the solution. Again, ugly slide, but the main point here is the following. So it turns out that if agents are constrained to a K-factor model, I can write down these regression coefficients as a function of the autocorrelation under the subjective and the objective measure. Okay, so the subjective autocorrelation, what we show in the paper, this is our main result, is going to be a function of this green stuff, U and M. Now, what are U and M? U and M are just going to be a solution of a very complicated optimization problem that the agent is going to run in his head. So what he's doing is going to pick the K-factor model which best fits the data. But the beauty of our model is that U and M are just a function of two things. It's a function of the autocorrelation of the interest rate differential and of K. There are no other variables that affect U and M. So what does that mean? It means that once you know what the autocorrelation function of the fundamental is, so once I know how persistent inflation in Italy is, and once you tell me how many factors you use to make predictions, I can tell you how big your deviations from rational expectations are going to be in the data. Okay? So I just need to do two things, and I can do it in Excel. So it turns out that we can write down these deviations, this term structure from deviations from rational expectations as a function of the autocorrelation coefficients under the objective measure, which I can just measure in Excel, and K, which is the amount of complexity that people have in their minds. Okay, so this was very ugly. I can show you theoretically that if people focus just on a one-factor model, so in finance, we have all this evidence that people actually do focus just on one-factor models. Under a one-factor model, this looks very beautiful. So deviations from rational expectations just are a function of the autocorrelation at horizon H, autocorrelation at horizon H minus 1, and the discount rate. Okay, so once you pin down these numbers, I can plot what these deviations from rational expectations look like. Okay, so now I'm done with the theory. Now I can show you some data and then I'm done. So what is the setting we have? So the fundamental in our setting is going to be interest rate differentials vis-a-vis the US. So I'm going to take 10 different countries, the Eurozone, Switzerland, Australia, whatnot, vis-a-vis the US. I'm going to calculate the interest rate differential. And I'm also going to look at log exchange rate expressed in dollars relative to the foreign currency. What I'm going to do is that I'm going to run this regression currency returns on interest rate differential. So this is the figure I already showed you. So if you measure these coefficients beta H for any horizon H and you regress it on the interest rate differential, you first get the FAMA result. High interest rate countries have high returns. And then you get the Boghetta-Van Winkle result that high interest rate countries have lower returns than low interest rate countries. And then it gets 0. Okay? So now what do we get in our model? I can now do this exact same exercise that I did in the data in our model. How? Well, I just showed you that these deviations from rational expectations are just a function of the autocorrelation function of the interest rate differential under the objective measure and the number of factors K. So all I need to do is to calculate the autocorrelation function psi star, and I can just plug in psi star for any horizon into my expression for beta Rx. Now, for a one-factor model, this is very simple. If we have a K-factor model, I need to do this numerical optimization that I showed you before. So what do we have here? What we have here is the result. Okay, so the data is the black line. The red line is what we get in the model. Now, it's important to notice, so the pattern looks very similar. I will show you why this is not as successful as we would like it to be. Now, it's important to notice that when you run a regression of currency returns on interest rate differentials, you're using information on currencies, right? However, I did not use any information on currencies. I just used the autocorrelation function of the interest rate differential. So it turns out, in order to understand how returns look like in currency market, I can actually ignore a lot of the information we have in currency market and just focus on what happens in interest rate market. What you see here is that the patterns look very similar. So you have this positive coefficient and then this negative, and then it goes to 0. Now, one thing that's not good about our model, I think we should also be honest about where the model does not work. So we're cheating, of course, because on the left-hand side, you have the empirically estimated coefficient, which is very big. And on the right-hand side, I have the coefficient as it is in our model. And what you see here is that there's like, it's only 30% that we explain of what you see in the data. Now, a referee asked, why isn't it as big as in the data? Well, of course, our model is like super stylistic. Of course, we believe that there are risk premia. So in a realistic model, the delta that I assume to be constant should probably also be time bad. Okay? Okay. So now this was for a one-factor model. Okay, so for if people are really, really stupid and only use a one-factor model, the pattern looks really as it is in the data. Now, what if I make people more and more sophisticated? What if I allow people to use higher order factor models to make predictions about the interest rate differential? And this is what we do here. So what I'm plotting here is the autocorrelation function of the interest rate differential in the data. That's the black line. And the red one is if people use a one-factor model. What you see here is that people's prediction is very different of what you see in the data. Okay, so they make big mistakes. Now, what if I allow them to use a two-factor model? And what if I allow them to use a three-factor model? Now, all of a sudden, if you use three factors, it looks very, very similar. Now, there are lots of term structure people in here. Why should it look good if we have three factors?
Should I answer?
Yes.
Yeah. I got it. It's capture levels, local and curvature.
Exactly,
yeah.
exactly. So I make you work in my
Yeah.
talk. Very good. So it captures the three factors that we all know. And indeed, what you see here, if you use three latent factors, you do a pretty good job. Now, because we have referees, they ask, what if you use 10 factors? Yeah, if you use 10 factors, you do even better. Okay. Now, what are the implications for return predictability as people get more and more sophisticated? Well, this is what we get here. So the red line is for a one-factor model where you really match the pattern that we have in the data, high excess returns, low excess returns. If people are super sophisticated, you see a zero line, so that's the blue line. So there's no predictability, okay? So returns are zero. And that's exactly what we expect, okay? So if people make big mistakes, you see return predictability. If people are very sophisticated, there's no return predictability. Okay, so last thing, so how many minutes?
Yeah, you have 10 minutes.
Okay, so last thing I want to show you is survey data. So how can we show that people actually make these mistakes? So in the paper, we have a theoretical test of how many factors people apply using survey data, because it's like very theoretical. I'm going to skip that. The last thing I'm going to show you is that evidence that we can also match the pattern in the survey data. So what we do here is, I already briefly mentioned it. So we take forecast data from consensus economics. So consensus economics is a brilliant data set that gives you expectations. There are many macroeconomic variables at different horizons. So we take the 3 months interest rate and we construct interest rate differentials and forecast errors of interest rate differentials. And we regress it on the level of interest rate differentials at time t. In the paper, we show that this coefficient should again be just a function of the autocorrelation function of the interest rate differential at different horizons. And now we can look at how this pattern looks in the data. And this is what we get. Okay, so as I mentioned, what we have in the data is first we have negative coefficient. What that means again is you overreact to today's information. If I tell you that interest rates are high, you're going to predict interest rates which tend to be too high. If interest rates are low, you tend to predict interest rates which are too low. It switches its coefficient if you go to longer horizons of, say, 7 years. And now all of a sudden we have underreaction. So if you get some information about interest rate differentials, you underreact to the information. The red line is what we get in the model. And we get exactly the same pattern in the model. So first you get some overreaction and then some underreaction. Okay? So let me again emphasize, underreaction and overreaction is not hardwired in our model. I did not make any assumptions about how expectations are exactly pinned down. They're just a function of the interest rate properties or time series properties of interest rate differentials at different horizons. Okay, so let me conclude. What I want to argue here is that, I spent 10 years of my career thinking about risk premia and how to make the stochastic discount factor more and more complicated. I think it's also good to take a step back and just start from fundamentals. And if you look at survey data, it really looks like we are not rational when we make these predictions. So these are very sophisticated people that should know how to make predictions. And it turns out that a very simple model of where you assume that people just cannot entertain all this complexity that we have already matches the data really well. So we have some follow-up work that we try to like impute like term structures of expectations without, again, like pinning down whether it should be extrapolative or diagnostic. So we just want to let the data speak and see what happens to the term structure of expectations. So thank you very much for your question.
Okay, thanks, Andrea. So can I take it to 2 or 3 questions from the floor? If you have some, yeah, there's one back there.
It's very nice paper, so I just have a comment. I just wondering, it looks like you look at some sort of autoregressive process. I was just wondering how is it possible to keep into account uncertainty? I just give you an idea of what I have in mind. If you look at an autoregressive process, think about a Garch type model, yes, Garch mean type of model. So you can rewrite a Garch mean model as an ARMA 2-1 model so that you can take uncertainty into account. I was wondering if in your context, this idea make any sense, just something like that.
So just to understand correctly, so you assume that people have some uncertainty about the parameters?
Yeah, basically inserting uncertainty, which would be the conditional volatility, into the mean equation. If it makes sense, or just an idea in your context.
So we allow for any type of ARMA process, but of course there's no uncertainty. I mean, the parameters that they pick are a function of their learning. So I mean, there's deviations from the truth anyways. You may call it uncertainty. I just call it, because of this I just call it misspecification.
Okay, thank you.
Other questions?
Yeah, thank you for the presentation. Very interesting. So the inflation, the interest rate differential is based on nominal interest rate, and then you could decompose in a real rate component and an inflation expectation. So I was wondering if you try to do that, and whether some of the prediction error depends on inflation expectations error. You know, you started with inflation, which probably is one of the driver of the dynamic that you found. Yeah.
That's a very good point. So if you run these regressions both on real or nominal interest rates, they look exactly the same. Now we use data until 2000, from 1990 to 2019. So there's not a period of high inflation. In our follow-up work, what we do is that we try to decompose bond returns into inflation and what comes from interest rate. And we have much longer data sets. So there we start from the 1980s to until now. And there I expect like inflation to have a bigger impact. But that's a very good point.
Okay, so can I add a question to myself?
Mm-hmm.
So this presentation is very, very interesting. So remember when I was young, I worked in London as a country economist for Italy. And my duty was to forecast Italian inflation. So there was at that time, it was mid-90s. There was this convergence play. So inflation was driven downwards toward the euro area average. So there was a simple AR1. But all economists in every bank forecasted inflation with an AR1. So one factor, one model, and an autoregressive component. So it was very simple. But I think so. You're adding more nuance on this implication, showing difference between different factors and the advantage and disadvantage of adding more factors to the one or three factor model. So I think so do you think that these findings can be useful also for other markets, like not just for exchange rate, for the forex market, like for bond markets or other fixed income markets?
So thanks a lot for your question. So the amazing thing is, I mean, I was a non-believer of all these things, and then I started looking at the data. even if you take a variable, which is very easy to predict, like if you take, for example, volatility, everyone in here can agree that volatility is super easy to predict. You just take yesterday's volatility. Yet when people if you look at people's expectations about what the VIX is and whatnot, you see systematic mistakes. And that to me is just like mind-blowing. So, and of course, it's much harder to look at the S&P 500 because I have no idea what the S&P 500 is going to be tomorrow. So to answer your question, I think our framework is applicable to any type of asset class. I mean, the only thing I assume is no arbitrage has to hold. So as long as no arbitrage holds, I can write down my equation for any type of asset class. And I do believe that this is true for all the asset classes. And in fact, we're looking at extension of like bond risk premium.
Other question? Oh, there is one question there.
It's just an interpretation question because there is overreaction and underreaction later. Why? So do you have a one sentence story for this pattern?
Well, in the short term, if I tell Marcello that inflation is really, really high in Italy, in the short term, he might overreact and predict inflation, which is too high. But then as time goes by, his expectation about what the inflation are going to be in the long term are going to like mean revert and underreact in the long term.
So it's a mean reversion argument.
I think it's also natural to expect that it doesn't persist. Like
I would expect it to converge.
To zero. Or to
yeah. So it's the underreaction part that is puzzling to me for the longer term. But thank you.
Okay. If there are no more questions, I would like to thank Professor Bedolin for his enlightening presentation. And so we'll pass to the next speakers. So the next presentation is by Orkun Saka, a joint paper with Professor Barry Eichengreen, and cultural stereotypes and multinational banks. So Orkun, the floor is yours. You have 25 minutes for presentation.
All right. Thank you very much, everyone, for being here, and thanks to the organizers for including the paper in the program. And after Andrea's inspiring talk, I think we are ready to talk about biases and stereotypes in the domain of banking, as in the paper. So this is a co-authored work with Barry Eichengreen, and we're going to be talking about cultural stereotypes of multinational banks. So if you look at the right side of my slides, you're seeing a kind of somewhat recent cover from The Economist magazine. I think this was the UK version, but it might also be going around in Europe too, where you see the then Prime Minister of the UK, Liz Truss, which was one of the shortest prime ministers of the country, who is kind of defending her economic policies with a kind of pizza in one hand and kind of like fork with some spaghetti on the other hand, and kind of this is referring to the type of mess that her planned budget created in the bond markets, in the financial markets at the time. But of course, the issue that we are interested here is that how it was kind of, being likened to a kind of Italian soldier. And especially I remember the reaction at the time on Twitter and other domains of my Italian colleagues of like how stereotypical this thing is. Even in the age of political correctness, we are seeing this in the cover pages of the very sophisticated magazine. So what we know about cultural stereotypes is that they're historically determined and they change very, very slowly. Even though maybe we are not mentioning or making them explicit as often as we used to because of the political correctness, but they are still there, and it's very hard to crack them, right? It's very hard to contract upon them. And one could also play the devil's advocate, right? So one could say that, well, there are stereotypes, but there's also some grain of truth in them, right? Maybe Italians are really messy in their politics. That's why, like, this cover magazine kind of referred to an Italian soldier picturing Liz Truss. And this is a very thorny issue because, how are we going to separate those two things, right? There's probably some objective truth in every stereotype, but there's also the subjective perception of the person who's observing it. So I'm going to try to come back to this issue when we're talking about the empirics in our paper. But in our paper, we're not going to look at all types of stereotypes, but we're going to kind of proxy stereotypes by looking at how one nation trusts another nation. Okay, that's going to be our proxy. Okay. Is it working? Oh. Okay. So we already know. I'm not going to be telling you a lot about how important culture is. We already know that several historical examples from papers about the traders in medieval ages of how cultural closeness mattered to them when they were trading. Even with the modern data sets, we know that cultural closeness is quite important for equity investors. Even not only across countries, even within the same country, when they're investing into different companies, they really care about, for instance, whether the CEO is sharing the same cultural heritage, whether they're speaking the same language, etc. So it seems to be important. But in this paper, what we are going to be trying to do is we are going to be looking at the cultural trust phenomenon as a proxy for stereotypes, and whether that matters for the actions, specifically for the lending decisions of the financial institutions to governments, okay? And we are going to be focusing on an ideal laboratory. Why do we think this is an ideal laboratory? Is because we're looking at the sovereign exposures of the European banks in Europe. And two factors are important here. One is that we have homogeneous regulatory treatment of government bonds, right, in terms of risk ratings. And the second thing is that we also recently have this single supervisory mechanism in Europe, which assigns, a subset of our banks in the sample to the same regulator. So that's going to kind of, delete away or erase any kind of, regulatory heterogeneity that you may think could confound our results. So it's an ideal laboratory in that sense. And we're going to be taking cultural trust measures from a Eurobarometer survey. And also on top of this, we have recently conducted our own survey to add on this measure. So that's going to come from survey measures, and we're going to merge it with the bank level data sets of sovereign exposures in Europe. And that started, I think most people are familiar here with this data set. That started with the first CEBS disclosure after the Eurozone crisis, and continued with in the form of capital exercises, stress tests, etc. EBA has been regularly publishing these data sets with a full breakdown of each bank's sovereign portfolio. Right, so it's amazing because there's no comparable data set of this sort anywhere in the world, right? And from here, we are going to be looking not only at about how different home countries of these banks trust to the target country, but we're also going to try to kind of nail down the identification issue in this context. And I'm going to come back to that, why it's important. We're going to try to fully map the branch networks of the European banks, and based on those branch networks, we are going to compute a bank-specific trust measure, okay? And for identification, we are going to use that, essentially. We are going to compare banks headquartered in the same country at the same point in time and comparing them towards the same target country. So this is going to take away many of the confounding factors that you may have in mind, especially with regards to the sovereign that they are lending to, okay? Okay, so I'm going to be short in the literature. There is a growing literature on how cultural trust matters. This has been applied initially by Guiza et al. In their seminal QJ paper looking at various cross-country flows. And then this has been applied in different contexts, including decentralization decisions of multinational banks, and also, for instance, even most lately by Pursenan in a JF paper looking at the acute analyst stock recommendations, and even those stock recommendations seem to matter depending on where the acute analyst is located, right? And there's also recent literature on the Eurozone crisis and how sovereign exposures were affected, especially the home bias phenomenon that appeared during the Eurozone crisis that I myself also contributed to. We are also kind of building upon that literature as well. So the identification issue is this. Basically, if you have a setting where you have this dyadic relationships across countries, you have home countries and target countries, right? And you have a trust measure that's going to vary across all country pairs. You can include home country fixed effects, right? Because each home country has exposures towards different countries, and you can include target country fixed effects. But the problem is that there are many types of confounders that are that are varying across country pairs, that's going to confound your regression. And I'm going to come back to this when I'm showing you the simple regressions that we have run. For instance, not only trust, but also like trade relationships, colonial relationships, speaking the same language across countries. All of these things and countless other measures can actually correlate in this kind of setting. So what we are going to try to do is that we are going to take the branch networks of the banks more seriously in this paper, and that's going to help us hopefully to create a bank-specific measure of trust. Okay, and why do we think that the branch network matters when banks are buying sovereign bonds in the sovereign bond markets? Is because of three reasons. So we have so far come up with these three different channels that where subsidiaries in other countries of a bank could actually matter when they are buying sovereign debt. So the first one is the delegation. So the subsidiaries might actually be delegated with the task or with the deciding of the actual exposures, and through that there could be a direct channel of buying sovereign debt. The second channel is about the information flows. So it could be the case that subsidiaries, through internal reports and confidential reports, they can transmit back to the headquarters certain biased information that's colored by the local cultural stereotypes. And based on that information, headquarters could make the purchases, right? Is there a question? No, okay. And the third channel is that there could be personnel flows between subsidiaries and headquarters, right? If you're an Italian bank who has branches in UK, it's possible that you are gonna start hiring some British people also for your headquarters in Italy, right? So, and I'm gonna kind of try to come back to this issue, showing evidence that there is actually, this is actually visible in our sample, that, people, the bank's branch networks actually predict what type of nationalities are represented within the bank's headquarters, okay? So these three channels are important to kind of transmit the culture or the stereotypes from the subsidiaries back to the headquarters. So when you take that more seriously, our identification strategy is going to look like this. So for instance, just look at the UK, where you have, let's say, three banks, HSBC, Lloyds, and RBS. HSBC and RBS are the multinational banks, which is going to matter in our setting. And Lloyds is the domestic one, right? It's only located in UK. While HSBC has branches in France and UK, RBS will have branches in UK and Ireland. So in our setting, this means that the RBS is going to have a mix of cultures that's coming both from Ireland and also from UK. And as opposed to that, HSBC is going to have a mix of cultures that's coming from that's coming from France and UK. So that means that actually we can compare them, even though they are located within the same country, right? This headquarters. And we can compare them towards the same target. In this case, for instance, we can compare their exposures towards Austria, which would take away any of the concerns that you might have. For instance, Austria might be in a crisis. It might have high sovereign risk, low sovereign risk. All of this will be taken into account in our setting. So just to mention briefly about the data sets. So Eurobarometer surveys have been very classic. So this shows us, the amount of survey participants in the Eurobarometer who express a lot of trust towards a certain country in Europe. And this is like 15 by 15 metrics. And we have expanded this recently to 30 by 30 with our own surveys, and I'm going to come back to. So basically, this is going to give us the main trust measure that we are employing in this data. And Eurobarometer, European Banking Authority gave us this, series of disclosures coming from 2010 all the way to 2021. And I think there are several others that I haven't included yet. So it's 11 years of data set, and in every year we see more or less 2 disclosures. That's quite useful because we see quite a big breakdown of sovereign exposures, up to 200 countries. In this one, I'm only including 30 countries. So we have various other measures that I'm not going to get into. The important thing, I think, is to look at especially the sovereign exposure variable, which is going to be our main dependent variable, which is going to give you in the country level treatment 56% as the mean, and bank level treatment 58%. That means that in our sample, when you observe a bank and a country, a target country pair, right? 56% of the time there is some positive exposure. 44% of the time there's no exposure at all, right? And we are talking about sovereign debt market, the safest asset category. This actually, just the takeaway is that this market is drastically under diversified. Okay. And this is our empirical setting for the country level treatment. So I'm going to do what the literature has done so far by using first this trust measures at the country level. Okay, and then I'm going to come back to the bank level treatment later on. This is just like an exercise to see what it would look like if we were just following the literature. Okay, so we have the country level trust bias, which is basically approximated by this initial regression. So what we do is basically we regress the country level bilateral trust onto home country fixed effects and target country fixed effects. And we use the error term from that regression as the bias, right? As I told you in the beginning of the lecture, so there could be this differentiation between, which part of it is bias and which part of it is the truth or the objective, is there a grain of truth in every bias? Well, that's what we are trying to do with this, and it's also standard in the literature. What we are trying to do is basically, if you're a country that's always trusting to everyone, we are taking away that average, generally high trust, and looking at the deviations. And if you're a country to whom nobody is trusting, then we are taking away that, average component. So maybe you are not a trustable country, but we don't care about that. We care about, if you're not trustable, but one country trusts you more than average, then we look at that, that's our bias. And then that bias variable basically is incorporated into the regression, where we have the sovereign exposure as a dummy variable first, but we have the continuous version too. For each bank located at home country H towards target country C at time T. Okay, so it's a kind of a dyadic relationship here again. Country level trust bias is going to be varying between home country and target countries, and then we have the classic fixed effects, but of course we cannot include fixed effects yet at the home country target country level.
A clarification. So it's no, put it back to the slide. So the variable country level trust bias is the error in the first equation.
Yes, it's the error term from the first equation. Exactly. So this is what we do with the first part. What you see is basically at the sorry about the small writings. At the very top, you see the country level trust bias variable, and then we do like pairwise regressions where we include each control variable to see like how they perform, one-to-one, and then we kind of do this kitchen sink regression to see like if all these factors, when we put them all in the same estimation, whether that's killing the effect of the trust bias. And what you see is basically, you can increase the number of controls, by the way, here. Like, I am aware of the fact that you can add in many more things. What we are adding is like bank branches across countries, past bank merger activity across countries, media coverage from Factiva, common language across those countries, colonial relationships, this geographical distance, common border, legal origins, etc. You can include more trade variables, etc. What seems to be the case that in general, country level trust plays out as positively and significantly, and in any of the regressions, you see that it's still significant, even though certain variables are taking away the coefficient size. Okay, and this is just kind of to show you that this is the way that literature has done it so far at the country level. And then now I'm going to show you why we take branches more seriously. As I told you, one of the channels that subsidiaries or branches of a bank can affect the headquarters decisions is through sending employees to the headquarters, right? And this is what we're going to show for a subset of the banks in our sample. We have this data set from Bank Focus, which shows the headquarters employees with their nationalities, okay? And we can see this, employees at every level, and especially we are going to focus on the higher levels, risk management committees and board of directors as such. And we are going to show you that, the branch network actually predicts where your employees are coming from, which nationalities they're coming from. And that this is going to be just a simple regression at the cross section where nationality at headquarters is a dummy variable of 1. If bank B located in home country H has an employee from target country C, okay? And then bank branches is basically whether bank B has branches in that target country C and usual fixed effects. And this is what it looks like with. In each panel, we are defining the bank branches in a different way. It doesn't change any of the results. We see this, positive prediction. So there is prediction power of the branch networks in terms of, the national composition of the employees at the bank headquarters. So this kind of gives us a bit more confidence into moving on to the bank level results. So for the bank level results, as I told you, we create this bank level trust bias, which is going to be a weighted average of where the branches of a bank is, multiplied with the country level trust bias of those locations. Okay, so it's going to be a weighted average of that. That's going to give us a bank-specific variable that's going to plug into a similar regression, but in this case, it's going to vary between banks and target countries. Of course, this gives us the chance to kind of exclude all the confounders that I included in the first regression by using home country, target country fixed effects, and we can actually, even increase this and saturate this fixed effect by interacting them with the time as well, right? So if there is any relationships across countries that's changing even over time, that doesn't matter for our setting, right? And this is what it looks like. The coefficient is similar, actually, not very different. In the first setting, we have just simple fixed effects, and then we introduce the home country, target country fixed effects in the second column. And then we include also controls in the form of bank branches from bank to the target country in different, nonlinear forms. And then at the final column is just introduced saturating this home country, target country fixed effects by interacting them by time. The coefficient is quite stable. And in terms of the economic magnitude, I told you that, this is a market that's drastically under-diversified. We're talking about, almost half of the time, no exposure at all of a bank towards a target country. And I'm talking about the largest banks in Europe, okay, which are included in the EBA disclosures. That's pretty much the criteria for being included in those disclosures to be a large bank in your country. And compared to that, this one standard deviation rise in the trust is increasing the probability of investing in a target country by 14%. So if you compare this to the unconditional mean of the dependent variable, that's a large impact, I would say. And then you can see the heterogeneity across our sample period. 5 minutes, okay. So you can see the heterogeneity across our sample period, because some of you might think that, there was a Eurozone crisis. It was all about sovereign bonds. It was all about periphery, core, etc. Maybe, that's everything that's driving our results. It doesn't seem to be the case, really. Our results are alive at the very end of the sample period as well. What you're seeing here in the middle, like gray shaded, green shaded area, is a period where EBA changes disclosure requirements. For some of the banks, it's said that if your exposure is less than 10% to a country, less than 10% of your portfolio, you don't have to disclose that country. You can put it in the others category. And that kind of disrupts our identification, as you can see it. This is the continuous version of the dependent variable, where you look at directly the nominal sovereign exposures of each bank. There again, you see that the coefficient is quite stable across the sample period, so it doesn't have anything to do with the sovereign debt crisis. And then we look at, if you're nervous about, using your own country as a bank, like using that in your data set because of the home bias phenomenon that was talked about a lot recently, we drop home country observations. The results do not change. We also drop, this is, I think, a drastic test where we are dropping all countries that the compared banks have branches. So going all the way, if you might remember, I'm not sure if I'm going to, oh, sorry. If I'm going to be able to go back there. So if you remember here, so basically we are dropping not only UK, but we are also dropping France and Ireland, which means that we are comparing HSBC and RBS towards a target country where none of the compared banks have any branches, right? That kind of cuts off any kind of linkages, direct linkages between the country and the bank. And the results are, if anything, larger really than before, as you can see. And then we use some proxies for indirect linkages through host countries. That doesn't change the result. We use an IV regression by taking some of the cultural similarity variables that are usually by sociologists, interpreted as very historically determined variables. So if you believe that that's a good instrument for, looking at the trust, we instrument the trust by using those. And again, the results are, if anything, larger. We include only Eurozone countries, currency exposures might differ. The currency exposures of the sovereign bonds might differ. So including Eurozone only is assuring us that, this has nothing to do with the currency composition, excluding all the periphery countries. And then importantly, including the SSM banks. So as a single supervisor mechanism that came into being around 2014 onwards, kind of, brought some of the banks in our sample together under one supervision. So if you're, concerned that, this heterogeneity in local supervision is a problem, these banks in the sample are all supervised by the SSM. The results do not change. And then some heterogeneity. So we divide the banks in two different ways, diversifying and non-diversifying banks into two categories, depending on the level of frequency of exposures that they had to any target country. So it seems that the results are more driven by non-diversifying banks. And if you also divide the target countries into two, like some countries like Germany, they always exist in the bank's portfolios. Some countries, let's say like Poland, do not exist that often. So if you kind of divide the countries into two in that way, it seems that the stereotypes are working more towards non-target countries. Yeah. Non-common targets, which means that when you don't have enough information, maybe when you're not very familiar with the target country, it's possible to cultural stereotypes to play a bigger role. And then role of crisis, just the nutshell, when a crisis happens, it seems that the role of the trust is actually being magnified. And then this is the last thing I'm going to show you, which is the recent data set that we have created by a survey. And then we actually compared, because we were getting a lot of questions about, how persistent are these stereotypes, because you're measuring it with the Eurobarometer, which was in 1996, which is ages ago. So is trust still the way it was? What is the persistence in there? And we just measured it in 2022 across 30 European countries. And this is kind of the correlation across two survey measures. On the left-hand side, you're seeing the new survey. On the horizontal axis, you're seeing the Eurobarometer. And you see that very high positive correlation, around 75%, which assures you that stereotypes are pretty much where they were. And using this also data set that kind of enlarges our sample, because we can include, almost double the size of our sample with this new survey of trust measures. And that also doesn't change anything, but I didn't put any of the tables here. So to conclude, we kind of try to extend this recent literature on econ finance on trust and stereotypes by extending it not only to the banking area, to the financial institutions, but also trying to propose a tighter identification strategy and showing that why that tighter identification strategy should work, kind of like microfunding it by looking at taking the branch networks of European banks more seriously. All results imply an economically substantial effect, and we think that this is likely to be inefficient. So trust, normally in theoretical terms, we don't see a reason why trust should play a role here. Of course, there are settings where bilateral trust can play a role, where if you have a one-to-one relationship, higher trust of one party could actually increase the chances of the other party paying back, right, in those one-to-one relationships. But in the sovereign debt markets, the default is rarely, partial, and it's highly unlikely that you would think that, Austria is going to default on HSBC, but not on RBS, right? So in that sense, the trust measures between those two banks mattering for their sovereign debt exposures likely to be inefficient bias in this case. We don't see any rationality. And lastly, the diversity seems to be the key, because it really matters what nationalities you have in the composition of your higher level management. And the more nationalities you represent, actually, because bias measures can take positive and negative values, the more nationalities are represented in the bank composition, then you actually your biases are actually converging towards zero. Right, so that's kind of the positive message from the paper. Thank you.
Okay, thanks, Ogun. So now the discussion of Professor Michela Altieri from Lewis University, Rome.
It's not showing up. Okay, I see it here. Okay, thanks the program manager to having me here and then to read this interesting paper. It's actually nice because I'm thinking myself to those problems on trust, especially related to economic growth. So I will be very short and summarize the paper. So the paper investigates the role of cultural biases, right, and on the sovereign exposure of banks. And they do employ this nice measure of cross-country trust, which proxy for those stereotypes. So they find that high level of trust indeed are correlated, are causing more investment, more sovereign investments. And the paper also has a lot of side results. For example, it shows that this culture propagates through the hirings of managers. Okay. Now, my comments are pretty empirical because I'm an empirical person. So first of all, about the sample, you have roughly 108 banks from 15 countries, 22 quarters. However, if you dig into the sample, you see that the panel is very unbalanced. Like Germany is really overrepresented, like yes, I don't know, many banks, while Spanish banks have 2 banks only that covers the entire quarters. UK only has 6 banks. So provided this is talking about culture stereotypes, it's important to understand how your sample composition affects the measure. And so it would be good if you can compare this your sample with some other works that use this kind of data. So that would be interesting to see any difference. And then also you don't mention this in the paper, at least not in the version I have. Is there any difference between investment bank and commercial banks? Because you have both in the sample, but you know, they have different way to invest also in the sovereign exposure. So it would be interesting to see if there are differences across those. Okay, so the empirical strategy, you expect a positive relationship between bilateral trust and sovereign exposure. There are some problems that you do not discuss in the empirical specification. I don't go through all of them, but more importantly is the point 3. You have a 0 sovereign exposure because you have 0,1 variable, but actually that means 2 things. Either you sold or your sovereign exposure debt, or you never invested it, but you never distinguish between those 2 cases. So did you try to have a multi-choice variable in which you look also at the decision to sell the bonds? Okay, so what do? You follow GISO and you compute this country level bilateral trust, and then you use to compute this bank level trust measure. Now the weights that you use, I mean, in the paper is shares in the country, branches in the network. So if I understand correctly, the weight is solely based on the number of branches. However, this is a bit weird because there are some branches that count 0 for the bank. Well, there are very important subsidiaries. If you think about, I have an example in Italy, UniCredit Poland was dragging UniCredit into very big problems, while there might be an office just of representative, doesn't really matter. So I'm wondering why you don't use the sites of the subsidiary instead to weight. Most importantly, I think there is an endogeneity issue which has to be addressed. So you do not have reverse causation, which is a good news. So it's not the sovereign exposure influence trust, but you have an omitted variable problem because you might have a third variable that explains more. And there has been huge literature discussing this, right? Because trust depends on other culture variable like religion, language, and therefore you are capturing something that might be different. So in addition, you have initial multicollinearity when using other control variable. This happens mostly in equation 1, but also in equation 3 when you use all your fixed effect. And I will be more digging into that. Now, what about endogeneity? The problem is that this country level bilateral trust is likely to be correlated with your residuals, right? So now what do you do in the paper? You run this Osted test, which is, let's say, it's a bit econometric. I'm not going into the detail, but basically you assume that this delta holds, therefore there is not endogeneity. However, there are 2 problems why this is not enough. There is a technical problem. There is a recent paper, which is from econometricians, that shows that even when the Oster delta holds, if there is an omitted variable problem, there is a very likely possibility of switching coefficients. So maybe you want to look at that and see if that applies. But more importantly, there is a theoretical issue. So is theory that is suggesting us, and there are all these papers of Laporta, Glaser, that basically discuss this. The trust is a product of other culture variables, and it's very difficult to disentangle between, I don't know, trust and religion, trust and language, trust and the quality of the institution. So I try to help, and I dig into this literature, and I found this very nice paper from American Economic Review. And the nice thing about this is that the replication package is on the website, so you can use that. What do? They instrument trust with inherited trust. Inherited trust. So, wait. So what do? They say, okay, there are two things that shape trust. One is all these cultural variables that you cannot really distinguish. And then there is something that you inherited from your parents. So they say the inherited part is not affected does not affect the current outcome. So it's very unlikely. Therefore, they run this regression and use the residual from this regression to have a coefficient for each country, which is the portion of inherited trust. And that is the instrument for your trust. And this, I think, is very nice because it can help you to have an instrumental robustness test to see if your results stay. And you can also use for the manager nationality, because you have, in your paper, you have the nationality of the manager. So you can basically allocate this inherited trust on the manager's nationality. So it might be, you can use it in several ways. Third, you have a multicollinearity issue. If you look at the correlations, it's pretty clear that all these culture variables correlate a lot. I must say, I'm not sure the equation 1 and in table 1 is helping you. I know you say that the literature does that, but it's actually a motivation not to do it. And the reason is the following. You see that there is a switch of coefficients from the univariate to the multivariate, which is quite big. And this is a huge concern, right? When you run an econometric regression like this. And even in equation 3, when you have all the fixed effect, the country level bank branches switches. And honestly, from a theoretical point of view, has little sense, the negative sign. Why should I expect that I have less exposure in a country when I have a branch? And in fact, the univariate is positive. Yeah, I'm done, I think. Now, other small comments. In the branch, so the branch, you discussed this, and you in the footnote 51. So the branch decision itself, this one is affected by trust itself. So you have another problem there. And other comments is that one thing, and maybe this was me, you said this also during the presentation, but I did not understand that. You said that you control for financial linkages by excluding country with branches. However, your branches enter into your measure of trust. So I'm not sure how those two things go together. I'm not sure how, if it's me, I did not understand. Maybe just a matter of rephrasing in the paper so that we understand better. Finally, you see that there is this bank diversification effect, but what about the bank size effect? What about few banks driving this, these effects, or the other way around? We know there is the paper of Gimbla that says that the more bank is sophisticated, the less is affected by these cultural things. But still, you want to check for those too big banks, right? Which is standard test in the literature. So very nice paper. And I think it's very important to understand the cultural mechanism, how the cultural mechanism affects the economic outcomes, and good luck with the paper.
Okay. Thanks, Michela, for your discussion. So, Orko, do you prefer to answer now or to take the question for the floor? Take questions. Okay. Some question for the floor? Okay, one question from Andrea.
So your left-hand side variable is a probability, but what you can do is that you can look at actual holdings, right? I do that. Oh, so yeah. So in the paper of Koichen and Yogo, where they look at this demand system and they look at international portfolio holdings, they find that the majority of holdings is determined by macroeconomic variables. So like 60% of all the holdings are explained by the level of interest rates and things like that. So how come this is not something that affects your results?
Or macro variables.
Sorry?
You mean macro variables are not affecting my results?
Okay. Okay. Other questions? One on the back.
Yeah, thank you. Nice paper. Just a brief question about how do you think the the quantitative easing policies of the ECB might be affecting your results, if at all, in the sense that, you know, by design, the way they were implemented with the capital key and other constraints, there was an implicit bias towards buying German bonds, which were also the relatively smaller bond market in the Eurozone. So at some point, you know, midway through your sample, about 30%, over 30% of the outstanding German bonds were already in the ECB portfolio, where only 15% or less of Italian bonds were in their portfolio. So there was a big difference in the footprint of the ECB in the different markets. Thank you.
Okay, there is one question here. No, wait for a microphone.
Thank you. And no, if it is possible to, as an extension, to have some information on the extensive margin, because if I understood correctly, it's only on the intensive, and in the last years, especially I remember during the Greek sovereign crisis, there was a lot of criticism on the exposures of banks from some nationality towards Greece, but this is something that you could generalize. And in a way, this could also change if beliefs from one country towards the target change over time. And it could be also affected, this is the second question that I would like to ask you, by let's say the cycle. I'm not sure if you control for this, but I mean, if investment opportunities, because for instance the spread, put it simply, the spread increases, is this in a way taken into account in your model, the widening of the spreads over time? And so a widening of investment opportunities rather than a cultural explanation.
Thanks. I think it's we are done with questions, so you know, Orkun can answer discussion and the 3 comments.
How much time?
5 minutes.
Okay. So first of all, thank you very much, Michela. This was a really nice, useful set of comments. I really like them, especially the ones on the country level side. There's probably a lot to do either, or to drop it all together, as you said. Maybe put it in the appendix or something, because that's actually like not the main kind of purpose of the paper. Kind of the main purpose is to kind of bring this, tighter evidence with the bank level measures rather than the country level. But yeah, there's a lot to criticize on the country level side. So I don't, maybe the way forward should be to drop it altogether. Could be. So some specific comments. So yeah, the panel is a bit unbalanced. That's correct. Yeah. So some countries, depending on, so this is not something that I created myself. I'm taking everything that EBA has ever included in those disclosures. This data has been used pretty much this way by all the researchers so far, working on Eurozone crisis, home bias phenomenon, etc. And yeah, I can try to do some balancing tests maybe to see how it's going to work, drop some countries altogether, and then see if one country is influencing the results so substantially or not. So that could be something. Binary variable for the outcome. So I think this came in a couple of times. So just to clarify again, so I didn't have the time to explain more in detail about the mechanisms that we have in mind, those 3 channels that I showed you. So the first channel, if you remember, is the one where the sovereign debt purchase decision is delegated to the branches, right? And that's the channel that actually we want to minimize, because we want to look at the decisions that are done directly by the headquarters. And for that purpose, it looks like, there's no literature on this. At least we couldn't find anything on this yet. We have some anecdotal evidence with discussions from supervisors, with my co-author discussing them directly, saying that, if it is an entry-exit decision, it's very likely to be done at the very high level for the bank, at the headquarter level. So whether or not, for instance, entering into Greek market or not, right? As opposed to, for instance, the quantity decisions. You're in the Greek market, you want to buy more or less, that can be delegated to the subsidiary. So that's the channel that we want to kind of minimize. That's why the binary, that's the emphasis. That's why the emphasis on the binary dependent variable. But otherwise, I think I showed you, at least in the graphs, when you looked at the cross-sectional changes across time, it doesn't seem to play out any different. Like if you just look at the log nominal exposures, which is the full information we have about sovereign exposures. And then omitted variable, omitted variable concerns are valid for the country level analysis. But if you look at the bank level analysis, right, most of those concerns are going to be invalid, like religion, unless you think that religion is going to change between HSBC and RBS, for instance. If you look at our, the main identification strategy that I showed you, unless you think that it's going to change for a country, for the banks of the same country at the same point in time, then it shouldn't matter that much. Inherited trust as an instrument, I'm going to look into this. This could be useful if I can find a way to kind of compute this, not at the country level for a specific bank though, right? Because since we are including all this home country, target country, fixed effects, anything that's country level is already like absorbed in the specification, right? If I can find a way to generate this inherited trust, maybe through bank manager's nationality, some sort of individual level, more micro level variation we need, then I'm going to look into that. And then some questions about macro variables not affecting all results. I guess these are again like country level macro variables. I guess I would agree with the first set of results, but with the second set of results, we are not actually saying that these are not affecting the sovereign exposures. But what we are trying to do is basically, to isolate the impact of trust. And to do that, we are trying to get rid of all of these, alternative explanations. And one way of doing that is to use this, home country, target country, fixed effect setting, which would take away any kind of, interest rate differentials, GDP growth differentials, et cetera, right? Even not only at the country level, but also like, at the interaction of the home country with the target country and with the time as well, right? If GDP is changing over time for each country, even the perception would be taken into account, right? If German people are thinking differently about Austrian growth at different time points differently, that's also taken into account, right? And then how can the regulation not affect? Again, regulation is probably affecting sovereign debt for sure. But again, similar to the previous comment, we are trying to isolate the effect of trust independent of regulation. So in this setting, if you think that regulation applies differently to the banks of the same country, then we have a problem. But otherwise, it shouldn't be a problem. You see what I mean? Like unless if the regulation that HSBC and RBS are exposed to is the same regulation, then that regulation itself cannot drive our results because our variation is coming from the comparison of HSBC and RBS, as I showed in the slides. So as far as I know, all target countries are treated similarly across Europe, right? In terms of what risk weighting they're attached to when they're being held in the bank portfolios, etc. I'm not sure what you mean by regulation. Then, like, do you mean like the supply of sovereign bonds are different? I see. So it's the ECB purchases of sovereign debt. So okay, so that's not regulation, but ECB purchases of sovereign debt. So you can take it as a kind of supply shock or demand shock at the target country level, right? So some countries are being heterogeneously affected by the purchases ECB is making at different points in time, and that should also be taken into account by the target country fixed effects, right? So it shouldn't be a problem in that sense. And again, widening of spreads we talked about. I guess these are also like spreads of the sovereign bond spreads widening across different countries differently. Again, I'm guessing like the explanation I gave may have clarified a bit, right? Like if you're using target country time fixed effects, that's you're basically comparing towards the same target, two different banks towards the same country. So if you remember the graph that I showed you, whatever is happening in Austria is unimportant in that setting, because I'm comparing HSBC and RBS exposures towards the same target. Whether that target has high or low spreads should affect both of the banks, not one of them. You see what I mean? The variation is coming from the heterogeneity across banks, not heterogeneity across different targets. Yeah. Okay, thank you.
Okay, thanks, Orkun. So I have I'd like to close this second session. So thanks, everyone. I'd like to thank everyone for being here for this second session. And now is 1:20. We have lunch now, and we reconvene here at 2:30. Okay. Thank you to all the speakers and discussants.
Sorry, just
thanks to all of you who decided to come back. And let me go straight away for the first presentation. The first presenter is Andrea Tarelli. Andrea has a joint paper with Doron Avramov, Abraham Louis, Yang Liu, and the title is Dynamic ESG Equilibrium. And I will be the discussant, so 5 minutes for you. The rest for me. No, joking. 25 and 5. Correct? 25 and 10, 5. Okay, good. Please.
Right. Thank you, Lisa, for the introduction, and thank you all for being here. It's a great pleasure to present this joint work with Doron Avramov from Reichman University, Tel Aviv, Abraham Louis from EDEC, and Yang Liu from University of Hong Kong. And what we do in this paper is developing and applying an equilibrium asset pricing model in which we account for two facts. One, that the preferences toward ESG investments, which we call ESG demand, may be time varying, and also that the ESG scores of the assets, which represent the supply side of ESG, are also dynamically time varying. So to motivate our work, here what we have is the representation of a measure of attention of the press toward ESG investing. And the way it is calculated is taking the number of articles on Factiva for each calendar year that contain keywords on sustainable investing, ESG investing, and so on, and normalizing this number by the total number of articles about investing. And as you can see, we have an increase of attention until about the year 2000. Then there is this plateau, this slight decrease until about 2012, 2013. And then we have this huge increase in attention in the last after 2015, basically. And with this value that stabilizes toward the in 2022, where we have this slight drop. So the existing literature, the existing theoretical literature about asset pricing with ESG characteristics is mostly based on static models. We have one-period models in which the mechanism is that green assets, in the presence of some agents that are ESG perceptive, they provide some non-pecuniary benefits to these perceptive agents. And so in equilibrium, this pushes up the demand for green assets, and in equilibrium, these assets are going to have lower expected returns. This is true in a static equilibrium where we have ESG preferences that do not change in time and ESG scores that are not changing. The empirical evidence on the ESG return relation is, however, mixed, and this is at least for a couple of reasons. One is that there is a large uncertainty on the ESG characteristics of firms, and this is because if we take the data from different ESG rating providers, there is a huge disagreement on the scores, even for large firms. If we take the ratings from a plethora of providers, we're going to observe probably scores that differ and by a large extent. And then another reason is that, as observed by Pastor and co-authors, tastes for ESG are dynamically time varying. And so what they observe in particular is that upon increasing climate concerns actually drive contemporaneous returns of green assets that are positively correlated with the shocks. So what we do in this paper is developing a dynamic model that is based, the baseline is the long-run risk framework by Bansal and Yaron, but in which agents derive utility not only from physical consumption, but also from, they also receive some non-pecuniary benefits from their investments. And so the portfolio ESG profile is going to provide some, to represent a second consumption good in the consumption bundle. We have time-varying preferences for ESG, so time-varying ESG demand, and same thing for the ESG scores that in the aggregate represent the ESG supply. What are the implications in brief? So what we find is that we have a negative contribution to the expected return of the convenience yield for green assets. This convenience yield is exactly represents the non-pecuniary benefits. So this is the same mechanism that we have in static models, but in a time-varying framework. So this convenience yield can be time-varying. What we find is that there is a structural positive correlation between ESG demand shocks and the returns, the contemporaneous returns of green assets. And so ESG demand represents a systematic source of risk in our framework. And this systematic source of risk is priced in the cross-section. We show that it has a positive price of risk. And this implies that green assets also deliver a positive ESG demand risk premium that adds to the negative effect of the convenience yield, so that this ESG demand risk premium can actually at least partially offset the negative effect of the convenience yield. So the model in brief, what we have is preferences in which we have Epstein-Zinn time aggregation. This is not really necessary to capture the incremental contribution of ESG, but of course it's going to be useful to match the baseline equity premium together with a long-run risk variable. And then what we have here is the bundle of consumption. So usually in Bansal and Yaron, for instance, we have only physical consumption, but here we also have this second consumption good, which is given by the product of the ESG score of the wealth portfolio, which is given by the sum of the products of the portfolio weights with the ESG scores of the assets, that is multiplied by the ESG preferences, which is what we call ESG demand. And these non-pecuniary benefits are also proportional to the amount of wealth that is invested in the wealth portfolio. So ESG scores are positive by, this is the convention that we choose, they are positive for green assets and negative for brown assets. So first result, we have the Euler equation that regulates the returns of the assets in the economy. And what is interesting is that here on the right-hand side, we don't have 1 as usual, but we have 1 minus this convenience yield. So the convenience yield is given by the product of ESG demand, delta T, and the ESG score of the asset, GNT. So in equilibrium, green assets are going to have a lower expected return due to the presence of this positive convenience yield. So then to solve for the SDF, we need to put some more structure in the economy. We define these processes which combining with the log linearization of the Euler equation allows to solve the model. So what we have is consumption growth as in the long run risk framework shows this predictable component xt, which is persistent, and this is the long run risk variable. And then concerning ESG, we have this aggregate ESG supply variable, which is a persistent mean reverting variable, and aggregate ESG demand, which is also a persistent variable. In the baseline model, we have no correlations between the innovations. Then in the extensions, we allow for also for some interdependency, but they do not really change the mechanisms at work. So in equilibrium, we solve for the SDF. We have closed form formulas for the, in particular, for the prices of risk that are associated with the 4 sources of systematic risk. And what is important is that these prices of risk are all positive, meaning that assets which returns are positively correlated with one of these sources of risk are going to have a positive risk premium contribution due to that exposure. So to price an individual asset, we assume the dynamics of this ESG score as, again, a persistent mean reverting process. And here the innovations, we allow the score of the asset to be correlated with the aggregate wealth ESG score, epsilon G, and then we have an asset specific component. And then for the dividend growth, we have the typical specification that we have in long run risk models. So we have a dependence on the of the drift on the long run risk variable. And then we allow dividend growth to be correlated with the consumption shocks with a common market component. And then we have this asset specific shock. So in equilibrium, we find that the price to dividend ratio of an asset depends, co-varies with the aggregate ESG score. And then even more importantly, it co-varies with the ESG demand variable. And it co-varies positively with the ESG demand for green assets and negatively for brown assets, meaning that prices of green assets are going to increase when ESG demand increases and vice versa for brown assets. And then we have this last dependence, which is always positive with the asset's ESG score. So when an asset becomes greener, the price is going to increase and vice versa. The unexpected return over an asset is driven by the same forces. And so here what we have is, for instance, a positive structural correlation with the ESG demand shocks when the asset is green, and the other way around when the asset is brown. And the same thing, a shock to the ESG score of an asset is going to have a positive effect on the unexpected return of the asset. Turning to the expected returns, in particular to the expected excess returns, we have several forces at work, but the most important, those that are related with ESG motives, are the effect of the convenience yield. So here we have minus the convenience yield, meaning that assets that deliver some non-pecuniary benefits, like green assets, are going to have a negative contribution from the convenience yield. So this lowers the expected return of the asset. But also we have this component that is due to the exposure to ESG demand shocks that is actually positive for green assets and negative for brown assets. And so this force is opposite, goes in the opposite direction of this of the convenience yield force, so that this actually makes the ESG expected return relation less steep than it is in a static framework. So we take the model to the data, we consider ESG scores from MSCI IVA. The sample runs from 2007 to until the end of 2022. The scores are normalized so that they range between minus 0.5 and 0.5. So 0 is the level of an ESG neutral asset. We focus on US stocks and we build evaluated portfolios for the market and for a brown, a neutral, and a green portfolios, which are obtained by sorting stocks by their ESG scores. The log linearized model can be written as a vector autoregression. And so, and since there are two variables that are unobservable, in particular the long-run risk variable and the ESG demand variable, we filter them using the Kalman filter. So these are the parameter estimates. Of course, I'm not going to comment on all of them. The only thing that is important is that here the lambdas, which are the market prices of risk, they are all positive and statistically significant. In particular, we have here the ESG demand shocks price of risk, which is positive and significant. And another interesting result is that the brown portfolio loads more on the long-run risk variable than the green portfolio, meaning that brown assets on average are more exposed to long-run risk shocks. This has implications, of course, for the equilibrium returns. So here we have the time series of the filtered ESG demand. And as you can see here, we have a trend that is decreasing until it's almost constant, a little bit decreasing until 2014. And then this variable, which is filtered from market data, is actually increasing and steeply between especially 2016 and 2022. And then we have this halt of the trend in 2022. Aggregate ESG supply, as you can see, is much more stable. And this makes sense because while ESG demand is more of a behavioral variable, it depends on investor tastes. ESG supply is actually related to the technologies that are in place, corporate governance, and these are characteristics that, of course, are more difficult to change. So here what we have is a representation of the cumulative return of a green minus brown portfolio. So the green line is the realized return. The orange line is the cumulative conditional expected return. And as you can see, this expected return is negative, and it's very different from the realized return. But if we add this delta effect would be the effect of the unexpected shocks to ESG demand that are these model implied shocks to ESG demand. What we obtain is this this other line, this purple line, which tracks quite closely the realized return. Here we have some more time series evidence. So for instance, here we have the convenience yield premium for the assets. So there is a negative contribution to the expected return for a green asset, and positive for the brown. And of course, this contribution is largely increasing in absolute value toward the end of the sample because of the higher ESG demand. Here we have a representation of the convenience yield premium, to which we add also the other risk premium contributions that are related to ESG, in particular the ESG demand risk premium. So as we can see here, this tilts a little bit the relation, so that when, for instance, when the convenience yield is small, green assets actually have a higher ESG premium than brown assets. And here we have the expected excess returns accounting also for the other risk premium. So the model allows to decompose really the returns of assets with ESG characteristics. And here we have the decomposition of into a short run consumption risk premium for the green minus brown portfolio, which is negative. We have a negative contribution also from the long run consumption risk premium. We have an ESG supply risk premium that is basically negligible. Then we have an ESG demand risk premium that is positive and significant, 22 basis points, which attenuates the contribution from the convenience yield premium, which is minus 37 basis points. So overall, summing these contributions, we obtain an expected excess return of the green minus brown portfolio of minus 1% per annum. And if we add the contribution of the given by the shocks to ESG demand, we reach, this is a positive and large contribution of about 3.5%. So we reach 2.54%, which is very close to the observed value. And how am I doing with time?
5.
Yeah, perfect. So here we, after having estimated the model, we play a little bit with it by performing some inputs response exercises. So here we're shocking the ESG demand variable delta, applying a 1 year, 1 standard deviation shock. And as you can see, there's an effect on the expected returns of the green and brown portfolios. So the expected return of the brown portfolio increases because of a higher contribution from the negative convenience yield. And the opposite for the green portfolio, which expected return lowers because it provides more non-pecuniary benefits. But if we look at the realized contemporaneous return of these portfolios, we have this huge effect that is contemporaneous to the shock that actually makes the differential return of the two portfolios of the opposite sign during the shock. And so if we accumulate the returns from the beginning of the shock, well, until the end of this time period, what we see is that the cumulative return is actually positive on average for several years, here for about 4 years. And so for 4 years, starting from the beginning of the shock, we observe actually an average positive return of this portfolio. Here we have valuation ratios, the PD ratio of the green portfolio that increases after the shock, and the opposite for the price to dividend ratio of the brown portfolio. Then we're allowing for correlations of cash flows with ESG demand, for instance. This may happen when, for instance, through a consumer channel, when there is an increase in ESG demand in the market. Consumers may also be affected. They may be purchasing more services and goods from sustainable firms and less for browns. This would have an impact on the cash flows of these firms. So if we introduce this effect, we have what we see in the dotted lines here that are a little bit small. What we see is that basically the effects of contemporaneous shocks to ESG demand are actually amplified, so that the effect of the shock can actually last for even longer than compared to the case of no correlation. And here we're doing the same thing, but allowing for a correlation between shocks to the ESG scores of the assets and the cash flows of the firm. So maybe a green firm may actually, a firm that becomes greener may actually attract more consumers in the case of a positive correlation, or maybe becoming green is costly, so the cash flows of the firm actually diminish when the firm becomes greener. In that case, we would have a negative correlation, which is what we have here in the dashed line. And so these correlations may actually change what is the effect of a shock to the ESG score of the firm. So here, during the shock, we may have actually more positive return if the correlation is positive, or even a negative return if the correlation is negative enough. Okay, so to conclude, by developing this equilibrium dynamic model, we filter a time series of ESG demand that is strongly time varying through time, and shocks to ESG demand show a positive price of risk. This has an effect on the expected return of green assets, which is lower than that of brown assets because of the convenience yield, but the presence of this risk premium may actually attenuate this negative relation. And in terms of the realized return, we see that increasing ESG demand have a structural effect on the returns of green assets, which are actually positively correlated with these shocks, and the cumulative effect of these shocks may actually last for years.
Thank you, Andrea.
Thank you.
So, if you want to stay here. Okay. So let me separate, as usual, a little bit of summary of the paper from the comments and questions. This is a discrete time multi-period asset pricing model with ESG assets, which might seem curious to you, but indeed, the models that have been very well published up to now are static models. So there is no dynamic version in the published literature in the top journals. There is a recursive utility, as you saw, which is defined on the sum of the physical and non-physical consumption, with an infinite elasticity of substitution between the two. And non-physical consumption, just to fix the ideas, is the product of three terms. What Andrea calls demand, delta, what he calls supply, G, and the investable wealth. The product of the last two in particular defines how brown or green is our savings, how much they are green or brown, okay? And I would call this delta instead an attitude, and I will explain to you why. Now, what does the model deliver? The model delivers an asset pricing formula which includes greenness, as you saw. So instead of the usual product of the SDF and the return being 1, it's diminished by the greenness. Second, it delivers market risk premia with 3 covariance components, and the covariances with respect to consumption growth, the return on aggregate wealth, and the growth of total versus physical consumption, minus convenience yield. The convenience yield was already in the static literature, and it was the only thing we had in the static literature, okay? Just, I will comment then on how relevant this is, but just to fix the ideas, before that, we had only the convenience yield. Once they have set up this basic model, what do? They add a mean reverting long-run risk of consumption growth alla Banca and Yaron. Okay, so very well known to people in finance. And they add a mean reverting specification for this, the dynamics of the supply, so how green or brown is the investable wealth, and for the demand, so this attitude delta. To obtain a lot of standard things that we have in dynamic general equilibrium asset pricing. So the actual and not only the expected returns on the price to consumption ratio, the return on wealth, the stochastic discount factor. And the nice thing is that all of these are affine and increasing in the greenness, G, in the greenness appreciation delta, so how much people like and convert greenness into consumption. This is why I call it appreciation instead of calling it demand. And they are affine and increasing in long-run risk, which again is a sort of benchmark result. Then they have the actual, not the expected price to dividend ratio. They have which are again affine and increasing in greenness appreciation. They have the actual and not only the expected return on the market, which is made out of the fixed plus a time-varying component. And the latter is positive in the long-run risk. And what they do in the previous version, they had VAR estimate on US data 91-2019, and today they have extended up to 2022 with a slightly different data set. Now, this is more or less the summary of what they have. Great. We don't have any more slides. So apparently I do not have comments. Doesn't go on. Okay, good. Thanks a lot. It's a very nice contribution and very much due, because it was sort of awful that we have a full literature in dynamic general equilibrium and asset pricing in the ESG, which is very much under the scrutiny of finance people, was sort of out of this picture. We had these very well written, but still static results, okay? Out of those, the consequences over time were sort of taken by intuition, okay? But it was not fully, they were not fully fledged. This confirms this model, which in my opinion, again, it was sort of due, and thanks for having written it and having taken the time to do that. Confirms the role of the convenience yield of the static models. So green assets expected returns must be smaller than brown, okay? But also it rationalizes the intuition of the static models. So the intuition was, and I have in mind the Pastor, Staumbach, and Taylor papers, was how come that theoretically we should observe returns on green assets which are lower than brown, and over the last decade we have seen the opposite. And so they argued it's because there have been a number of unexpected increases in demand, and the increases in demand explain why observed returns were much higher than expected ones. Okay, so the expected ones were negative and the actual ones were positive. Now, this was consistent with the static intuition, but was not in the equations. So finally, we have the result in the equations. And I also like a lot the robustness results, both in the theory and in the empirical part. Having said so, my concern is whether really G and delta, what I would like to see, I would like to see supply separated from demand. The fact that in this model, they appear in a multiplicative way is not so convincing, okay, from foundational point of view. So let me try to give you a hint on how to come out of that, because this is the natural way to model, okay? However, we know that aggregate behavior towards ESG is the result of some investors being regulated and being sort of forced to tilt their portfolios towards greenness, and some others really willing to do so because they do prefer green to brown. So for realism, what appears now, which is this delta times G, doesn't capture this separation of the population into two different types of heterogeneous investors. So I was simply asking myself, why don't you put a minimum G, at least for some investors, okay? So if you don't want to have them heterogeneous right from the beginning, but still, why don't you keep a constraint on G separated from the rest of the problem, which, by the way, would help also when you go to the data, okay? Having the possibility also in the data to separate G and delta, in my opinion, would convince much more the reader. The second thing, the second thing, let me try to be quick, is whether physical and non-physical consumption are really perfect substitutes. So this is only a matter of making the model a little bit more complicated. You put a Cobb-Douglas function instead of putting a plus in the middle, and maybe one can avoid this idea, because otherwise, how come that you might have a minimum subsistence level of consumption which is made of, say, greenness? Doesn't seem too much realistic, no? But this is a technical stuff. Some more parameters still. Last point, VAR estimates. Okay. The initial level of the ESG demand, as well as its long-run average, are estimated, while the mean reversion is not. So the mean reversion is set to 0.999999, which makes the demand a random walk, essentially. Now, I understand this fits the data very well. It's a surprisingly nice fit. Still, if we think of what happened over time, this increase in demand has been stable, okay? And is it a random walk? I would have expected a mean reversion, okay? Probably towards a level which is non-constant over time. So I understand that it's demanding from the model point of view. But at least I think one should also show the opposite case, okay? So the one in which there is no unit root, there is no random walk, and instead the process mean reverts very importantly. Why? Not, I have a sort of economic reasoning behind it, because if the mean reversion is low, the long-run variance of ESG demand is high, okay? Because it's the inverse of the parameter. And this is the intuition which very often comes out of when we look at the raw data, that this longer run variance should be high, okay? So if mean reversion is high, what happens then to the other results? So in my opinion, the robustness exercise for this paper, which the paper deserves because it's important, is to completely turn this hypothesis on delta upside down and convince people that the model works and it fits. Also, if this demand, which is unobservable, works the other way around, and that you're able to capture what happens also if instead of being a story of demand going like that and supply flat as it is now, you have the opposite. So you have the supply, which drives the results, and the demand, which is more silent. That's it. Sorry for having taken a lot of time, but the paper well deserves, and I suggest that you all read it because it's a very nice piece of literature, and I hope you will be able to publish it, even though we don't agree both on what the referees asked you to do. Do we have questions? Frank?
I have a question about you call this delta a convenience yield, but I find it a bit difficult to interpret in this setting, because I mean, traditionally in commodities market, the convenience yield is something like the benefits that you have of owning the product. I mean, if I own a house, I can live in it, right? So that's the convenience yield. Here it seems to be more like a taste parameter, some kind of taste for ESG investments, which is not exactly the same thing, right? So it goes a bit towards Lisa's comments. So shouldn't you have sort of different groups of investors with different preferences for ESG investments? Because that's an alternative way of modeling this setting.
Thank you very much. I share Elisa's opinion that it was a much needed contribution. And my question is about alternative theories that are probably observationally equivalent. Let me start from a premise. If you ask ESG people why they do ESG investing, they will tell you either because they have a preference for doing some good, or because they want to reduce their risks. Okay, so what you have observed over the past decades could be the effect of correcting some mispricing in the market. You had very risky assets that were overvalued, overbought. They had too much climate risk in them, and people started selling those assets and buying assets that have less risks over the long run. That's a plausible story. I believe your story much more, but anyway, that's something that people could say. It's a completely different story. Any idea on how to disentangle between these two stories with the data?
Andrea?
All right, so thanks a lot for the questions, and thanks a lot, Elisa, for the great discussion. So I'll go quickly through the points. So concerning your first point, well, putting a constraint on G would be great. I'm not sure it's easily solvable, the problem, but no, but I agree that it's a very good point. We go a little bit, maybe it's not totally the same thing, but in that direction. By the revised version, we have a dependence on G on delta. So there might be an endogenous effect of delta on G, and we capture that effect with a parameter, but it's not the same thing. Then for the elasticity of substitution, the point is that when you log linearize a model and since you have delta that is unobservable, you would obtain a linearized model that is observationally equivalent. So we have in the revised version the model with the non-infinite elasticity, but until the Euler equation and not going further. Otherwise, until the Euler equation, it's doable and it makes sense. For the unit root in delta, yeah, the problem is that we have this trend in the data that we have, which is growing. So if you don't fix the value of the of delta, then you obtain a positive drift, and you have a time series that explodes. So that's that was our issue. So yeah. Then for the convenience yield, well, it's just a matter of terminology. What we call with convenience yield is basically the non-pecuniary benefits that are delivered by the asset. So it's a product of delta and the score of the asset. So, but convenience yield, you can just replace the terminology with non-pecuniary benefits. So I just perceive as if the asset is giving me something more than just a financial return. I don't know if this was a question. Well, for instance, you can think the other way around. A brown asset is delivering a negative convenience yield, meaning that the investor is not happy of holding that asset. So the investor really has to receive a much higher financial compensation just to have that asset in the portfolio, because otherwise, you know, you may invest in a firearm company if the company gives you a 50% annual return, but not if it gives you just a little bit more than the market. So this is. And then concerning the last question, yeah, it's a good point. There are these two opposing views. There seems to be evidence that until now the preference channel is more explains more what we have observed in the ESG space, but for sure there is I mean, some of ESG investments are driven by hedging risks. Somehow the analysis on cash flows wants to also to explore that avenue, but the point is that even our representation may somehow be considered as a shortcut to account for some hedging of cash flow risks, in the sense that you may be representing that additional risk or a lower additional risk through this somehow to this quantity that is the convenience yield.
One quick question. So what I didn't understand, just to have an intuition, if your model can envisage a world without a brown asset. So if in the limit there's a transition to a world with just green and no brown.
Well, so do you mean in equilibrium? If well, we don't, for us, ESG scores are exogenous. So we're not finding the ESG characteristics in equilibrium in the long run. So it's not something that our model can do.
Okay. Thank you a lot, Andrea, again. And let me call straight away Marco Zanotti, who will present the second paper, Financial Intermediaries and the Demand for Duration, which is co-authored with Alberto Plazzi and Andrea Tamoni.
Yeah. Okay, so thank you everyone for being here, and thanks to the organizing committee for having our paper into the program. So the paper I'm going to present is co-authored with Alberto Plazzi and Andrea Tamoni. And in this paper, we study financial intermediaries and their demand for long-term cash flows. So we want to understand how much long-term cash flows, long-term investment, financial intermediaries seek in the equity market. So we only focus on the stock market. So I'm going to give you an introduction of the paper, so the research question, how do we study the question and what do we find? Then I'm going to take a step back, giving you a motivation for why do we need this paper, so why do we care? And then I'm going to introduce the data and the methodology we use. And finally, I'm going to show the empirical results and conclude. So the main research question we aim to answer in this paper is who is demanding, so who has preference for long-term cash flows in the stock market? So who is demanding sort of long duration stocks in the equity market? And the main reason is that we often assume in the literature that some specific investors, so predetermined investors, are always seeking long-term cash flows, are always long-term investors. So think about pension funds, for instance. We often assume that pension funds are always unconditionally long-term investors across different markets. And this might be true because they have long duration liabilities, but they can achieve this duration, this matching in duration for liabilities and assets, so investment, through different asset classes. So they can invest in fixed income, real estate, and in stock market. What we want to understand is if indeed these investors are always unconditionally long-term investors also in the stock market, which might not be the case. And then we want to study if there is a time variation in this demand for long-term cash flows in the stock market by financial intermediaries. And if there is a time variation, we want to understand what is the economic force behind this variation. So what is really driving this change in demand for long-term cash flows by financial intermediaries? So we study this question using a demand system approach, and we study the preference for duration, for equity duration, for a given subset of financial intermediaries, which are the typical intermediaries that are regarded as long-term investors. So we only study like pension funds, insurance companies, and typical long-term investors. And what do we find, which is the main takeaway of this paper, is that there is a significant time variation in the demand for long-term cash flows by financial intermediaries. So it's not really the case that they're always demanding long-term cash flows in the equity market. And what seems to be the driving force, so we cannot claim for causality at this stage of the project, we also find some positive relationship. And what we find is that there seems to be a correlation, a link between financial intermediaries' balance sheet constraint and their demand for long-term cash flows. And the idea is that when intermediaries are unconstrained, so they can invest sort of unconstrained, they demand long-term cash flows. Whereas when their balance sheet constraint is more binding, so they sort of have some binding constraint, they demand fewer long-term cash flows. So they effectively became exposed to what we call reinvestment risk. Okay, the motivation. So there has been an increasing interest in the recent years in a demand system asset pricing literature, which aims to understand what is the impact of investors' portfolio choice, so asset allocation of investors in asset prices. So this literature focuses on understanding how preference or demand for some stock-specific characteristics impact asset prices. So think about how the demand for ESG or the demand for value factors have an impact, a direct impact on prices and asset returns. On the other hand, like sort of in parallel after the global financial crisis, there's been another literature, the intermediary asset pricing literature, which basically the main finding from this literature is that financial intermediaries are not just a veil in different financial markets, but they do have an impact on asset prices. So it's not the case that financial intermediaries only intermediate between agents, but their balance sheet have an impact on asset prices. So what we want to do in this paper is to connect these two literature, to study the demand for financial intermediaries for long-term cash flows. We want to study the demand from financial intermediaries' point of view, and then understand what are the implications of balance sheet constraints. So what is the impact of balance sheet constraints in financial intermediaries' demand? So the data we use in this project are typical Chris CompuStat data with a quarterly sample from 1980 to 2022 second quarter. And for equity portfolios, so to understand, to estimate the demand system on equity positions, we use 13F data from Thomson Reuters. So these data allow us to observe equity holdings for different institutional investors. And we decide to study 4 types of financial intermediaries. So these financial intermediaries are the ones that are typically regarded as being long-term investors. So they're the ones that kind of considered as being always unconditionally demanding long-term cash flows in the equity market. So we study New York Fed primary dealers, and these are the New York Federal Reserve counterparts in monetary policy intervention. So these are the New York Fed counterparts, are a specific small subset of financial intermediaries. Then we study banks, insurance companies, and pension funds. So these are the summary statistics for portfolio holdings in equities. We have something more than 900 unique financial intermediaries over the sample, and they account for something more than 36% on average of the total market capitalization. So it looks like we're studying a relevant share of the total market. Okay, so the first goal in this paper is to have a measure, a proxy, for how much an investor is demanding long-term cash flows. And we want to do so looking at the equity portfolio, so the equity position of a given financial intermediary. So the first thing we do is to observe equity portfolios of investors, and we want to build a measure of this demand for long-term cash flows looking at the portfolios. So of course, we need in the first stage a measure of sort of timing in which a stock is paying the cash flow to investors to have this measure of intermediary-specific demand for long-term cash flows. And a natural choice we use for estimating, for having a proxy of timing in the cash flows, in the timing of the at which a given stock is paying to investors, is the equity duration measure. So we just take off the shelf the measure by Andrea Gonçalves, which is pretty similar to the typical duration measure we have in fixed income market, where of course we don't have deterministic expected payouts, so we have to rely on a model for the numerator, so the expected payouts in the future dates. And we run a bunch of validation tests to actually make sure that this duration indeed capture the timing at which different stocks are paying out to investors. We just check that long duration stocks indeed pay out more in the future, in a very far future, with respect to short duration stocks. Okay, so now we want to have this proxy for demand for long-term cash flows, and we look into the theoretical prediction of what should be, in principle, in theory, the portfolio allocation for a long-term investor. So the intertemporal CAPM prediction of the optimal portfolio for an investor with H period ahead investment horizon, with this H period being really, really long, so this is a really long-term investor, is made by 2 components. The first component is the demand for the market return. So a sort of demand for 1 period ahead expected return. And if we were to have H, so the investment horizon equal to 1, this is just the full demand, the demand for a given investor, so which is a short-term investor in this case with H equal to 1, stop here. It's just this component, and these resemble the traditional CAPM. Whereas in the intertemporal CAPM, when H is very, very large, so the investor is really long-term investor, there is a second component of demand. And this is the B term here, the second component, and this is the demand for hedging for investment risk, which is the demand for hedging for a negative shock in future investment opportunities. So if the investor is really a long-term investor, we should observe these 2 components, the demand for the market and then the demand for hedging for our investment risk. So from this optimal portfolio choice of a long-term investor, we build a demand system following Kogent and Yogo, where basically we have on the left-hand side portfolio weights which are normalized by a weight in an outside asset, which are very small stocks typically. And on the right-hand side, we have theta market equity, which is useful to pin down an investor's price elasticity. And then we have the demand for the market, which is the A component in the previous slides, and the demand for duration. So our coefficient of interest is this theta duration, and this is the B component from the previous slide. So what we are really interested in estimating is this theta duration, which is the demand for long-term cash flows of investor I. So we validate this demand system, finding that indeed this demand system capture the same amount of demand. So the unexplained demand here, the latent demand, is very similar to a demand system with 5 characteristics. And this is consistent with the finding in Gormson and Lazarus, where they find that just a single duration factor, so one factor based on a duration of cash flows, is able to subsume many different factors proposed by the cross-sectional asset pricing literature. So we find this and we test the validity of the demand system, that these results still holds also in a demand system framework. And we follow Scoggin, Richmond, and Yogo in estimating the demand. So we use an IV based on this paper, and we estimate the demand system with GMM and shrinkage estimator if we don't have a lot of holdings. So for investors with lower than 2,000 holdings. Okay, so before running in estimating our demand system, we thought about a validation test, a validation exercise to make sure that indeed the theta duration we have in the demand system is really capturing the demand for long-term cash flows. So we estimate the demand system for target date funds. Target date funds are a particular type of mutual funds where they have to specify sort of the target date, so a future date in which they're going to pay out their cash flows to all investors. So what we do is to estimate the demand systems for target date funds with fewer than 10 years time to maturity. So these are target date funds which are going to sort of expire in lower than 10 years period, which is the green bar, and we have a negative coefficient on theta duration, the demand for long-term cash flows. And we do the same thing for target date funds in the red bar with a time to maturity, so which are going to expire to pay out the cash flows to investors after 20 years. So it looks like indeed this theta duration is capturing sort of the preference for long-term or short-term cash flows. Okay, so then we study the demand for long-term cash flows across the 4 types of intermediaries we have in our sample. And the first fact that we document is that there seems to be a significant time variation in the demand for long-term cash flows for all the 4 types of intermediaries we study in the sample. So it looks like these investors are not always unconditionally long-term investors in the equity market. And moreover, we have a large heterogeneity across different institutional investors. So it looks like banks have a really different demand for long-term cash flows with respect to pension funds. Then we study what is really driving force, so what is leading this time variation in demand for long-term cash flows. And what we try to do is to relate this demand for long-term cash flows with intermediaries' equity capital. So in the green line, we plot the equity capital, so sort of the balance sheet capacity of primary dealers. And the blue line is the theta duration, so the demand for long-term cash flows of primary dealers. And there seems to be a positive and statistical correlation between these 2 lines. Then we start studying this for all the 4 types of intermediaries we have in our sample. So what we do is to regress the average demand for duration, which is the theta duration for each of the 4 types of intermediaries, on a measure of equity capital ratio, so a sort of balance sheet capacity, which is specific to each of the 4 different intermediaries. And what we find is that there seems to be a positive and significant linkage, correlation, is not causality at this stage, between balance sheet capacity and the average demand for duration for different intermediaries. So the idea here is that when the balance sheet capacity for a given intermediary is higher, so they can sort of absorb liquidity shock, they also demand long-term cash flows. Whereas on the other hand, when they have more binding financial constraint, they don't demand long-term cash flows, and they became more exposed to reinvestment risk. And the second row here, the sigma duration, is a proxy for reinvestment risk. So consistently with what we expected, we find that indeed there is a positive and significant coefficient on reinvestment risk for the demand for long-term cash flows. So it looks like that all else equal, when the reinvestment risk, so the risk of a negative shift in future investment opportunities increases, investors also demand long-term cash flows, longer-term cash flows. So we studied this same regression in a panel setting. So here we have on the left-hand side, investor-specific demand for long-term cash flow, and still is regressed on lag equity capital ratio for a given set of intermediary. And although we lose some statistical significance, we still find qualitatively similar results. So the second fact we document is that not only we have heterogeneity across different intermediaries' demand for long-term cash flows, but also within the same type of intermediary. So here is the cross-sectional standard deviation of the demand coefficient, the theta duration, for the two intermediaries here, so primary dealers and banks. And the average theta duration, so the average coefficient on demand for long-term cash flows, is this line here, 0.10. So it seems that the cross-sectional standard deviation is pretty high. So there is a huge cross-sectional variation, even within the same type of intermediary. And the last analysis we do is to sort of try to connect financial intermediaries' demand for duration to their own equity capital. So what we want to test here is that, for instance, JP Morgan demand for long-term cash flows is related to JP Morgan equity capital ratio. So what we want to do here is to match demand for duration for a given investor I to its own equity capital ratio. The thing is that data we have for equity portfolio holdings are from Thomson Reuters, whereas data we have for fundamentals, so CompuStat typical data, have two different data sources, and of course they have two different identifiers. So what we have to do here is to painfully manually match each intermediary's portfolio to its own fundamentals identifier, and we're only able to do this in a, say, satisfying way, so at least 50% of the institutional, only from 1992 to 2020 for quarter. But for this smaller sample we analyze, we find that indeed in the cross-section, regressing on the left-hand side, demand for duration for a given intermediary on a dummy equal to 1 if the intermediary has an equity capital on the top 30%. So if the intermediary is very unconstrained because they have high equity capital, higher balance sheet capacity, this dummy is positive and statistically significant even within the same manager. So even with manager fixed effect, higher investors with higher equity capital have higher demand for long-term cash flows. And this still holds controlling for the amount of reinvestment risk. Okay, so to conclude, in this paper, we study financial intermediaries' demand for long-term cash flows. The demand system is sort of micro-founded by an ICAPM framework. And what we find is that there is a significant time variation in demand for long-term cash flows. So it's not really the case that pension funds, for instance, are always unconditionally demanding long-term investment. Then we find that there is an heterogeneity across different intermediaries and also within the same type of intermediary. And then we're trying to link this heterogeneity in terms of demand for long-term cash flows to balance sheet constraints. And what it looks like is that when balance sheet constraints are more binding, so they have lower balance sheet capacity, investors demand fewer long-term cash flows. So they became effectively more exposed to what we call reinvestment risk, future negative shift in future investment opportunities. And now we're trying to study what is the channel behind this. And the main hypothesis at this stage is that there is a sort of gambling for resurrection, so that when intermediaries have more binding balance sheet constraint, this sort of gamble for resurrection, investing in short duration stocks, which are the one which provide higher expected return. But this is just speculation, and we have a lot to do. Thank you.
Thank you, Marco. And the discussant is Frank de Jong.
This working? Okay, well, thank you very much for inviting me to discuss this paper. It's good to be back here, even if it's only for one day. So I really enjoyed reading this paper. I think it's very much a work in progress. So the idea of my comments will be to see if I can help you in sort of further developing this paper. So maybe a sort of a one-page summary. Basically, you look at institutional investors who hold a large amount of equity. However, these institutional investors are different in terms of their investment horizon. For example, pension funds and insurance companies tend to have a very long investment horizon, whereas banks and financial intermediaries may have shorter investment horizons, depending a bit on the incentive systems that their asset managers have. So one sort of the basic implication that you study in this paper is that, these long-term investors might have larger allocation, might have a preference for equities with long-dated cash flows. So basically what you do is then you use the recently developed literature on demand systems for investments, demand-based asset pricing, to look at this issue. And what I thought were your main findings, quickly summarized, is that insurance companies have quite a high demand for duration relative to banks and dealers. So banks and dealers sell this duration. The results for pension funds were a bit different. I mean, you didn't find very strong results, and I'm commenting on, want to comment on that later in my discussion. So one thing I really liked was this looking at the target date funds, because that sort of points directly at the investment horizon. And there indeed you find that funds with a longer remaining horizon do have a larger demand for long duration equities than ones with a shorter horizon. And another important point is that the demand for duration fluctuates a lot over time, and you relate this to the sector's capital ratio. Okay, so my first comment is on the measure of the equity duration. So basically, equity duration is defined as it is for bonds. It's sort of the average present value weighted time to arrival of the cash flows. Now, the difference between equity and bonds is that bonds typically have a finite maturity, whereas equities have an infinite maturity. So their duration tends to be quite long. And in the literature, there are several ways to estimate equity duration. What you do is to use a method by Gonçalves that was new for me, actually. I didn't know it. What they do is they project cash flows on a set of firm characteristics, predict cash flows into the future, and from that calculate a discount rate, and implicitly there's also a cash flow duration then. One thing that I found a bit puzzling is that this measure seems to include share repurchases and new issuances. I'm not sure that is fully correct. For a bond, you would never do that, right? For a bond, you look at the one bond that has been issued, you look at the cash flows of that bond, and you ignore any new bond issues or repurchases at par, because that would be an embedded option. If the bond is repurchased at market price, it doesn't affect the duration. So this may be more a criticism of Gonçalves' method than yours, but at least what I would like to see in the paper is some kind of robustness check, whether more, say, standard methods as used by the accounting literature, Weber, and recently by some of my Tilburg colleagues, where they look at cash flow projections from more accounting-based measures and
expert expectations or analyst expectations, whether they give you the same result. Because I think the duration measure here is key, and in the literature there's sort of various methods, and it would be nice to see if they give you the same answers. Having said that, the measure that comes out, this is a time series plot. The left one is from your paper. This is like the aggregate duration series that you report. The right is Schiller's PE ratio, just downloaded from his website. These are aggregates, but in the time series sense, these two look very much the same. Or at least the big movements in these measures look very, very similar. So in some way, your measure looks a lot like a valuation ratio. This is actually not new, because Weber's measure also looks a lot like a valuation ratio. But what I would like to see is some statistics, how over time, but also in the cross-section across firms, your duration measure correlates with sort of well-known valuation ratio measures. Because that might explain why you sort of capture things, especially if it's based on accounting figures, that easily may be just a translation of a valuation measure. And there might be a bit more going on than that. That's also why I would sort of prefer to look at alternative measures of duration. Okay, good. Second point, where am I? Yeah, the demand for duration. So basically your theoretical prediction is that institutions with long investment horizons, you expect to have a higher demand for equity duration. Now, what I found missing in the paper, or maybe I didn't look very carefully, but I didn't see by investor category what the average duration of their portfolios was. Just some descriptive analysis would be, evidence would be good. Also, if you want to lengthen the duration, it's equity duration. Another way is not to have the same amount of stocks with longer duration, but also just to buy more stocks, right? You can also do that with bonds. Instead of one bond with a 10-year duration, you can buy 2 bonds with a 5-year duration. It gives you the same portfolio dollar duration. So I would also expect, by the same arguments, that pension funds and insurance companies would have a higher allocation to stocks. Now, in your data, that doesn't seem to be the case, because if I again, correct me if I'm wrong, if I look at table 2, the primary dealers and the banks seem to have larger allocation to stocks than the insurers, and in particular the pension funds, which only have 5% equity allocation according to this table. So that seems to be really weird. So either something's going on that I don't understand, or this is a typo. But please make sure that this is correct. Then, taking a little bit of a step back, I mean, in the large section of your paper is devoted to the impact of financial constraints on the demand for duration. But what I found missing a little bit in the paper is a very specific model in terms of the strategic asset allocation. Yes, you do present a sort of broad model in the ICAPM sense of a portfolio consisting of a speculative demand and a hedge demand, but your model is sort of silent of what that hedge demand looks like. And I think it's very important to understand your results is to be a bit more specific about the hedge demand. So going back to this older literature on strategic asset allocation with bonds, say Campbell and Villegas book, basically, if you're completely risk averse and you don't want any risk as a long-term investor, you buy a bond with a maturity that's equal to your investment horizon. Indexed to the price level if possible, right? So that's your risk neutral portfolio, no risk portfolio. Now, and that indeed that hedges against reinvestment risk. Similarly, what you also say that long duration equity can hedge against reinvestment risk, say changes in the risk premium of stocks. And there's a nice paper by Jessica Wachter in JFQA, also like 20 years old. What that paper predicts is that depending on your investment horizon, so the T here is the investment horizon, typically investors with a longer investment horizon would have higher allocation to stocks, but it's also state dependent. So depending on the Sharpe ratio, which is the variable on the horizontal axis here, the demand for assets varies. So if you have very high Sharpe ratios, not only you profit from a high Sharpe ratio this period, but since these Sharpe ratios are persistent, you also profit from that in subsequent periods. And the longer your investment horizon, the more you as an investor profit from that. And that argument, I think, actually goes against your findings of the financial constraints, because typically in recessions, the Sharpe ratios are very high, risk premiums are very high. So it is actually the long-term investors that would buy more long duration equity and the short-term investors that would sell it. And you find the exact opposite, right? So I mean, I'm not claiming that you're wrong, but at least this specific theory has a prediction that goes against your findings. So I think it would be nice to explore the theory, all the theories that are out there in the literature a bit more, to see which findings you support and which findings you reject. Okay, some smaller comments, and I think I'm getting out of time quickly. The outside assets you define as all stocks for which you cannot derive the measure of equity duration. And that actually seems to be a large fraction, because what I didn't tell you in this table 2 is that this W0 here is the fraction of stocks for which you cannot calculate the duration, which is much bigger than the ones for which you can calculate duration. So that is also, I think, something that you want to take a further look at. And I also think that in the setting of strategic asset allocation, it would be much more natural to take something like cash and short-term bonds as the outside asset, and equities and long-term bonds as the assets that depend on your investment horizon. So given your setting, I think I would prefer a different choice of the outside asset. And then finally, my last point, I think one of the things you might want to explore is that I think your findings could have interesting implications for asset pricing, because if you find that some institutions have a large hedge demand for long duration assets, and others are willing to sell it, like the intermediaries and the investment banks. The investment banks are probably more risk averse, so they will charge a price for selling that hedge asset, and that may actually explain the lower expected returns that you find in equilibrium for these long duration assets relative to the short duration assets. So that I think is a nice implication of your finding that could shed some light on this debate. Okay, but in summary, I think it's sort of a very nice paper, and I have some suggestions for further work.
Thank you, Frank. Just a small remark. He mentioned the Wachter calibrations to Barberis data, and those results hold even if you take any Campbell and Visera bar. So they are very robust. It's not only a matter of that data set, as you know. Are there questions from the audience? Oh, Andrea, you're welcome.
Expert on these demand-based system, but somewhere in the background there has to be a market clearing condition, right, to estimate these kind of things. But I mean, related to Frank's point, it seems that these financial intermediaries do not hold so much equity. So to me, it's a bit strange. I mean, when you say that this theta goes down, or that they dump long duration assets, where does it go? Someone has to hold it in equilibrium. The same applies to the regression that you run on the financial intermediary constraint. You say when the constraint binds, they hold less long duration assets, but where do they go? I mean, someone has to hold it in equilibrium. So that to me was a bit strange.
Some other questions from the audience? Raffaele, Corvin?
Yeah, what does explain that huge variation in the cross-sectional variation that you show in the plot? I mean, from one day to the other, I mean, from one time to the other, there is a big spike and then comes back, I mean, to a very low value. So, I mean, that's an economic mechanism there, or just questions the stability of the estimates?
Marco, do you want to respond to both Frank and the questions, please?
Yeah, if I can address very, very quickly. So I'm going to start with backwards. So for what explain the cross-sectional heterogeneity, so the first thing that can explain it is, I mean, if our theory is correct, is the cross-sectional heterogeneity also in equity capital ratio. So it might be the case. Yes, this might also be explained by a second thing, which will be banks or primary dealers, in that case, going in and out of our sample for each given quarter. So it's not really flat, the number of institutions we have for each quarter, but there might be some reshuffling of the sample of intermediaries we have. But we have to look better in this. Yeah, for sure. So concerning Andrea's concern on market clearing, so in the demand system, we don't really need market clearing at this stage when we estimate preferences, but we do need market clearing when we run counterfactual exercises. So when we run counterfactual prices, which is what we're going to do in the next stage, we also need to estimate the demand system for mutual funds, investment advisors, and all the market participants in the equity market. So there, yeah, we will definitely need to understand also demand for other agents in the market. But this stage, just estimating the demand system, we just need holdings. So with portfolio holdings, we understand how much the preference for given characteristics is changing just looking at portfolio holdings. But yeah, this is definitely needed for market clearing. And for Frank's discussion, really, thank you very much. These are really, really useful comments. And so the only one concern I want to address is about the weights. So the weights in the table are asset-specific weights. So these are the average weight for all of these stocks in the equity portfolio. So the 5% weight or 0.5% weight was the average weight in a given stock for the pension funds asset allocation. We might be more clear in the notation in the paper, yes. And regarding the outside asset, unfortunately, we cannot observe in 13F data fixed income holdings and cash or outside assets. So the best we can do is to take the assets for which we don't observe duration. And the reason for which we don't observe duration is that we don't have enough CompuStat, so fundamentals data, to estimate the duration. And these are typically small cap. And we just follow the literature saying, okay, if we cannot have a measure of equity duration for these stocks, we just pull them in a sort of outside asset, and we consider these as the outside asset weights. And thank for all the other comments. Yes, definitely we're going to have some robustness check with the duration measure following the Cho-Solomon and Sloan. And yes, we're going to run some counterfactual experiments to understand what is really the asset price implication of these findings. But thank you very much. Thanks.
Thank you, Marco. The next speaker is Stefano Ramelli, University of St. Gallen and SFI. The paper is Do Institutional Investors Stabilize Equity Markets in Crisis Periods, Evidence from COVID-19, and is co-authored with Simon Glosser, Pedro Matos, and Alexander Wagner.
Thank you. Thank you very much. Thank you to the organizer for having this paper on the program. I'm very happy to be here and enjoy the conference very much so far. Actually, a lot of my papers so far are focused on ESG and how investors react to the climate crisis. So I like a lot the paper presented today. I'm presenting now a slightly different paper on a related topic, so on how investors, particularly institutional investors, reacted to a different crisis, the COVID-19 crisis. So why these papers? So nowadays, institutional investors represent around 75% of the US equity market. So on average, institutional ownership is around 75% as of 2020 of US public equities. And we know from the extant literature that institutional ownership has a lot of beneficial properties in normal times. So for instance, institutional ownership increases price efficiency, facilitate the incorporation of fundamental news into prices, and in general can improve corporate governance. So it's a good thing having institutional ownership on board. But what about the role of institutional investors in crisis periods? Okay, so when a tail risk event occurs, when there is a crisis. So why do we care about these questions? Well, we care about this question because this is really at the basis of the corporate finance, the key corporate finance assumptions. So the typical assumption in corporate finance is that the marginal investors and institutional investors are likely to be the marginal investors are well diversified. So they follow the key message of Markowitz, okay, who passed away yesterday, I think, 1906. So this idea of diversification. So we assume that marginal investors are fully diversified, and hence we can value companies based on using as a discount rate the exposure of the company to systemic risk. Why? Because the marginal investors is well diversified. So you should only care about the exposure of a company to the market, to systemic risk. Well, does this assumption hold in reality? And in particular, does it hold when a tail risk event occurs? That is, when most companies are at risk of bankruptcy, and when most financial outcomes also for investors are basically decided. Okay, so this is the law of the so-called Pareto principle. 80% of the outcomes also for investors occur in very few vital moments, like a crisis. So we care a lot about the role of marginal investors during tail risk event. And so far, we have a little bit of tension in the literature, so mixed evidence on the role of institutional investors during tail risk events. So Chen et al. In 2019 studied the role of institutional investors after the 9/11 terrorist attack, and their message is that institutional investors lent a steady hand to the market. So they behave rationally, and they did not overreact to this event. But we also know from the asset fires sales literature that institutional investors could potentially enter the same trade at the same time and stabilize equity markets. And we have a lot of contributions on the fire sale externalities by institutional investors during the global financial crisis. Actually, I would say that most of the literature on fire sale by institutional investors is based on this key recent event, the global financial crisis. So what we do in this paper, we study the role of institutional investors during the COVID-19 crash in early 2020. And we believe that this event, this particular event, is meaningful to answer these questions. Why? Because the COVID-19 was an exogenous event that came out from outside the financial markets, while the global financial crisis is by definition endogenous to the financial markets, and hence less appropriate to study the role of institutional investors in reaction to it. Okay, so there are very good movies about the role of institutional investors during the global financial crisis and how they managed to reposition their portfolios before the general population knew about the crisis. So let me give you a glimpse of the results of this paper. First, we ask how the predetermined level of institutional ownership affected stock returns during the COVID-19 crash. And in the main analysis of the paper, we focus on US listed companies. And we show that firms with higher institutional ownership at the end of 2019 performed significantly worse during the first quarter of 2020, when we had the COVID-19 market crash. And this result is driven by two fundamental channels. Two channels of institutional fire sales. One that is similar to the channel studies in existing papers, so an increase in redemption risk of institutional investors, forcing them to liquidate part of their portfolios, okay, to respond to an increase of redemption risk. The second channel is new, or at least has been less emphasized so far, and is the simultaneous rush by institutional investors for companies with particular characteristics, in particular for companies more resilient to the COVID-19 crash, in particular from a financial point of view. I'm talking about firms with high cash holdings and low leverage. So we show that institutional investors, at the same time, they all try to reshuffle their portfolios towards these COVID-19 resilient firms, causing negative externalities on their market valuations. Next, we study how institutional investors actually changed their portfolios between the end of 2019 and the end of the first quarter of 2020. And we show that institutional investors, all type of institutional investors except hedge funds, reshuffle their portfolio by prioritizing more financially resilient companies, while hedge funds sold more indiscriminately. And we also show that retail investors acted as liquidity provider to financially fragile firms. And next, we study whether this behavior of institutional investors happen only in the first quarter of 2020 or continue also in subsequent quarters. And we show that investors continue moving into higher financially resilient companies also in the second quarter of 2020. So let me now go through these results with some more details. So I'll start with the data. So data, as I said, here we focus on Russell 3000 non-financial firms, although we have a robustness checks also looking at international firms, and we retrieve financial and accounting information from Compustat. So in particular, our main dependent variables when looking at stock returns is return over what we call the fever period, which is a very hot period going from February 24th, 2020. So basically the day after we had the outbreak of COVID-19 here in Italy through March 24th, was a Monday, so March 20, that is when the Fed intervened to calm the market and provide liquidity. So this period, we call it the fever period in a previous paper that published with Alex Wagner on the Review of Corporate Finance Studies. Information about institutional ownership comes from FactSet. So this is the institutional ownership based on 13F reports. And yes, then we also have other data points. So let me go through the first result, the stock price effect of institutional ownership. So here in these regression tables, I regress the return, cumulative return over the fever period. So this the COVID-19 crash, if you will, on a series of firm level characteristics at the end of 2019. And as you can see, we control for stuff that other paper has shown to have driven stock returns during this period. Leverage and cash, well, we have market beta, stock liquidity, profitability, and so on and so forth. We also control for the environmental and social scores, because some papers show that they were important driver of stock returns during that phase. And what we find is that stocks with higher level of institutional ownership at the end of 2019 perform significantly worse than other companies, okay? Keeping constant their other characteristics. And the effect is not only highly statistically significant, but also economically important. So a one standard deviation higher institutional ownership at the end of 2019 means 7.5% low of a standard deviation lower return during the fever period. So it seems that institutional ownership can explain quite a bit of the variation of stock returns during this extreme market movement at the end of 2020. Next, we try to investigate the heterogeneity of this effect based on the heterogeneity of the institutional ownership. And we find that there is indeed quite a lot of differences in terms of institutional investor characteristics. We find that the effect is more negative for more active institutional ownership, confirming that this stock price effect seems to be driven by active decisions, acting behavior of institutional investors, while passive investors were associated with a higher stock market performance. So this also speaks to the debate of whether passive or active investors can stabilize the markets. Our result here show that during tail risk event, passive investors may paradoxically help to stabilize the market and not the opposite. The effect is also stronger for shorter term institutional investors. So institutional investor with a shorter term investment horizon, and here we use their portfolio turnover as a proxy to define them as short terms of long term, had a more negative effect on stock returns. And also the effect seems to be stronger for more domestic US-based institutional investors, while foreign investors, it seems they had a more stabilizing force on stock returns. So here in this graph, so this graph on the left-hand side, I just summarize graphically the result in the previous slides. And here I plot the evolution of the effect of institutional ownership on the cumulative return from the beginning of 2020 through each day. And as you can see, before the fever period, institutional ownership, the level of institutional ownership had basically no effect on stock returns, but it started having a quite negative and economically important effect towards the end of the fever period. So right before the Fed intervened to calm investors, in particular institutional investors. Importantly, well, you may argue, well, maybe institutional investors were pre-positioned to the COVID-19 pandemic. So institutional ownership was higher exactly for firms that were less exposed to COVID-19. Okay, this does not seem to be a case. So here we have a binary scatter plot showing that the predetermined level of institutional ownership is basically uncorrelated with changes in firms' fundamentals during the fever period, where here we use changes in analyst forecasts as a proxy for changes in firms' fundamentals during the COVID-19 period. So next, you may wonder, what is the effect of institutional ownership in normal times? Whether this result that we have is something special, as we claim, or just a features of the cross-section of stock returns. So here I show in a binary scatter plot that on average, the historical relation between institutional ownership and return is not negative, indeed is positive. And this is in line with existing literature. And here in this other graph, we run around 1,000 cross-sectional regression of weekly return on firm characteristics and also the predetermined level of institutional ownership, okay, just to show what is the effect of institutional ownership in normal times. And as you can see, over the 20 years period from the beginning of 2000 through the end of 2010, institutional ownership had a strong negative effect on stock prices only in two other cases. In January 2001, the so-called the burst of the dot-com bubble, and in October 28, so the global financial crisis. So it seems that what we're capturing here is something that is peculiar to crisis periods, so the occurrence of tail risk event. And I would add, of these three events, the only event that is exogenous to institutional investor trade is the COVID-19 crisis. The other crises were partially caused by also institutional investors themselves. So what are the channels of these results? So why does institutional ownership why did institutional ownership cause a more negative stock market reactions? Well, here we find evidence for two drivers of institutional fire sales. The first driver is the classical driver of fire sales, so an increase in redemption risk urging institutions to exit the equity market, hence causing a negative externalities on stock prices. And we show the existence of this effect using two proxies of redemption risk. So low flows in global financial crisis IO is the percentage of institutional ownership had by investors who experience very high outflows during the global financial crisis, hence likely to experience high outflows also during the COVID-19 crisis. And the second proxy is where we look at actually at the outflows during the first quarter of 2020. And as you can see here, it seems that these investors, so these investors were associated with higher drop in stock returns. The second channels that we identify is the portfolio rebalancing of institutional investors all at the same time, so all in the same weeks, towards firms that were considered more financially resilient, so more ready to face a period of low cash flows and potentially difficult access to external capital. And here we build these two proxies of institutional ownership risk exposure. So high leverage IO is the percentage of institutional ownership had by investors with a very high exposure to high leverage firms. Okay, and low cash IO is the percent of institutional ownership of investors with high exposure to low liquidity, low cash firms. Okay, so it seems that firms held more by investors highly exposed to high leverage companies perform worse, and firms with a lot of investors exposed to firms with low cash also perform worse. So this seems to serve to confirm that this stock price effect on institutional ownership seems to be driven by these two different channels. So what we do next, we study the actual change in institutional ownership, okay, between the end of 2019 through the end of the first quarter of 2020. Here, I just show just plot the distribution of Delta IO 2020 Q1, so the change in institutional ownership at the firm level during the first quarter of 2020 against the distribution of Delta IO during the last quarter of 2019. But I could have plotted also the distribution of Delta IO during any other quarter in 2019, 2018. And as you can see in the first quarter of 2020, the distribution of the changes of institutional ownership at the firm level is skewed to the right, suggesting that on average, institutional investors exited from the average companies during the first quarter of 2020. And yes, perfect. And what we do next is we regress this Delta IO at the firm level on various firm characteristics as a way to uncover which type of firms institutional investors prioritize during the COVID-19 crash. Okay, so in the paper, we have a regression table. Here, I just have a graph, and we find that institutional investors prioritize companies with higher financial resilience, in particular, prioritize companies with low leverage and high cash. Okay, and these results hold for all type of institutional investors except for hedge funds that sold indiscriminately. So they did not try to discriminate between more financially resilient or less financial resilience. They just exited from the equity market indiscriminately. I don't have here the results, but since most of you are interested on ESG, we do not find that institutional investors during the COVID-19 crash prioritize high ESG stocks. So if there is a positive effect on stock prices, must be driven by something else, not the role of institutional investors. So to link to the nice discussion on the previous paper by Marco, Frank, and Andrea, so if institutional investors exited from certain type of companies, like low financial resilient companies, someone must have taken the opposite side of the trade. And usually in the literature, for instance, also in the Cohen-Yoto approach, one minus institutional ownership is defined as households. So the market always clear because everything that is not institutional ownership is considered to be households who provide liquidity. We could have done the same in this paper and simply saying, the other side of the trade were retail investors, one minus IO by definition. We want to provide some additional piece of evidence on that. So we look at the trade of retail investors on Robin track, so Robinhood Trader, and we find that Changes in retail investor popularity correlates negatively with change in institutional ownership. In other words, we find that retail investors, here proxy by Robinhood attention, provided liquidity by companies to companies shunned by institutional investors. Okay, in the new version of the paper, we will have another version, a proxy for retail investors trade. Okay, because people were not happy with us using Robinhood as a proxy of the retail investors. So briefly on the last point, did institutions reverse their trading in the second quarter of 2020? The short answer is no. We do not find evidence that institutional investors reversed their trading in the second quarter of 2020 when we had the start of a market rally fueled by the Fed. We find some effect of reversal, of stock price reversal in 2020 Q2, but the reversal seems driven by the Fed interventions, not by institutional investors reverting their trade. Okay, so maybe since I linked to the literature on fire sale, you may have expected a reversal of the stock price effect, but we claim that this is not necessarily the case if the fire sale externalities are driven by a rational repositioning of institutional investors all at the same time. Okay. So to conclude, in this paper, we ask a very simple yet important question: do institutional investors stabilize equity market in crisis period? Our analysis based on the role of institutional investors during the COVID-19 crash suggests no, that is not the case. Indeed, institutional ownership significantly amplified the stock price drop during the first quarter of 2020, and the results based exclusively on the equity market are consistent with evidence already published on the bond market. Okay. And these fire sale externalities were created by a combination of institutional investors deleveraging, so exiting the equity market, but also by their simultaneous reshuffling of the portfolio towards certain type of firms. And we believe our results have important implications for policy and practice, in particular for financial stability. Thank you very much for your attention.
Thank you, Stefano. The discussant is Fernando Avalos from the BIS. Do you want to stay there? It's okay. Good.
I have my notes in my computer, so it's probably safer than the podium. So, first of all, let me start by thanking the organizers for inviting me to the conference to discuss this very interesting paper. This is a forensic paper, so to speak, which tries to understand what went wrong in equity markets in March 2020. And from that derive some policy lessons, and plenty of went wrong in markets that month. I am not going to repeat the description of the paper that Stephanie so excellently did right now, but let me just quickly, in a nutshell, to borrow from Marco, summarize the key findings as a platform to my comments. So the question is set out from the title, and let me just rephrase it a bit. The question is whether institutional investors contributed to amplify equity markets distress during the COVID outbreak. And the main findings are that, indeed, institutional investors engaged in fire sales that destabilized equity markets, leading to a cross-sectional, sort of broad, across-firm valuation losses for those firms at least in the Russell 3000 index, non-financial ones. Those fire sales were in principle driven by two items. Investor redemptions that force companies, investment funds, institutional investors to get cash. And second, portfolio rebalancing towards firms that were more financially robust, that is, that had less leverage or stronger cash buffers.
They also find that retail investors provided the liquidity required in the event, given that the sell-off by institutional investors was so widespread. And that's at least the case for Robinhood investors, if those are representative of the very heterogeneous group of retail investors. A key takeaway or conclusion is that when a tail risk event materializes, institutional investors amplify price crashes. So my comments now will try to explain how and why, to some extent, I disagree with some aspects of the narratives and interpretations that the authors construct from the evidence they present. Hopefully that could lead to some additional tests or analysis that might shed more light on the events. So the key element of the paper, of course, it's the fire sales. It is a known fact, it has been reported profusely, that indiscriminate sales that you can sort of portray as fire sales by certain investors in a context of limited market liquidity drove large valuation losses during the second half of March 2020. This was a pretty broad cross-market deleveraging event. It's not something that was circumscribed to equity markets. We verified that for treasuries, for other fixed income markets or funding markets, for money market funds as well, for corporate bonds also. In fact, comparable developments were observed last year in commodity markets, and I have a paper with some bulletin with some colleagues that will speak about that in next month probably. So the thing is, or the question at this point is that it seems that there is more space for the authors to study whose sales were more consequential for equity market developments. The authors mostly refer to a sort of broad group of institutional investors as drivers of the distress through their trades. But is it that the case? Are all institutions the same? Their actions are comparable? Figure 7 in the paper actually seems to suggest differently, since it shows that, for instance, hedge funds were the largest sellers, both in terms of amounts and share of their portfolios, whereas mutual funds were sort of second in that scale, but they were not that large in comparison to those from hedge funds. And pension funds, in fact, have relatively limited sales, while other investors, like investment advisors, actually did buy during the period. So the point is that more can be done to apportion price impact and drivers of institutional deleveraging in terms of trying to understand why what happened in March 2020 did happen. It is also true that to get a more sort of robust identification of the drivers, they might require higher frequency data, and I'll say a bit more about that later on. So bottom line is that hedge funds sold off much more than any other institutions. And according to the paper findings in table 5, for instance, they sold different stocks than the other institutional investors. Now, different institutions face different incentives, and therefore a more detailed analysis, a more comprehensive analysis of who was actually selling and how that impacted market developments could also bring us more understanding on why they actually did sell, which could provide interesting insights for policymakers. So as I said, there are two main drivers that the paper identify as the cause for the fire sales. One are redemptions, and the other is the repositioning of investors. Now, with regards to redemptions, I would say that overall, the evidence from this paper and other papers that has addressed other markets, the evidence seems consistent with the sudden deleveraging event triggered by the liquidity squeeze, the sudden need from investors to get cash for whatever reason. Redemptions are obviously a potential driver of the event, but its actual weight, it's not very clear. It's not sort of disentangled in the paper. And in fact, there are some reasons that would give base for underweight their relevance. For starters, pension funds are not subject to any sort of typically large-scale redemptions. Hedge funds, which are the largest sellers in the sample in this event, typically have redemption windows or redemption advice periods that tend to shield them from investor fleeing their assets. Mutual funds, though, are more exposed, and there's evidence, or there's other studies that show that they probably have a large role in the dislocations that were observed in corporate bond markets. But in this case, for equities, their sales are not the largest. Still, it would be interesting to know or to find out if their ownership swings were closely associated with the events that we verified in March. But again, we don't have that analysis, and it would actually be very simple just to rerun some of the tables, not with the aggregate ownership, but with the investor type ownership. Now, market intelligence and analysis suggests that in many cases, this need for cash, these liquidity needs, were spearheaded by margin calls on derivative positions that created again this pressure. This could also have been the case, as we were not so long ago reminded by some, for some vehicles, off-balance sheet vehicles that are popular among pension funds, like in the case of the UK, the liability-driven investments. Now, that calls for attention towards a different kind of aspect of funds position, not so much the financial strength of the firms in their portfolio, but the fragility of the portfolio itself, how much the institutional investors' portfolios are exposed to leverage, either explicit or perhaps more importantly, synthetic through derivative positions. The other element is, of course, the portfolio rebalancing. The paper proposes and tests where portfolio rebalancings were another driver of fire sales, and they find that firms more financially fragile, with more leverage or thinner cash buffers, had lower returns and saw more pronounced drops in institutional ownership during the first quarter of 2020. Now, the truth is that it sounds a little bit unlikely that institutional investors, which are typically very mindful of the impact that their trades have in market prices, would suddenly, because of a strategic decision of leaving these kind of firms, simply are going to stampede out. We're going to stampede out of those stocks, causing fire sales and causing valuation losses. In fact, the mere fact that the shift continued in the second quarter of 2020 rather than being reversed suggests that this was part of perhaps a longer trend that simply continued in that quarter. The author could provide more evidence. They do provide some evidence, but for the fourth quarter of 2019, but they could provide a little bit more to understand whether this trend actually had begun before or lasted longer. But if they really want to make the point about portfolio rebalancings being a potential cause for fire sales, they might bring to the table some market intelligence that could actually sort of help us to understand what is the rationale for this kind of, what would have been the rationale for this kind of unusual behavior from institutional investors. There is a couple of issues with the timing of the fire sales and the sort of spread between fundamentals and the pricing, but I'm late. So let me just skip that and just focus on the last point about the extensions. There are three main areas of extension that I think could be interesting. First of all, as I said, bring more information about the fragility of the portfolios themselves in the way of synthetic exposure to derivative positions. The other potential area of extension that is actually suggested by the authors themselves in the introduction is why the response in this case was so different than the response of institutional investors to the September 11 shock. Both shocks were completely exogenous, and however, we have a completely different reaction to them. What is different? What was different in September 11 from what happened with COVID that motivated these institutions, whoever those were, to react in such a different way? I mean, this is key, because if we don't understand that, we are not really understanding what happened in March 2020. And then the main conclusion of the paper is not really warranted, because we don't really know if this is the way that institutional investors always are going to react to this kind of shock, or this is something that there is some other factors that are intervening. And then the final point is also suggested by the investors. I'm sorry, by the authors of the paper, in the sense that do these swings in valuation do have an impact in the real economy or not? If you look at the index, this seems like a very brief dislocation that apparently was over in a matter of weeks. But they show us that that is not so, in the sense that the index recovers, but the cross-section of firms does not really, the effect is heterogeneous. For some firms, they recover more, and other firms, those that are financially weaker, recover less. So this would be a nice complementary or extension in a new paper to explore whether or not these swings in valuation actually have an impact on corporate investment decisions. Overall, interesting paper, perhaps a little bit more work to do, but quite worthwhile.
Stefano, is there any quick response that you want to give? Just 2 minutes?
Just briefly. So first of all, okay, it works. Thank you so much, Fernando, for the discussion. All comments are very well taken, and I agree with some of your comments. Let me just mention, well, maybe I'll try to address two points. So first of all, on the comments that it's unlikely that institutional investors who are usually careful in their trade cause fire sale externalities by rebalancing their portfolio at the same time. Well, on this, I would I would say that I disagree on this, because that's exactly the point of the paper. Yes, we know that in normal times, they are very mindful of their effect on market valuation. The point is whether they are careful during a tail risk event, where basically in the same days, so here we are talking about 1 or 2 weeks of very high panic, whether they're able to behave rationally during this period. And I think it's quite credible that during these 2 weeks, they had to, they probably were very busy repositioning completely, reshuffling completely their portfolios towards certain sectors and certain type of firms. And by doing that, they may have created negative externalities on price. That's our, let's say, main story. And in the new version of the paper, we will have an analysis that I think can address some of your remarks. So we will try to disentangle the change in institutional ownership at the firm level in a component driven by flows. So a flow-driven change in IO, and the part that is driven by discretionary decision of portfolio managers, and the relative importance, the 2 components on the stock price effect we identify, and we find that the second one, so the effect driven by the reshuffling of the portfolio, is much more important than the flow-driven one. So maybe to address some of your comments, for instance, on the heterogeneity between hedge funds and other institutional investors. Yes, hedge funds sold a lot, but it does not mean that also other investors had a negative effect on prices, because maybe they did not divest from the equity market, but they decided to reshuffle their portfolios, so they may have an effect through these check-on channels. But thank you so much for all these very important comments. We will address them.
Okay. I suggest that the floor asks the questions directly to Stefano, since we have a coffee break coming. Thank you again.
Last session of the day, so we're a bit late, but just like 10 minutes about. So next paper, we have Federica Zeni connected, so she couldn't make it, so for a last minute inconvenience. So I think she's there. Okay, you can all see her. So she's presenting a paper titled Reducing Carbon Using Regulatory and Financial Market Tools, and I'll give her the floor, 25 minutes. Thank you.
Thank you. Can you hear me?
Yes.
Okay, great. Okay, so thanks for inviting me. Apologies if I cannot be here. Thanks also for to my former colleagues at the bank, which I saw in the screen. I don't see people anymore, by the way. I used to see a video of the room. Okay, great. Yeah, no, unfortunately, I'm stuck in the US at the moment. I'm waiting for a passport renewal. But anyway, so glad to be here. I'm presenting the paper, Reducing Carbon Using Regulatory and Financial Market Tools. It's a joint work with Franklin Allen and Adelina Barbalao. It's still a preliminary paper. That's actually the first time I presented in a formal workshop. So really looking forward to hear your comments and questions. Okay. Okay, so we know that global emissions causing climate change are a global externality which should be corrected with a unique global carbon price. Yes, we see a certain degree of heterogeneity across countries as of the form of carbon regulation, carbon pricing regulation may take, and whether it is implemented in the first place. Specifically, we see some countries that have implemented a carbon tax. Few other countries, an emission trading scheme, which is substantially a regulated market for permits to pollute. Other countries have implemented both. The majority are still either considering or haven't done anything. Against this fragmented regulatory framework, we have a clear need to to meet the Paris Agreement goal, which is the one of stabilizing global temperature below 1.5 degrees Celsius. And there are various estimates of how much it would cost us to meet this goal, which range between $5 to $7 trillion per year by 2030. This is clearly like beyond what governments are doing so far. So there are clearly a lot of reasons as to why we see this picture. What we focus on in this paper, particularly thinking about democracies, is the lack of political support, which is driven by different different preferences and concerns for the environment. On top of this, there are important equity issues, which I will maybe touch at the end of the presentation, in that countries that have contributed the least to create these emissions are the most affected by this problem, and also the ones that have the least resources to deal with it. So this is another motivation graph to just put everything on the same scale and to give you the message again that we are not doing enough. On the map, you find the direct or implied carbon prices that are currently active in these countries that range about around $40 per carbon ton. And these have to be compared against what we think has to be right now the carbon price signal that we need basically to meet the Paris Agreement goal, which ranges about $200 per carbon ton. So against this fragmented regulatory framework, there's the good news that financial markets are responding, and there's a lot of work also presented in this great workshop about institutional investors' in interest for sustainability-oriented projects. And specifically in this paper, we look at the development of the sustainable debt market. So the corporate and government sustainable debt market has risen exponentially after the pandemic. It has now reached around $6 trillion cumulatively, which is an order of magnitude that starts to be compared to the Paris Agreement financing needs. And in particular, after the pandemic, a new type of, a new category of debt contract has emerged, which we want to focus on in this paper because we believe that has the potential to potentially substitute the regulatory tool. And these are the sustainability-linked loans and bonds. So how are these contract designed? Basically, they embed a contingent payoff. They have a contingent payoff which depends on the issuer emissions vis-a-vis a certain benchmark. For example, like Uruguay has issued a sustainability-linked bond in 2022 with expiration in 2034. So usually these bonds have a key performance indicator, a KPI, which for the case of Uruguay, is the cumulative emissions that they have produced between 1990 and 2025. That is the year where they expect to peak. And then with respect to this key performance indicator, they have this target of reducing emissions by 2034 of at least 50%. If they do so, and actually if they exceed the target, they're going to get a discount on the initial coupon rate. Otherwise, if they fail to meet the target, they get a step up. So this interest rate increase or decrease embeds a market price and a carbon price incentive, which in our SLICE framework actually can substitute the kind of incentive that the firm face in a carbon pricing regulation. But why this is also interesting, because of what's happening already, or the fact that these carbon contingent securities seem to have a wider reach than the carbon pricing regulation. Particularly in green, you find the percentage of this sustainability-linked debt issuance relative to issuance of normal standard debt over the same years. And you can compare this with the current active regulatory framework, and you can see that. So we find regions such as Europe that have an active sustainable market, but also a relatively stringent regulation. But also you find countries that have an active, sustainable market, but no regulation at all. So this is, so in this paper, we're going to look at a country perspective and trying to see what are the conditions under which we should expect the blue or the green or the coexistence of the two, put in very simple terms. Yeah, so the premise is like a heterogeneous fragmented regulatory framework, which we think is an equilibrium outcome of a disagreement of the voting population. And at the same time, there are global financial market that seems to be providing an alternative. We want to understand the interaction basically between these two tools. This is like a preliminary framework. We are making some assumptions. The assumptions, of course, are going to inform the results. And so, yeah, I'm going to be very transparent on what I think is going to be important for the substitution to take place with you. Yeah, so I'm gonna go quickly through the baseline model. So we have two models in the paper: a simple kind of like bank solution linear model, and then we have an extended model, which I will touch briefly during the presentation. So in the baseline model, we have substantially two technologies: a polluting technology and a green technology. The polluting technology is more profitable than the green one. And then there are two types of agents, the standard one, which are financially motivated, and the environmental one, which have this they want to consume, but also they have this warm glow type of preference that we see emerging, that we have seen some empirical evidence of it. Basically, you derive some disutility from doing bad or utility from doing good, irrespective of how much what is your impact basically on aggregate emissions. Both of these agents at this point are going to be affected. There are no climate deniers in this model, so I'm gonna show you when this matters. But they know that they are atomistic, so they behave as basically a small agent. Then there is a regulator which chooses a carbon tax, but is subject to a median voter constraint, meaning that it needs the majority of the population in favor of the tax in order to implement it. And then there's this extra ingredient, which is basically the fact that we allow standard environmental agents to trade through this debt contract that resemble the one that we see in the market. So basically, there is a fixed component of the interest rate as a fixed component, and then there is a contingent term which depends on the emissions of the issuer vis-a-vis a benchmark, which in equilibrium is going to be the counterfactual emissions that the issuer would have produced in absence of these securities. So the main predictions of this simple model that doesn't allow for a coexistence of these two tools, it's basically that if you get support for a carbon tax, if you had enough green agents, then you should see a carbon tax correcting for the laissez-faire economy. But absence political support, a market for contingent finance will arise in equilibrium, and the extent to which this financial markets can substitute the emission reduction achieved by the tax depends on the funds of the environmental agents relative to the standard one. So in very intuitive terms, the problem shifts from a political constraint to a budget constraint. What is the main result, I'd say, from the main takeaway from this simple model, which really still stays in place for the extended one, is that the opportunity of financial markets to arise weaken a little bit support for the regulation, and it does so across all type of agents. So it weakens the support both of the environmental agent and both of the standard agent. The environmental agent is going to now trade off the cumulative global benefit achieved by the tax against his private benefit of doing good and reporting about it, versus but the standard agent now, it knows that if the tax is not implemented, then it actually has a more profitable opportunity to basically enter this market. And so because the existence because when internalizing the financial market response, they vote less in favor of the tax. If the economy shifts from a one that supports the tax to one that does not support the tax, but there is not enough funds to switch basically to reform all the technology investments, then there can be welfare losses. That's the main prediction of this simple model. So I'm gonna skip the literature because I think I'm already at 15 minutes or so. So the baseline model, we have these two technologies. The polluting technology is more profitable, but produces emissions. The non-polluting technology, less profitable, produces zero emissions. And then we have two types of agents. Both of them are like consumption. The standard agent form a proportion theta of the population, whereas the environmental one a proportion 1 minus theta. Both of them are impacted by carbon emissions, so they are not. Also the standard agent are not climate deniers. They recognize that there is this exposure to climate, or although they are small, so they cannot do anything about it really. But on top of it, the environmental agents also have this warm glow type of preferences. And in this simple model, although we're going to relax this assumption in the extended one, the green preference is actually pretty high. It's higher than the productivity gap. And the regulators simply maximize the utilitarian social welfare. So in this case, we have that in the laissez-faire economy, the standard agent, although it recognizes the impact of the environment, it prefers basically to invest in the polluting technology, whereas the environmental one that has this extra kink in its utility, by doing good, it prefers to invest in the green one. Now, if there was a carbon tax, if there was an unconstrained carbon tax, it would be optimal to put this carbon tax at least equal to the productivity gap to shift the investment of the of the standard agent. If this parameter lambda is sufficiently high, we assume that this is the case in this model. So the regulator would optimally impose this tax. However, we have a median voter problem in the sense that you need the majority from at least half of the population. Now, if the median voter is a green one, you don't have problems. If the median voter is a standard one, then it may be that the standard one is going to weight its private benefit from investing in the polluting technology against the expected basically reduction in climate exposure delivered by the tax. Now, clearly, if he was a climate denier, then this thing would be zero and would get always no support for the tax. That's something that we are looking at now, and I apologize with the discussion is not in the draft yet. Okay, so then there is a carbon contingent financing. So we basically allow these agents to trade, and it's very intuitive to see that trading can only occur if a carbon tax does not exist in the economy, and if the standard agents are the issuers and the environmental one are the lenders. So this is very similar to what we see for the case of Uruguay. Basically, the standard agent is going to get compensated if it reduces emissions beyond the benchmark, which is the laissez-faire economy. Vice versa, I will have to repay the environmental agent if it produces more emission than the benchmark. So in equilibrium, you get that there is trading between environmental and standard agents, and the amount of reformation of the standard agent depends on the share of endowments. There are regions of the model parameters in which you cannot reform all technologies. And also the median voter, which internalized the financial market reaction, is a bit less in support of the carbon tax, independently of whether it's green or brown. And so what happens is that there can be welfare losses. So if we put ourselves in a case in which in the counterfactual economy, there would be support for the tax, which is, for example, this case, you can see that when you introduce the opportunity of financial markets, there's going to be at some point, basically, some region of the model parameter, the support for the tax is gonna disappear. In particular, when the endowments of the environmental agent are large enough, but are still not sufficiently high to fully substitute, the support for the tax is gonna drop. This is gonna create a reduction in cumulative emissions achieved by this financial tool relative to the regulatory tool, and this in turn is gonna create a welfare loss. And so that's basically the main prediction of this intuitive model. I think I have about 5 minutes. So let me go quickly to the extended one. So this is very similar to the other one, that in terms of intuition, there's really little to add, with the exception that now we have a distribution of preferences, and we are interested in particular in the skewness of this distribution. And also there is the technology of a convex cost, which allowed us by construction to get internal solutions and to look at the intensive margin interaction of the tax and the market the market price of carbon. So we solve the model by backward induction. We find the equilibrium price and cutoff type in the finance market for a given tax. We then go one step before at the agent problem, and we find the threshold, the tax threshold that makes the median voter indifferent between voting or not in support for the tax, anticipating the reaction of the financial markets. And then we solve for the optimal tax of the regulator, and now the regulator takes into account the financial market response. So we have, I'm trying here to make some comparative studies that we're trying to understand whether the comparative study makes sense. So we have a distribution of preferences that lies below $40 per carbon ton, and we are looking like, given this model framework, how much we would expect the carbon price to be for a given level of the tax. Here, a first thing to notice is that there's substitution, in the sense that the higher the tax, the lower the price of the market. Higher tax in particular reduce the abatement potential of the issuers and also the lender's budget. Another thing to notice is that according to our model calibrations here, the cutoff types, so the types that are indifferent between being lenders and borrowers of the carbon contingent security, are always above the median voter, which means that they are typically greener than the average voter in the economy. This means that the person that has the marginal voter basically is usually a borrower of carbon contingent securities. So is weighting the benefit of the tax against the private profit of issuing these securities. Here is a similar thing. So basically the median voter threshold decreases because of the presence of financial markets. This is extra term here. This is basically how much the median voter is different from the average. Usually when you get a skewed distribution, whereas the mass of agents that have very low preferences, you get this term to be positive. And so the more this term is positive, the less the support for the tax. And you can see that with financial markets become even lower. So on one hand, financial markets decrease support for carbon tax. On the other hand, though, financial markets supply some sort of some level of emission abatement. And in particular, if you solve for the optimal tax, you find that the optimal tax in presence of financial markets is not the Piguvian benchmark anymore, but it's the Piguvian benchmark net of what you would expect for the financial market the abatement provided by financial markets. And so whether there is detrimental, whether financial markets are detrimental or not, it depends on how much this constraint becomes binding versus how much emission reduction can the market supply. So we find that the tax is below the Piguvian benchmark, but if the immediate constraint is very low, then there is the possibility of welfare losses. So let me conclude. This is a very similar graph as of the and these two baseline economy scenario, where basically where you have when support for the tax is either very low or very high, financial markets can actually improve welfare, or at least achieve the same welfare as the tax. But in intermediate cases, you may have that the financial markets shift the economy from one that supports the tax to one that does not support the tax, but don't have but the distribution of the population endowments and preferences doesn't allow basically for a full substitution. Okay, so to conclude, in the baseline model where we have either a carbon tax or this carbon contingent financing, we are able to outline the substitution effect and the limitation, and the fact that from the political constraint we shift to a budget constraint, basically. And in the extended model, we derive a coexistence of these two, so an intensive margin substitution. And we haven't yet derived all the cases which are welfare losses as a function of the distribution of the population preferences. But our takeaway here is that financial markets are not always welfare improving. Thank you. I think I'm a couple of minutes.
Thank you very much.
Yeah, thank you.
For staying well on time. So now the discussion by Tito Cordella. You have 10 minutes.
Okay, thank you very much for the invitation and for giving me the opportunity to read this very interesting paper. So, let me just start that my overall take, I really enjoyed the paper. First, because it is an elegant model, and I also always give some kudos for elegance. But not only because it is elegant, because also because it addresses a very important issue, how to use regulatory and financial instruments to deal with carbon emission and climate change. And what it really does, the paper does, is to provide a thoughtful and nuanced policy analysis. And the reason why it is thoughtful and nuanced is because it's based on a second-best world. And being based on a second-best world, it highlights interesting trade-offs among regulatory and financial market tools. So what I've really learned in this paper is that addressing climate change issues requires a rich and possibly a general equilibrium framework where different policies and instruments, financial and not, can interact. In this rich framework, we really have the fact that the total effect of policy is not the sum of the different parts, can be more or can be less. And it can also happen once we consider all these constraints that good ideas may turn out not to be so good. And this especially in the case that is analyzes in Swiss paper, in which good ideas like carbon taxes may affect the political economic equilibrium. Let me just give a very brief summary of the paper. This is one good economy with a mass one of entrepreneurs, which can produce the good with a green or a traditional technology. The green technology is more expensive, but everybody gains from lower emissions. So lambda is the cost of total emission and is higher than the gain of producing the brown versus the green goods, that is pi minus g. In this economy, we know the solution would be a very easy one. We just impose a sort of Pigouvian tax, tau, greater than pi minus g. But the real problem, and this I want to be a little bit provocative, is the presence of a fraction of green entrepreneur. Since the green entrepreneur feel responsible for their own emission, and they bear a utility cost that is it of their emission. And so green entrepreneurs are willing to adopt the green technology even in the absence of a carbon tax. But now what happens? Because green entrepreneurs want to adopt green technology without a carbon tax, now traditional entrepreneurs may end up voting against the carbon tax. Why? Because the tax of the burden is independent of the number of green versus brown entrepreneur. It's independent of theta. Theta is the fraction of brown entrepreneur, while the gains depends on the fraction of brown entrepreneur. So if all entrepreneurs would be brown, they would vote in favor of the tax because lambda is greater than pi minus g. But if there are many green entrepreneurs, well, the brown entrepreneur not willing anymore to pay the taxes because most of the reduction in pollution occurs via the good behavior of the green one. So this is what happens in the political economy equilibrium. The median voter will vote for a carbon tax, either if the median voter is a green entrepreneur, of course, or if it is a traditional entrepreneur, but most entrepreneurs are traditional too. So the brown entrepreneurs is favorable to a carbon tax, only if there are few green entrepreneurs, because those are the ones that otherwise the brown entrepreneur can free ride on the behavior of the green one. So the question of the paper is how, absent the support for a carbon tax, can green finance help? And here the idea is that traditional entrepreneur may issue bonds whose returns depends on emission reduction, and green entrepreneurs will of course be willing to buy them. And if their pockets are deep enough, so green entrepreneur can buy a lot of these bonds, they may replicate the carbon tax outcome. If not, the presence of carbon contingent finance may even reduce welfare. And why? Because it undermines the consensus for a carbon tax, either because of greed, because now the brown entrepreneur want to be paid by the green one instead of paying for the tax, and the feel-good effect that the green entrepreneur prefer to buy this bond because they feel better than just having a tax in which, yes, they help the reduction of the emission, but the tax misses this feel-good effect. And this is something I would like to understand better, but I wouldn't discuss in detail. So I have a few questions, of course, being a discussion on the model, both on the modeling strategy and on the policy tools. Regarding the model, this is a minor point. I'm not totally sure about a median voter model. Here is a population that is composed of only entrepreneurs. So perhaps I would prefer a lobby model or of a lobby model. And I think the result will be the same, because actually all what matters at the end is who controls the legislative process, who decides the amount of the carbon tax. But this is a minor point. The things that it bothers me a little bit is the perfect correlation between endowment and preferences. That is, what here you have all traditional entrepreneurs have an endowment H1, and all green ones have an endowment H2. And also in the more generalized model, we have the H1 that is endowments, and eta I that is the feel-good effect, the guilt effect of pollution increase monotonically in I. I understand this is neatly for single peakness, but it's not very elegant. So the question is, couldn't you model this? Maybe just having a decreasing utility for consumption would make richer people more willing to pay for emission abatement. These are minor points. My major point is regarding the returns on the security. The return on the security on this carbon security is a fixed part, that is R hat DI, minus a part, minus carbon contingent financing growth. It depends on the difference between the emissions that the entrepreneur would made absence the tax or absence this bond, and the ones that will occur at equilibrium. So E bar denotes the counterfactual of what emission will be in the absence of external financing. The problem is that in the model, it's not observable if an entrepreneur is green or brown. And once we solve by backward induction, the regulator proposes a tax, entrepreneur vote, entrepreneur chose investment and financing. Now, why shouldn't a green entrepreneur pretend to be a brown one and can in this way be able to gain from selling a green bond? So there is a sort of time consistency issue. And more generally, the problem is, my question is, what is the interest of the green entrepreneur to reveal their type truthfully when they could gain pretending to be brown one? The second point that I'm a little bit confused is regarding these returns on this carbon contingent security, especially on the part that is the carbon contingent one. E2 hat minus E2 denotes the carbon emission that the entrepreneur is responsible for. I perfectly understand what this is an equilibrium, and it's too late to go into the formula, but I wonder what it is, how this what happens out of equilibrium. And actually what I'm really asking is how the debt country is actually written. And the other thing that I'm really confused is why the variable report component does not depend on the amount that the entrepreneur lend, the green entrepreneur lend to the brown one. It seems that you have returns on the fixed part that depends on rightly on the volume of the lending, but the contingent part it seems to be independent on the volume of lending. And this maybe I didn't understand perfectly, and you could give me some light on this. Finally, other policy tools. My question is that if policy can discriminate between green and traditional entrepreneurs, wouldn't a subsidy solve the political economy impasse that when traditional entrepreneurs control the policy agenda? So instead of having, in this case, to issue a carbon tax, use a carbon subsidy, and wouldn't this solve the problem? And the other is a poor provocation. I would say, wouldn't this particularly set up a Texas policy of taxing green entrepreneur would work? Because if I tax the green entrepreneur would become like brown one, and then there would be a consensus of the median voter to impose a Pigouvian taxation. But this is not something I suggest, it's just out of the model. So let me just conclude, that is for 10 minutes. To face the climate change challenges, we really need smart policies, and smart policy needs smart analysis. And smart analysis are necessary because we want to understand the different trade-offs that may occur in a second or third best world. And this is exactly what this paper does. And I would just conclude saying we desperately need more paper like this one. Thank you.
Thank you very much. Other questions on the floor? Okay, if there are no questions, then Federica, do you want to take
Thanks for the great discussion. I think it touched on a lot of issues and features of the paper that we are currently working on. So the lobby, makes sense. I think it's not a first order right now, but the comments that came after are. So the perfect correlation between EDI and HI, also you are totally right. I think it's something that we are doing now in the extended model, which allows for modeling, as you're saying, the utility function. So we will definitely do this. As of the equilibrium, so I apologize. I think that there has been, in terms of notation, we haven't been clear because the contingent part is actually a function of the debt, although it is probably that the notation was confusing. And the out of equilibrium result, it's definitely something that we need to address. And also, as you are saying, as we are defining the contract and thinking what is observable and what is not. So in the extended model, we actually take the assumption that EDI is observable. But you are totally right that we should incorporate, we should relax this assumption. And perhaps, yeah, the provocative kind of thing, I think it's very interesting the way you put the discussion. The problem is basically that we have too much of green entrepreneurs. This is something that comes out of the fact that we assume that the standard one actually are not climate deniers. If you relax that assumption, some of the nice interpretation that you give actually doesn't take place anymore, but it's also something that we are addressing right now. So thank you very much for this great comments, for the great discussion. And yeah, I hope to see you in Italy at some point. Or in DC. That's right. Right. Thank you.
Okay, thank you very much for both Federica and Tito. Thank you. Okay, we can move on to the last speaker, Massimo Dello Prete from Imperial College. What is missing in asset pricing factor models? Have 25 minutes.
Slides. Okay, okay. Works like that? Okay, I know it works.
Okay, great. So first of all, thank you very much for giving me the opportunity to present my joint work with Manu Pal, Paolo Zaffaroni, and Irina Zveladze on what is missing in asset pricing factor models. So a major challenge in asset pricing is explaining why different stocks exhibit different expected returns. So the first model to address this question was the capital asset pricing model. But when this model failed pricing the cross-section, hundreds of systematic factors have been proposed in the literature, and this phenomenon was even labeled by Cochrane as factor zoo. But despite many factors have been introduced, still a sizable pricing error is estimated in any model that we can think of. So in this paper, we would like to not to ask the general question, which is which factors are missing, but we want to ask a more general question, which is what is missing in asset pricing factor models. So the existing models usually assume that only systematic risk is priced. Saying differently, if we take the difference between the expected excess return and the model implied excess return as a linear function of the risk premia of the single risk factors, under correct model specification, we expect this difference to be equal to 0. We deviate from this general belief and we rethink the risk-return trade-off, allowing for this little a component to be possibly different from 0, and we will also give an interpretation to this little a as compensation for unsystematic risk. And we will do it under the setting of the arbitrage pricing theory. How do we measure misspecification throughout our work? We do it through the lens of the SDF. So just to be everyone on the same page, the SDF is a quantity which adjusts cash flows for risk and time. And under correct model specification, it should happen that the expected value of the SDF times the excess return should be equal to 0. And saying differently, the risk premium of a strategy is related to the covariance of the return on the strategy and the SDF itself. So what do we do? First of all, under the arbitrage pricing theory setting, we firstly identify what's the admissible SDF. And then we take this to the data and we quantify how much compensation for unsystematic risk actually matters when pricing the cross-section. Secondly, we adjust a little bit the setting and we allow for a candidate model to start with, and we develop a methodology to correct a misspecified candidate model. And also in this case, we take this methodology to the data and we try to correct some popular factor models. And what we find then? So if we think of splitting the SDF into two components, one which is related to exposure to unsystematic risk, and one which is related to exposure to systematic risk, we find the unsystematic risk to drive more than 70% of the variation in the final SDF. In addition to that, we also find that many successful factors, which has been proposed in the literature, they were actually successful because they correlate with this component of the SDF. On the other hand, if we focus on the systematic component only, we find the market factor to explain more than 95% of the variation in this component, which also explains why the CAPM was such a successful model. But still, let's remember that it is just 95% out of the remaining 28% of the variation in the final SDF. So the market factor is definitely the main driver of the systematic component, but still, if looking at the full SDF, it's still like a small portion, and that's the reason why we observe a sizable pricing error. Having said that, it's not surprising that we find that the main source of misspecification in popular factor models, it's definitely that they are missing compensation for unsystematic risk. Okay, so let's start from the APT. So the arbitrage pricing theory assumes that deviations of gross returns from their expected value have a factor structure. The advantage of the APT is that one first advantage of the APT setting is that the APT is agnostic on which are those common risk factors. So everything is latent. So under this assumption, it follows that the expected excess return of a strategy is linear in the risk premia of the different factors, but there might also be a little a component, so an intercept, which can be different from 0 as long as it satisfies a no arbitrage restriction. So under the APT setting, we still have no arbitrage, even though little a can get deviations from 0. So the arbitrage pricing theory is a purely statistical model, so it stays silent on what little a is. In our paper, we will also give an interpretation to this component, and in a few slides, I'll show you why do we interpret it as compensation for unsystematic risk. Under this setting, we derived that the SDF takes the following form. So as anticipated before, it has two components. One component which depends only on the systematic risk factors, and a second component which depends on the unsystematic shocks. So if we assume to be in a standard setting where there is no compensation for unsystematic risk, then the second component disappears, and we go back to the usual SDF that we are used to work with when working with factor models. Okay, so that's all under the APT setting. Now let's adjust a little bit our setting in order to start with a candidate model. So let's suppose now that we start with a candidate model. It could be the CAP-M. Under the CAP-M, K-can will be equal to 1. We have only one factor, and our factor will be the market factor. So under this setting, we assume that excess returns follow a factor structure defined by only one observable factor. But whatever is left out from the candidate factor is embedded inside an alpha, which could be potentially different from 0, and within the epsilons. Our candidate model can suffer of two sources of misspecification. The first one is the one which has been explored principally in existing models, which is missing sources of systematic risk. But secondly, we account for a second possible source of misspecification, which is missing compensation for unsystematic risk. In order to make those two components to show up in our corrected model, we can rewrite the alpha as A plus beta miss lambda miss, where lambda miss is the risk premium associated to the missing sources of risk, and little a is our compensation for unsystematic risk. Similarly, we can rewrite the epsilon term as well. Under this new setting, under this corrected model, we show that the SDF, which prices the cross-section, takes the following form. This time we will have three components, one which is the candidate SDF, the blue term, which is the SDF implied by the candidate factors. And then we have a second component, which is a correction term, which makes the candidate SDF pricing our cross-section. And this component will depend itself on two components, one which is related to the missing systematic factors, and one which is related to exposure to unsystematic shocks. Okay, so now we are ready to go through the key insight of our paper. So let's put ourselves firstly from the perspective of the candidate model. If we put ourselves from this perspective, then the alpha definitely plays the role of a pricing error. Indeed, if we take the expectation of the candidate SDF multiplied by the excess return, this is supposed to be equal to 0, and if our model is correct. And whatever deviation we get from 0, this will be definitely a pricing error. But now let's change our perspective, and let's put ourselves from the perspective of the corrected model. From this perspective, the alpha is not a pricing error anymore. Indeed, the alpha is related to the covariance between the corrected SDF and the epsilons. So alpha will reflect compensation for exposure to missing systematic factors and unsystematic risk. If now we zoom in on the little a component only, the little a is related to the covariance between the SDF and only the unsystematic shocks. And here it comes the interpretation of little a as compensation for exposure to this kind of risk. Okay, so now we are ready to move from the model to the data. In order to do that, first of all, we need to estimate the corrected model. So this is the expression of the corrected model. If we want just to estimate the arbitrage pricing theory, the APT model, we can just delete the blue terms, which accounts for some candidate factors. In order to estimate our model, we use a Gaussian maximum likelihood estimator under a constraint. The constraint is the no arbitrage constraint. And this constraint will also play the role of reducing noise, as the estimator for little a will take the form of a ridge estimator. And this constraint is also the goal of ruling out arbitrage, of course, from the market. Our estimation process will depend on two hyperparameters, which is the number of the missing factors, k, and also the upper bound of the constraints. So the first stage of our estimation will be selecting those two hyperparameters using a cross-validation exercise. And we will use as a selection metric the Hengee distance, which is a pricing metric. So we want the Hengee distance to be as small as possible. We apply our methodology to a data set with more than 200 portfolios, characteristics of the portfolios. And in order to interpret our result, we collect more than 450 candidate factors, traded strategies, and we complement this data set with also about 100 non-traded variables as well, which includes macro variables, business cycle variables, or also sentiment indices, volatility indices, in order to interpret our results. So what this plot shows, so we say the first thing to do is selecting the hyperparameters. So how many missing factors and what's the upper bound of our constraint in the estimation process. So let's focus on the top panel first. The top panel plots the Hengee distance for different values of k, where k is the number of missing factors, and for different values of delta on the x-axis. So we want to minimize our Hengee distance. So looking at the set of curves that we can see in the top panel, we end up selecting this point. And notice that, one thing I didn't mention before is that we need the constraint to be binding in order to be able to separate the little a from the lambda miss components. Okay, so our constraint will be binding. So whatever value of delta which is greater than 0 will imply that unsystematic risk is actually priced. And in the point we select, definitely we have delta greater than 0, and we select 2 missing factors. Another thing that we can learn from the top panel is the following. So let me just go back to the previous slides. Okay, so let's look at the expression of the unsystematic component of the SDF. The unsystematic component of the SDF depends on the unsystematic shocks which do not have a factor structure. So on one side, one might think that just keeping adding factors in our model will eventually recover for this component. But this is not the case, as the E component doesn't have a factor structure in the first place. So just saturating the model with factors doesn't capture this term. And this is exactly what we observe in the plot, because if we move from k equal to 2, so from 2 missing factors to 10 missing factors, for example, the curve is completely shifted up. And also, if we also restrict delta to be equal to 0, this is the point which indicates a definitely much worse pricing than the model we select. From the bottom panel instead, we plot exactly the same quantity, the Hengee distance, but differently from the above plot. Those pricing metrics are computed from an in-sample estimation, so we don't run cross-validation. And this shows that if we were to select the k and the delta just from an in-sample estimation exercise, then we would probably end up overfitting our data. We would have selected many factors and also a very large value of delta. So this is just to show the risk of overfitting using just in-sample data. So at this point, one might wonder, okay, so how does compensation for unsystematic risk behaves? This is the vector of compensation for unsystematic risk across the different portfolios that we have in our dataset. All the values are per annum and in percentage. So we can see that many of them are very close to 0, but some of them are quite sizable. And if now we take all our estimated quantities and we plug them in the SDF expression, we can also plot the time series of the SDF. So in particular, here we plot the time series of the final SDF, the time series of the unsystematic component, and the time series of the systematic component. And just looking at those time series, we can already learn something. So if we focus, for example, on the largest spike in the final SDF, we find this spike to coincide with the stock market crash in 1987, and we can see that this spike was mainly driven by a systematic shock. Indeed, we can observe the same spike in the time series of the systematic component of the SDF. If now we move towards the 2000s, when we have the dot-com bubble, we can see that there is some increase in variability in the time series of the final SDF, and this is mainly driven by an increase in variability in the unsystematic component of the SDF, which is in line with the general thought that this shock was more like a sector-specific shock rather than a systematic shock affecting the whole market. If now we focus on which on the variance decomposition of the final SDF in the two components, this is exactly where we see that more than 70% of the variation in the final SDF is actually driven by variation in the unsystematic component of the SDF. So any model essentially which is not allowing for compensation for unsystematic risk is essentially missing a big chunk of variation in the final SDF. Let's now focus on the two components separately. So let's start from the unsystematic component, which is our main focus. So we find it to be acyclical. It doesn't correlate significantly with the recession indicator, for example. Then we find it to be significantly correlated with the successful idiosyncratic volatility factor, which means that this factor is definitely a story. This is definitely something which is missing, but this is not the full story, because only the R square only account for 10%, is only equal to about 10%. Indeed, we find the unsystematic component of the SDF to be actually correlated to more than 300 credit strategies, which has been proposed in the literature. This comes from a univariate regression. But then if we see if it's actually possible to span the full component, the full unsystematic component, using only observable strategies, we actually find that this is not possible. Indeed, we only get to about 66% of the variation explained. So notice that if we focus on the systematic component, 95% of it is explained by only one factor. And finally, if we focus on which are the strategies which load the most on this component, so the strategies which earn the largest risk premia for exposure to this component, we find those strategies to have been related to frictions and behavioral biases in the literature, and this will also give a suggestion to microfound this finding, as we will go in a few slides, as we will see in a few slides. Focusing on the systematic component of the SDF instead, we find it to be cyclical, as we might expect. As anticipated before, more than 95% of the variation is driven by the market factor. But if we want to reach the 99% of the variation, we need to add 4 additional factors, one of which is very highly correlated with the size factor, more than 88% of correlation. And this also explains why the 3-factor model from Lanfranco was that successful. But if we want to add just an half percentage point more to approach as much as possible the 100%, we need to get to 17 observable strategies. So this shows that to have small increases, we need more and more factors, as we might expect. So let's now focus on the second part of the question, which is then what is missing in popular asset pricing factor models. To answer this question, we take into account 3 models. So the CAPM, the consumption CAPM, and the Lanfranco 3-factor model, but our finding can be generalized also to other models. And we find all of them to miss some systematic component of in their definition, even though the main source of misspecification is not the systematic component, but it's definitely the compensation for unsystematic risk. Indeed, if we look at the additional standard deviation in the final SDF coming from accounting for the compensation for unsystematic risk, this brings much more variation than the systematic component, the missing systematic component only. interesting that no matter from which model we start with, we always end up with SDFs, which are almost perfectly correlated with each other. So this is an important result, as our corrected model should be almost the same across no matter which model we start with. And this should also be true if we look at only the systematic component of the SDF, as all the models we took into account, they are all missing the systematic component of the SDF. So after correction, we should find that also this component is very close to each other. And of course, having similar SDFs also implies having similar pricing performances. Okay, so at this point, you might be a little bit puzzled, like we studied for years that unsystematic risk is not priced. So in which kind of setting this kind of unsystematic risk can be priced, can naturally arise? So in order to answer this question, we took the Merton model from 1987, where he very easily introduced incomplete information in the market, introducing this additional parameter QI, where QI indicates the portion of investors who is aware about asset I. Okay? We can interpret this QI actually in different ways, also in some ways which match our finding. So if we think of an investor to be behavioral biased, I can think of this investor to be essentially focused just on some stocks in the market. And so it's as if he's aware of only those stocks rather than he does not observe some other stocks. Or this is also in line if we think of market segmentation as well. So when we have market segmentation, we have investors which essentially only invest in some stocks and not in other ones. So under this setting, we find that when n goes to infinity, and this is interesting because when n goes to infinity, we might think that idiosyncratic risk can be fully diversified, so shouldn't be compensated. But under this setting, we find that when n goes to infinity, the equilibrium asset returns and the equilibrium SDF, they take the same functional form as we specified under the APT-based models. So, and in particular, let's focus on the expression of AI. So AI is equal to 0 if we set all the QIs to be equal to 1. So if all QIs are equal to 1, which means all investors are aware of all the stocks in the market, then we are back to the CAPM because AI is equal to 0 and we get the same expression as the CAPM. But as long as QI deviates from being equal to 1, so is smaller than 1, AI naturally arises, and we have compensation for unsystematic risk. Another interesting thing that we can learn looking at this expression is that AI, which reflects compensation for unsystematic risk, as we might expect, is positively related to the risk, which is sigma square. But this relation is not driven by only sigma square, but there is also QI. So it might happen that two different stocks with exactly the same kind of risk, the same amount of risk, the same amount of unsystematic risk, they pay a different compensation just because a different portion of investors are aware about that stock. And this could also bring some light to solve the idiosyncratic volatility puzzle, for example. Indeed, in the idiosyncratic volatility puzzle, we usually observe that if we plot the alphas versus sigma square, we find a negative relation, which is unexpected because we might find that the larger the risk, the larger the compensation. So to conclude, in our paper, we deviate from the usual framework where only systematic risk is priced, and we rethink the risk-return trade-off, allowing for actually unsystematic risk to be priced. We leave this additional free parameter in our model, and taking this model to the data, we actually find that it looks like unsystematic risk is definitely priced. So this gives a key insight which can help different fields. First of all, for example, for theorists, it might give like an idea how to microfound this kind of findings. Secondly, for empiricists, it might eventually resolve the factor zoo. And thirdly, also another field like corporate finance, if we think of venture capitals or startups where the idiosyncratic risk is huge, accounting for compensation for this kind of risk might also help estimating the cost of capital. So that's all from me. Thank you very much.
Thank you very much, Massimo. So discussant is Fabio Moneta from Telfair Business School. 10 minutes.
Thank you. And, I want to say this is my last week of my visiting period here at Collegio, and I want to thank you everyone for the kind hospitality, and it's been a great year. Yeah, so this is an excellent paper. Where is the yeah. Yeah, so I really like this paper, and I think it's an impactful paper. You know, factor models has been used extensively both in academia and in practice. And you know, we started with the capital suppressing model, which is like one factor model, and then we've been extending to like the Farmer-French 3-factor model, then Farmer-French 5-factor model, but still there are still pressing errors. And so this paper asks what is missing in a factor model. So the question could be, maybe it's another systematic risk factor. You know, there's been a lot of papers trying to find new factors that should be added to factor models. And there could be maybe a weak factor, which is a factor which the beta with respect to this factor is close to 0. And the paper focused on unsystematic risk. And so the question is important, not only given the importance of the factor models, but also because if there is missing factors, if there is a weak factor, then you can have biases in estimating the factor models. And the answer is very impactful, because the elephant in the room is this unsystematic risk component. It's like it accounts for 70% of the variation in the stochastic discount factor, and is correlated with strategy reflecting market friction and behavioral biases. They use an LPT model that includes both compensation for systematic and systematic risk, and the asset-specific component are unrelated to the factors and satisfy no arbitrage restrictions. So as I said, this I think is an important paper, and provide at least 3 main contributions to the literature. The first one is to derive under the APT setting this admissible SDF, the price the cross-section, and to show what is the correction term for this asset-specific risk. And then provide empirical support that this unsystematic risk is price, and also to quantify the importance of this unsystematic risk, which it seems very important. The authors have to face a lot of challenges in implementing the model, so it's really I was very impressed with all the effort that they did to implement this model. So they have to make sure that SDF is positive. There is many observable quantity. They have the hyperparameters that need to be decided, you know, which are the number of factors, the delta, and then they have to impose this no arbitrage restriction. And finally, the last contribution is to apply the methodology to popular candidate factor models like the capital asset pricing model, consumption KPM, and identify what is missing in this model. So the starting point is the APT model. I want to remind you that there are 2 versions of the APT model. So there is the Ross version, and there is the equilibrium version of Corner 84. So they're based on the Ross version. And the nice things about APT is that it requires very few assumptions. So there is an assumption about frictionless capital market, which is required so arbitrageurs can do their magic. So they don't. There is no restriction for the arbitrageurs, and the returns are governed by a K-factor model, and we have many more assets than the number of factors. So we have that the return is equal to the expected return plus beta times a systematic the shock to the systematic factors plus E, which is a stock specific shock. And the expected return is going to be linear in the lambdas plus an error, which is this A, and there is APT implies there is no arbitrage restriction on this error term, and typically we don't focus too much on this no arbitrage restriction because often in many studies they use the exact version of the APT where this equation goes to zero. But if we don't use the exact version of the APT, this one doesn't go to zero, so is bounded. And that's what they exploit to impose the no arbitrage restriction. And in many studies, they use for the identity matrix, they use the covariance matrix of E. So I was wondering if it matters or not. And another comment is one of the strengths of the APT is the weak assumptions. And so in your study, you have normality aggression assumption. So I was wondering if it's I know for tractability, but if you really need it or not. So then they found that the compensation for systematic risk is large, is a Sharpe ratio 0.8, so it's much larger than the compensation for systematic risk. So we are really missing something very important in terms of risk premium. And as again, it also very important for the variation, explain the variation in the stochastic discount factor. And this component seems to be only weakly related to the idiosyncratic volatility factor. And if you look at a lot of different trading strategies, it seems that more than 300 trading strategies have a significant correlation with this stochastic discount factor. So I was left with it seems to capture a lot of things. And then if it's capture a lot of things, it's a bit difficult to interpret. And indeed, also when you look in table 3 to the correlation between the correlation with the different trading factors, you see there is a lot of the correlation seems to be high for a lot of different strategies. That is correlated quite a bit with momentum, with value, with profitability, investment, management, performance, short horizon reaction, financing. So there's a lot of large numbers and quite similar. So it seems again a bit difficult to interpret this component. And I think what the paper maybe could do a little bit more is in explaining a bit more why this systematic risk is priced. And because in traditional model, we assume that there is no role for idiosyncratic risk because we can eliminate it through diversification. You have this model based on Merton, which is at the end of the paper. So maybe you need to give more relevance of that model because it's really at the end, and a referee could be tired before he arrives at the end of the paper. And also, there are some assumptions which are a bit maybe quite rigid. The assumption is that investors are aware only of a subset of available security. And also, I think you use a diagonal covariance matrix of asset-specific shocks, which in the rest of the paper, you don't have a diagonal matrix. So there is a bit of inconsistency with what you have before. And I think one explanation could be based on what is suggested by Merton, which some investors are constraints, but so the supply of stocks that investor cannot hold would be then relatively high, and then the price would be lower. That's why the return would be higher. So there could be some imbalance between supply and demand, which could explain some of these results. And there is an interesting paper by Mark and Zhu that they based also on the Merton studies, and they show that the price of idiosyncratic risk, they show that it's price and depends on the correlation with the aggregate idiosyncratic return. And finally, another paper which provides also some possible explanation is a GFE paper, and they show that they can extract a common factor in firm's idiosyncratic volatility, and they show that this idiosyncratic volatility is related to the risk in the human capital of individual households. And so the common fluctuation is firm level risk enter the pricing kernel of households, and that's why is price. So I think it's you don't need to do too much analysis. I think you need just to be a bit more discussion and maybe to give a bit more relevance to the model to explain why the unsystematic risk is price. And related to the demand and supply effects, there is this literature on demand system as pricing, which has been mentioned in previous papers today. And so they derive this demand function, which depends on observed characteristics and a latent demand. And they found that the latent demand is the most important component, which explains 81% of the variance of stock returns. So the stock returns seems to be explained by demand shocks are related to changes in observed characteristics. So, and when in this literature, when they estimate the price elasticity of a traditional factor model, like the capital C pricing model, they found that the price elasticity, the theorem price elasticity is huge, where in empirical works, they found that is much smaller. So it seems that if you think about capital C pricing model, stocks are almost perfect substitute of each other, because what matters is the systematic risk. So you can replace a stock with a beta of 2 with another stocks with the same beta. But now, if unsystematic risk is important, then you have those stocks are not perfectly substitute anymore, which could explain why the price elasticity is not high. And so I think if you can build a connection with this literature, could help you to explain to sell a bit more the impact. I think the impact of your study would be even greater. And also because I think it's still an open question why the price elasticity is so low. So you could provide an explanation to this outstanding question in that literature. And finally, so I was almost often focused on practical implications of the model, and so in this case, factor models have been used a lot in practice. To estimate the cost of equity, for performance evaluation, and there is, for factor models especially, there is an industry which has been built on factor investing. So there is now a large, lot of investments in factors, and the factors, it's been shown that they're very robust across time. They even went, back in the past before 1926. They found, there is a risk premium associated with the factors. There is a risk premium if you go across different countries. And but now you show that this unsystematic risk is even more. The risk premium, the Sharpe ratio is even higher than the factors. So then, would be nice if you can use it in practice. I understand that the methodology is much more complicated for you know, for the factors, it's a easier and clear recipe to follow, but maybe you can find a way to sell it to practitioners as well. And I have some studies on mutual fund performance. I would be curious to see how to use this model for performance evaluation, given that mutual funds already have a hard time to beat the factors. And in your candidate model, you focus on a few models, including the capital suppressive model, and I think you do, to find my friends, 3 factors. I don't think the results will be different, but it will be good to show also the 5-factor model, which has been proposed because the 3-factor was not working very well. So, so at least I think it's good to focus on this better model. And I would like to see a bit more cross-sectional evidence. I know, I think it's by cross-sectional test, I mean like type of Farmer-Macbeth type of analysis, which I think is a bit empirically a bit difficult because you have to estimate your model using a window. So probably there are some challenges, but I would like to see some more cross-sectional evidence. Some out-of-sample analysis, for example, using international stocks. That could be another paper. I know the paper is already more than 100 pages, so most of my comments you can consider for another paper. And in some of the theoretical results, it needs to be very large. Then you use 200 portfolios. So if you want to end large, you could use stocks instead of portfolios. And then I was curious about some of the predictability of the different components. To conclude, is a very interesting and innovative paper. I will use it when I teach my PhD course in the fall. It's I think it's everyone should read it. And again, I would like to see a bit more discussion on the economic reason of why the systematic risk is price and the connection with the demand system asset price.
Thank you very much. Other questions from the audience? Frank?
Okay, so if I looked at the formula, the expression for the unsystematic part involves the inverse of the variance-covariance matrix of the sort of idiosyncratic risk. But you have like 220 portfolios. I mean, can you actually invert that matrix, or do you use some kind of shrinkage estimator? So how do you implement this?
Nice presentation. So it seems like you're ignoring the whole literature on machine learned SDFs. So, I mean, if you take like this like standard Nagel, Kozak, Santosh SDF, the pricing error would be 0 by construction in sample, right? So how much do you believe I mean, now you're making a big story that unpriced risk is like a big thing, but in these settings, it's 0 by construction. So what do I do with your paper?
Can you hear me? Yes. Okay. Okay. Let me start from the end. First of all, actually, I would like to thank you very much, Fabio. It was a very great discussion. Thank you very much for all the suggestions. I might ask you if you can share also your slides, because to take notes of everything. Thank you. So let me start from the end. So sorry. Okay. So yes, you are completely right. If one focuses on pricing errors, just like defined as sample mean minus the exposure to systematic risk, there will always be like some component left out, which is going to be the pricing error, what we usually call the pricing error indeed. And in sample, essentially, one might think that that component is essentially be completely, whatever is missing is going to be the little a, what we call little a. So by construction, it is equal to 0. So this is true in sample, but also if one focuses only on the pricing errors as computed in this way. We compute pricing error actually taking the product between the SDF and the excess and excess returns. And SDF does not depend only on the first moment, but it also depends on the second moment. And we do not use in sample second moments, and we do not even use in sample first moment estimation, but we use the model implied expected return and also the model implied covariance metrics to estimate the SDF. So this doesn't. If we were to use the in-sample quantities. No, we use the model implied quantities indeed. So if we, so since we exactly to avoid this matter, that's also the reason why we have the impact of the restriction and the estimation process which kicks in, because little a will not be exactly equal to the difference between the systematic exposure and the sample mean, but this will take the form of a ridge estimator. So we will not have little a to be exactly equal to whatever is missing. And so that's the reason why we do not get perfect fit, which would definitely be an overfitting result. So this is, we try to remove that estimation noise, exploiting the constraint, which at the same time reduces estimation noise and also puts some constraint on the arbitrage in the market. So there are different goals for this. I hope this answers your question, but I'm happy to talk about this more. So about the inversion of VE, actually I also had the opportunity to answer the other question, the comment about how much VE matters in the results, and actually I also had the opportunity to say why we call it unsystematic risk rather than just asset specific. This is because we do not leave VE to be diagonal, of course, because otherwise VE would only contain idiosyncratic shocks, but the E term would only contain idiosyncratic shocks. But from this literature, exactly as you mentioned, also Lettau and Pelger paper, for example, we know there is all this set of factors which are weak factors which cannot be disentangled from the idiosyncratic shocks. So, and indeed, under the more general APT setting defined by Chamberlain in 1984, we know that we do not need VE to be the covariance matrix of the error term to be diagonal, but it can be also non-diagonal as long as the covariances in the cross section are very small, which means that the eigenvalue of this matrix has to be bounded when n diverges. So under this setting, all the factors which are included in the covariance matrix are weak factors. And indeed, also like another contribution that we are thinking of this methodology is that in this way we can estimate all at once. So our unsystematic component, the compensation for the systematic component, will account for both compensation for idiosyncratic shocks and compensation for exposure to weak factors. So indeed, there is another exercise in the paper where we try to separate those two components, because one might think that, okay, whatever you find to be compensated is unsystematic risk, that's fine, but 100% of it is driven from the weak factors, actually. It's not driven from compensation for idiosyncratic shocks. So we run an exercise trying to making these covariance matrix that we estimate as diagonal as possible in order to see how much of the final SDF actually is driven by weak factors and how much is driven by compensation to idiosyncratic shock. So we find it to be about 50-50 in this back of envelope calculation that we make. So in order to invert VE, this is super, this looks like a super tough story. We use like the Woodbury identity. So this matrix has a form of, so actually we do not invert VE, but we invert the variance of the returns, because actually I didn't mention before, but we do not use that version of the SDF directly, but we take the projection onto the set of assets because our SDF depends on unobservable quantities. So taking the projection to the set of assets, we do not have to invert VE anymore, but we need to invert like the variance of the returns. And we exploit the Woodbury identity in order to make it easier and faster on the coding. And but this still is not super fast, definitely. Indeed, one of the other issue that we are addressing right now is exactly touching another point that you mentioned. So sorry, just one last thing is that exactly that the estimation process takes time. So in order to use it in practice, we need like to make it much faster and hopefully to also make it more useful also in practice in order to get a result in a short time. So, but in general, thank you very much for all the comments. I'm happy to take any other comments also later. Thank you.
Okay, thank you very much. Thank you very much. This is the end of the day. So it was a very long, productive day. So thank you very much all for coming. Special thanks again to Florence and Alberto and all the staff of the Collegio. And also on behalf of my co-organizers, Marco, Marcello, Pietro. And so logistical thing. So we will have a dinner at 8. So see you there. Galleria Subalpina is you should have received all the information from Florence. I guess if you have questions, ask. Okay, but I'll send you. Okay, thank you all very much.